coffee outside, so please enjoy it. And now let me declare this conference officially open and pass the microphone to our Mistress of Ceremony, Tatiana Kvitka, who will acquaint you with all the details. Thank you.
Well, hello, hello. How's everyone doing today? Are you awake? Did you have that wonderful coffee yet? All right. How's everyone doing today? That's better. That's better. So, Anna, thank you very much for the wonderful introduction. I hope you'll have 2 very busy and very entertaining days. I have a few announcements for everyone here. And one of them is going to be about the pitch competition. So who is here to pitch the company or the idea? All right. So listen attentively. Here's the rules. Every company will have about 15 minutes on stage. So you'll have 6 minutes to pitch, about 6 minutes for Q&A, and the rest of it, 3 minutes to come on stage and leave the stage. So that sets the stage for everyone on equal terms. We have our judges who will be here at the desk and also in the audience here at the tables. So the judges will be listening to a pitch, but your pitching is not going to stop here on stage. Please feel free to come talk to the investors after you're done here on stage, because the winner is going to be announced at the closing session. So you have all these 2 days to present your company here. Okay. The winner, by the way, is going to receive the prize sponsored by Microsoft. So it's going to be $60,000 worth of cloud cost from Microsoft Azure. So that means you have $60,000 more to spend on your development, on marketing, and all these other things that a startup needs. Who needs a conference agenda? Everyone has it? Okay, for those of you who don't have it, it's on Bizzabo, so we're proud to take care of our environment, and we go paperless. Please download the Bizzabo app on App Store. It's available for free. And don't forget that voting for your favorite startup is not only going to happen while they're pitching on stage, but also through Bizzabo app. So, while startups are talking to investors, that's yet another chance for people to go to Bizzabo and then, cast their votes. So a couple of social networking announcements. So our Twitter hashtag SVOD14. We're going to have the Twitter feeds here on 2 screens. And we're going to receive questions from the Twitter feed and from the audience here after each presentation from the speakers here. So, you can send your question on Twitter, or you can, if you're here in the audience, be assured your questions will be heard and answered. And we're going to be streamed live on svod14.org. So for any of you who know that there are certain people who couldn't make it here, busy with pitching at some other conference maybe? No, I'm just kidding. So who couldn't make it here, they can definitely catch up with what's going on here on svod.org. And the last but not least, the games. So we have 2 games, and the winners of the games will be announced at the closing ceremony as well, and everyone will get a prize. So one game is called Fantasy IPO. Each one of you received $300 SVOD with your badge. So once listening to the startup pitches or talking to them in the hallways, you know, you may invest in a certain startup by giving them these dollars. And so in the end, the startup that receives most investment will be the winner. So once again, just a reminder, please continue networking during the breaks, at the reception. This is your chance to be the winner of this game. And one more game, Business Model Canvas. Who played that game before? Okay, good. So the rules of the game are on that table over here. Angelica, could you please, show them. They're right there. So you have two printouts, one that explains the rules, and the other one that kind of shows the different graphs where you fill out the information. So basically, the way it works is a startup gives a pitch, and you, people in the audience, fill out what you think the startup's business proposition is, key partners, who are their resources, and what are their customer relationship, just to kind of see if the startup managed to deliver the idea to you. So once you're done with filling it out, there is a wall right over there, and there will be marks on the wall for each company. And please post your on the wall, and the jury will collect them and will compare the pitch with what you think was the pitch. And so the company whose pitch was the closest, in your understanding, to the real pitch will win. And once again, the winners will be announced at the closing ceremony. So with this, I would like to invite Anna Dvornikova back on stage. And welcome again.
Except that our speaker is stuck in traffic. So let's do this. Let's have 5 minutes of just networking and fun. Maybe Oscar will help with some nice music, and we'll wait for George, and then I will introduce the panel. So I would like to introduce our first fireside chat, and that is obviously called Successful Investments in Early Stage Startups. Is it a luck or a vision? What a question, huh? Very often successful investments in early stage startups are called luck, because really it's very hard to have any parameters on the startup that has no employees, no product, nothing. And one successful exit surely can be called a luck, and maybe two, or maybe three. But when you have more than 3 successful exits, bringing more than $1 billion of revenues to investors, then it's called a vision. That's why we have here George Zachary, managing partner of Charles River Ventures, one of the nation's oldest and most successful early-stage venture capital firm with approximately $1.4 billion under management. George is a Middle East investor, famous for being first investor in such companies as Twitter, Yammer, Shutterfly. We all know these companies. So why George is here? He's also here because he's famous for his intuition-based approach to entrepreneurs. And probably there is no way to share that experience. Probably this vision comes with experience and years and education and background, many other things. But we hope that George will share at least those with us, his ideas, how he sees entrepreneurs, why he selects them, why he doesn't. He focuses on consumer internet and infrastructure companies. And at Charles River Ventures, George started a seed program called Quick Start, where Charles River Ventures invests about $100,000 to $250,000 in a company. He graduated from MIT studying computer science and business. And our moderator is Ari Levy, senior technology reporter at CNBC Digital. Previously, Ari served as a technology reporter at Bloomberg News, covering networking, internet, and mobility. And he moved to Silicon Valley from New York in 2006. In New York, he was writing about stock market, and so now he's writing about technology companies. He has a master's degree in business journalism from Baruch College in New York. So George and Ari, welcome on stage. And one last thing. This is our 10th anniversary. So we decided to make lovely surprises for our speakers. You will see mugs on this table in the middle of the stage, and these mugs have caricatures of the speakers. So speakers, do not forget your mugs when you leave the stage. Thank you.
Good to see you too. Which one's?
I think that's you.
That's me, yeah.
So this is quite literally a mugshot. Good to see you. It's been a while.
Too.
So let's start with, I guess, the obvious question. You've been doing this for what, 15 years, VC, 16?
19.
Okay, 19 years as a VC. Have you ever seen an environment like this in your almost 2 decades?
Well, they say that history doesn't repeat, but it rhymes. I have. We're definitely in an inflating bubble right now. People like to think that bubbles are binary, that either we're not in a bubble or we're in a bubble, but we're in an inflationary bubble where the assets are increasing. So this is not 2000, but we're at the beginning of we're kind of in the middle of an inflating bubble.
And talk a little bit about, for the audience who doesn't perhaps know as much about you, where you focus your time, because then we can sort of put that in the context of how that's affecting your environment.
Yeah, in fact, we just had meetings with our limited partners last week, and we were talking about our strategy. So, if you're going to be a venture capital investor, probably the best way to focus is by focusing on the early stage to avoid a lot of the problems with later stage investing and market timing. So, I don't go after investing in Snapchat at $2 billion or Uber at $4 billion. Those might be good investments, but I try to focus on them in Series A and Series B investments where, the valuations are at, anywhere from $5 to $25 million, sometimes a little bit higher. But if the company works out, I can still make a positive absolute return. So that's kind of my just general investment strategy, is to stick to early. And I'd say of the 30 investments I've made in 19 years, all of them, 2/3 to 3/4 have been Series A, and actually 3/4 have been Series A or more, and the rest have been Series B.
So it's safe to say you weren't responsible for bidding up the Uber $17 billion round, or 18, I guess,
No, I wasn't responsible, but I also wasn't able to get into the Series A.
So, I mean, we know what's happening at the later stage. 4 $10 billion plus companies at this point. These mega $100 million rounds pushing valuations up past $1 billion. I mean, you have almost a stock market's worth of billion-dollar companies at this point. How is that affecting the early stage where you're getting in at, traditionally a $15, $20 million pre, maybe even lower than that?
It does inflate it, but not significantly. I would say 5 years ago, post the 2007, 2008 bust, valuations for Series A, I'd say the median ones that we saw that were pretty high quality were kind of 5 to 7 pre, raising $5 million, and now I kind of see 10 to 12 pre, raising $5 to $8 million in a Series A. And on top of that, we've seen some of the bigger funds that do multi-stage also get active, and they're forcing the price of rounds up and the size of rounds up.
And so how do you navigate that? And you know that we're in this cycle. I mean, we're in this sort of frothy period of this cycle. But you also know that you can't miss out on opportunity. A company that could be worth $1 billion, the difference between 7 and 12 is negligible. So how do you navigate that with all of this money flooding in and pushing up prices?
It's my recipe for success is A, do I believe in what the founders want to do in the product? That's number one. Number two is, do I think this can become a $1 billion company? Not if I do the math on some spreadsheet, it looks to $1 billion, but is it a company that can become on its own a public company if everything worked out?
And are you having to change your approach in terms of how much of the round you need, or whether you're a lead or a follow-on? Do you have to be more sort of willing to go with the flow because there's so much demand? My focus is always on being the lead investor or the co-lead investor. When I make investment, it's either do I believe in this company or not. It's not kind of, oh, well, I'll invest if other people invest, because that's the quote-unquote social proof. I don't care about social proof. The only thing I care in is whether I really believe in what the company's doing and whether I have conviction that I feel, as opposed to that I can just think. And so let's say you do a Series A in the 10 to 12 arena, and a year later, the valuation's up to 300, or that's the asking price. How do you determine whether to exercise the pro rata when you yourself know that that's a crazy dollar amount? Well, I'll give you an example. I was the lead investor in Yammer, and I entered at a post-money valuation of 20. The company had 60,000 users. I was an investor in the previous company, which spun off Yammer. And so I really believed that it was going to become a $1 billion company. And I told the founder, David Sachs, this is going to become a $1 billion company. This is awesome. And it's going to really change how companies operate. And he says, don't put so much pressure on me. And I said, well, let's keep, growing the company. And I just watched as the company was growing, it was getting monopoly effects within companies. There were network effects in companies. And I like to fund companies that become monopolies. And the reason why is monopolies are easier to get a great investment out of, and monopolies allow for companies to make execution errors and still survive. I'm an early investor in Twitter. Twitter's made an enormous amount of mistakes, but it's still a very valuable company. So I don't look for linear companies that grow, which is like they can grow from 6 to 10 to 14 million. I look for companies that can grow non-linear, where they can basically have the product market fit that they have creates a natural monopoly. But at what point do you see monopolistic potential? It's funny, we're using monopoly in a positive here. Yeah. Monopolistic potential for a company that got sold to Microsoft. Where do you see that potential? Because even when you see it, it's still super early. Yes. So at the beginning of Yammer, I knew that there's no one else doing enterprise social networking. Some people claimed it, but it was really the form of wikis as opposed to messaging. And I know that when some people like to message to each other, they message the other and they virally bring in other people. And I knew that would happen within a company. And then the other plan was, okay, well, how do we grow virally outside of the company? And David had a great idea, which is we're going to provide guest passes to external users. And those external users would be at other companies. So all of a sudden you would have switching costs between those two companies. So if Yammer started winning in the top organizations, it would spread virally across to multiple companies. We never got to that point. Microsoft realized that was about to start happening, and they realized it was about to start challenging their email monopoly. I can say that now because I don't have to deal with Microsoft anymore right now.
and they quickly acquired the company. It was very interesting. Microsoft was very specific and told us, you know, whatever you say, do not tell anyone that we're going to integrate this into our email, and that it's an enterprise social networking play, because the DOJ regulates Microsoft, and they know that Microsoft has a big chunk of the email market. And that, you know, the interesting thing is IBM pulled a completely klutz maneuver, which is the day we announced the Yammer acquisition. IBM announced that they were the #1 player in enterprise social networking, and they were going to win. So we actually presented that as evidence to the DOJ and the rest of the other government agencies to approve the transaction. They approved it in 9 days because IBM was claiming they were #1. So I think you have to be smart about how you handle the acquisitions. But to come back to your earlier question, I just try to think, can this thing have a virtuous loop? You know, Uber has a virtuous loop that's built on geographic density, where the more and more users the more and more customers you have, the more and more drivers that you attract, which forces the price down lower, which reduces the power of the existing incumbent. So you can see how that drives things. My biggest issue with Uber early on was I didn't know how the regulatory issues would play out.
Well, we still don't.
We still don't. Still don't.
Yeah. So you did, there were, what, 2 follow-on rounds at Yammer?
Yes, there were.
And you participated in both?
I participated in all the rounds up through the price of, the last round we did was $500 million. So I'll tell you the rounds, because this is quite interesting. It shows you what happens. So I did the $20 million round, then another firm led the next round, which was at 50, 40 pre-raising 10. Then the next round was done at 200 by another firm, a brand new firm, who led the round. That was like a $25 million round. Then there's a round done at 275 where we took some capital, a little bit smaller round, but we needed something because we were starting to burn a lot more capital. And the next round we did was at 500. And we only wanted to raise $50 million, but in 9 days we got $120 million of demand. And this was 5 years ago. And what had happened by that point is all the people who had passed on the Series A, B, and C, and D realized that Yammer was the breakaway winner, and they didn't want to lose out. So they put in some minor money at that point. And so those companies at that point realized that Yammer was going to be the runaway winner.
Part of the reason I ask is, and you've obviously been hearing this for years now, but you know, as famous as you were for getting into Twitter at the earliest possible stage, you're also perhaps infamous for not following on.
Yes.
What was, contrast those decisions, and how much of it had to do with challenges within the partnership of just convincing your other, you know, was it you or was it the other partners who just couldn't get comfortable with it?
Well, if anyone here has ever talked to or seen David Sachs present, he's an amazingly brilliant guy. And he gives a very compelling presentation. He had a great track record being the co-founder and CEO of PayPal. So it was very easy to back David because his presentation is awesome. Even if he never did anything with PayPal, he's a brilliant guy. When the Twitter guys came in to present at the Series B and C, well, they presented the Series A. We put money in because we wanted to, but the Series A and B pitches were probably 2 of the worst pitches I've ever heard in our firm. And basically they said, well, people will tweet, and here are people tweeting around the world. And this is at the first pitch, they had 60,000 users monthly.
This is 2006?
This is 2007.
Okay.
And their whole presentation was that people will tweet, and here are some people tweeting, in the future people will do advertising. There was nothing else.
Yeah.
And they basically just stated the obvious, that you could just look up what Twitter was doing. They had no specific vision. They had no brilliance or force of presence in their presentation. It was not a very compelling pitch at all. And you know, I think that what we learned, and what I learned, was that do not draw a false positive on the founder if you have product market fit. A false negative, excuse me. We thought that the founding team there would probably give up or try to sell the company, and that there wasn't enough core engineering there to sustain the company. And you know, the ironic thing, we were kind of right, because the engineering had a major problem early on, and still has. It's gotten a lot better. Mike Abbott actually fixed a lot of the problems on engineering.
Yeah.
But yeah, so I kind of relived that that mistake
Yeah.
probably every day for a year, for years.
At least you got into the Series A then.
Yeah.
But it sounds like even with the product market fit, you weren't, I mean, if their pitch was like, oh, well, people will tweet, and you're like, well, what the hell is a tweet? I mean, like, you don't even know if there's, like, that might not even be there. So you had sort of questions about the founders and about the...
Yeah, well, the reality is that I knew that several of the founders wanted to sell the company within the first couple years. They had no idea why people were using the service. And when founders tell me, I have no idea why people are using the service, and you know, I hope someone buys the company, that makes me pretty nervous. It doesn't inspire me to invest in a new round.
Yeah. But it's actually feeds well into one of the things I wanted to ask you about, which is you're getting, I mean, when you do it right, you're getting in so early that, you know, numbers are sort of pie in the sky, and
Yeah.
you're making bets on the founders. What's an immediate red flag? As much as you may like the product market fit, as much as you may actually personally like the founders, what's just something that where you can't pull the trigger?
Wow, that's a good one. Things we see product market fit. Well, on the consumer side, the biggest red flags are, I would say founders lying in pitches, early pitches. I mean, it's better just admit and just say we don't know than lying, because that basically sets an example of that there'll probably be a lot more lying in the future. So just saying we don't know is absolutely fine, because we know that we also don't know all the details, and we also know that our most successful companies don't know all the details as they grow and scale. So lying and misrepresentation is a big red flag at the beginning. On the enterprise side, it's a little bit different, because there you need you can actually do some diligence to figure out whether people are going to use the product. And I'd say there is, there you need a lack of any interesting customer references, even if it's pre-purchase, is a bit of a warning sign.
So how do you source deals these days? And how much of the channels are the same? How much of it has changed, again, given the number of new players in your market and just the vast amount of data that's out there versus even 5 years ago?
In terms of sourcing, I would say it's changed. 19 years ago, I was brand new in this business. I just knew people that I worked with at Silicon Graphics and a couple other startups before. So I didn't know a ton of great founders, but I knew enough people. And Silicon Valley was a lot smaller in terms of active founders back then. Back then, people used to send me business plans via FedEx, like these binders would show up every day. They didn't send me any like short PowerPoints over email. So back then, it was really attorneys introducing companies to me and other founders, and almost like this old world dating style. It was very long and laborious and linear for everyone involved. Now it's very different. Now a lot more of the best venture firms sourcing is driven by promotion of their own winners on social media, on traditional broadcast. It's driven by having a portfolio of winners. So the more winners you have, the easier it is to source. So there's a bit of a network effect in the venture business. And if you don't get those winners, it's very hard to market your firm. Yeah. So it gets easier and easier for us with the more and more winners that we have, especially if you're focused on early stage.
So is it possible to give a rough estimate of how many of the deals you do now are inbound pitches of some sort versus you meeting an entrepreneur at a SVOD conference or some such?
Inbound meaning?
Meaning because you have, Twitter and Yammer and Millennial Media, et cetera, on your side, and Pebble now, and people just know that people know you're a Twitter guy, they know you're a Yammer guy, and so that speaks for itself. So you just get tons of.
I think the former drives a lot of deal flow, and there's such huge competition for deal flow. I have to compete against the 20 other top firms, and these are not people that like to lose. So acting quickly, having our whole partnership involved is absolutely critical. I'm just closing an investment right now in a company where we met the company on Friday before the Memorial Day weekend. Was that Memorial Day or Labor Day? I always forget which one it is.
That was Memorial.
Memorial Day, yes. And 3 of us worked through the entire Memorial Day weekend to meet the company, spend time with them. 2 other partnerships didn't do that, and they lost. So my business is a 24/7 business now.
And when you see firms pouring money into services that they never used to pour money into, so money not just strictly going to investments into high-priced partners, but to all sorts of other services, and we all know who we're talking about here. What does that do? How do you react to that? And how much of that are you guys thinking about?
So our firm, CRV, well before I got there, in 2000 had a program called CR Velocity. And they had 70 people doing marketing, helping companies do marketing and recruiting.
70 people internally?
70 people doing recruiting, helping, very similar to some other programs people have rolled out. And at that point, the firm had a pretty big fund of $1.2 billion, and we're using the fees from that to pay the people. And it turns out that not the best people in the world want those jobs, because the best people that do those things really want to stay single proprietors, especially on the recruiting side. That's one issue. I would say that they're very effective marketing vehicles. So some firms that we compete with use that before in the selling process to close founders. But post-investment, it's very unclear whether they will work well. In fact, at CRV, we found that they didn't work well. In fact, they usually convinced partners to make investments that they shouldn't have made because they thought, well, we'll use all these resources to make the company great. And the problem is that you can't make a bad company into a great company by just adding external people that come from your own firm. So, I think as money cycles in and out of the venture business, this year probably $32 billion will be invested in venture.
Which is the most since 2000, I believe, right?
Yes, it's the most since 2000 was a crazy year of 120 billion. Historically, it's 8 to 16 billion. It's really, you look at it as a percentage of GDP.
Yeah.
And I would say that these extra services, they're helpful. They help differentiate the firms, but I don't know if they really help the companies. If you look at some of the most explosive companies in terms of growth, none of them have actually grown from them at all.
So at CRV, have you actually gone the other direction? And do you no longer have the sort of full services?
We actually have a head of talent who ran recruiting at Facebook. And her job is to find directors and engineers who want to voluntarily leave Facebook, I'll put it that way, and join some of our portfolio companies. So we do that because of the ridiculous shortage on the engineering front. And our other job is to basically help network with people. But at the end of the day, I would much rather back, not to use crazy examples, but these are a bit crazy, but personalities like Ellison and Steve Jobs, where these are forceful personalities that want to change the world. And they just say, hey, I need your money and just get out of my way. That's I'd prefer that than someone says, can you give me money and I have no idea what to do, I need all the help possible. Because that's usually not a sustainable, that's not usually a sustainable company.
Yeah.
And that person usually doesn't attract really high quality other co-founders or teams around them.
So a few years ago when I was talking to folks like you, one of the big themes was you can do smaller investments, companies can raise smaller amounts of money because there's very few infrastructure costs. So
yes.
AWS and open source software and all these great tools that are just sort of, everyone uses now. And so you did have this ability to do smaller seed and smaller Series A. Now those numbers have come back up to even being higher than they were before. And in part, that must be because talent is so expensive, right? Or maybe I'm wrong.
Partially, it's because talent came out. We did, in 2006, we rolled out a program called Quick Start, where we would give founders $250K and an uncapped convertible note, or $100K. Then we switched it down to $100K, because a lot of angels got very irritated that we're giving uncapped convertible notes because we're killing the pricing umbrella.
Hey, can you explain that for... But why were they getting irritated by that?
They were getting irritated because an uncapped convertible note was screwing up their attempt to control early stage valuations of seed stage companies. Okay. And that was a little bit of a scandal that broke across TechCrunch called the Bin 38 scandal.
Yes, I think I remember that.
So, we played nice with the angels and we decided to lower our amount. We said, here, we'll put in $100K. We're not going to jam the whole round. And we'll go with whatever terms that the angels decide. Since then, we've basically moved off of that. We put we did about 80 to 100 seed investments, and we've made more than our money back through a couple big winners. So, but the difficulty of doing it was that a lot of these companies would raise 100K from like 10 investors, and when things went wrong, no one would want to bridge the company. Right. Everyone said, well, I'm not doing it because they're not doing it. So a lot of these companies would basically just go down the tubes.
So there's no one left to invest.
There's no one left to invest, and there's no one who feels a sense of responsibility or commitment. So we've changed our program. We do not do the small investments. If we do seeds, we'll invest, $1 million for 10 to 15% of the company for very early stage companies. But we're not going to, where we're actually being a lead in that round.
Do you think that do entrepreneurs have too much leverage in this market?
I don't think so. I think the goal of all of what we're doing is to basically make the whole world better and make the economy better. So, it's up to me to basically be a better competitor and be a better player. So, competition is a good thing for everyone involved in the ecosystem. I think entrepreneurs have way more leverage than they did 15 or 20 years ago. It's a remarkably better situation for entrepreneurs. And I think overall that's probably better because that means you can grow companies faster with a cheaper cost of capital. I mean, the people who make these companies are the founders. It's not the capital. The capital is a fuel.
Yeah. I guess I look at, some of the scandals that are breaking, or that have broken in the last couple months. You look at, GitHub or Radium One or Rap Genius. It seems like every couple of weeks there's another co-founder who's gotten him or himself into trouble. And these are all very different situations, and I don't mean to categorize them, but it does feel like, are we giving entrepreneurs sort of Justin Bieber-like status so they can go do Justin Bieber-like things?
Well, we live in a social media world now where there's tremendous amplification of everyone's behavior. And everyone talks about that's the wisdom of the crowds, but we could also be heading into the tyranny of the mob. Meaning that large groups of people can now oppress one person very effectively based on what they think. And it's a new world. There used to be public lynchings in the United States because a mob would get together and say, you're guilty, and hang someone without a judicial system. So we have this tyranny of the mobs emerging. Whether they're right and wrong specific cases is to be judged on each case, but it doesn't seem like there's any counterbalancing force right now.
And do companies need to change the way they think about board structure because of this new environment? You have, boards are still very similar to how they were 10, 15 years ago, where it's, a few VCs, generally male, who have, their interests are in turning the company into $1 billion company. Yes. Nothing wrong with that, but then you do hit this sort of roadblock or perhaps a significant scandal, and it's, people throw their hands up in the air and they've never dealt with this before.
So what was the question?
So the question is, should companies be changing the way they think about their board? Like, should they be bringing a more diverse array of views onto their board versus just VCs?
The question is, at what stage?
I guess that's is it happening at your stage? Should it be happening at your stage?
I don't know. I know that at my stage, the only thing I care about is I want strong founder representation. Oop, there goes my phone. Strong founder representation of the on the board. I don't need to have board control because there's a simple reason why is, number one, I'm not a control-focused person. Number two is venture firms are never made by the terms that are on the term sheets. They're made by the success of the companies. And controlling a company and swapping a founder out really usually doesn't change the net effect of the company. Some venture people like to believe that because they think, oh, I'll change the CEO and everything will be different. In the reality, nothing is different. Usually the only CEO swaps that work well are where the founder says, I don't really want to be the CEO because I can't do this and I would just like to be chief product officer or head of some other group. So at the board level, at the early stage, I like to work with other board members who have a very long-term focus, and their only focus is to increase shareholder value. I don't really want any corporate investors. I don't want to have any investors that have any political goals or any kind of social goals. I'm not interested in that at all. I'm interested in increasing shareholder value. I mean, I'm a venture capitalist, I'm not a venture charitableist. So, and I don't mean to insult people who give to charity, I do, but that's not my job. LPs give me money to return money to them, and most of my LPs are foundations and pensions. If I don't return them money, they are not happy and they don't fulfill their goals.
So at what point does that perhaps change into, your best opportunity to increase shareholder value might be to have a more diverse board and a differing views, so you can deal with things as they emerge?
Yeah, but that could be true. The question is, what is diversity? Is it diversity of thinking? Is it diversity of gender? Is it diversity of race? Is it diversity of geography? I mean, everyone has their own viewpoint of what it should be. The only thing that I really care about is, can everyone on the board actually add value and not be a jerk?
So let me ask one more question about this environment. When you see companies providing employees everything from lunch, breakfast, dinner, dessert, to round trip buses from the city down to Mountain View or Palo Alto, to subsidized housing, basically allowing them to just focus on their code base. Does it concern you what the are there ramifications for that we should be thinking about? I mean, are we like building automatons that do nothing but,
That's a good question. I mean, it usually means there's a lot of money floating around that you can do that. I mean, when there's low capital in the system, companies aren't funded well enough to do that. When there's lots of money in the system, like there was in '99 and 2000, I remember the nonstop shrimp cocktail parties put on by startups, right? And then the price of shrimp went way up, and 3 years later, the price of shrimp went way down. So I just think that's a function of the capital sloshing around, and there is a lot more of it now.
What's one that got away? It's a company that you should, and you already mentioned Uber, so something besides Uber, company you should have invested in but didn't.
Trying to think of the most obvious example that I kind of blank these out of my mind because they're too painful.
That's my job too.
I would say an interesting one from an economic perspective is Snapchat. And I was one of the 4 people that put together Shutterfly. Actually, a bunch of the product concepts came from me and was incubated partially in my office. And I met the Snapchat guys, and they thought pictures should be ephemeral, which is kind of the opposite of what Shutterfly thought. So I had a old person's bias against that view. But I think that, I turned it down. But one of the reasons was I was a little spooked because I asked the founders, is this more than just sexting? And they said, of course this is more than just sexting. And I said, well, how do you know? I mean, do you run analytics? How do you analyze the pictures? He goes, oh, no, we don't run analytics with pictures. We have monitors in our office, and we see everyone's pictures going by. So that, to me, said, I don't know if I should trust these people, because they just laughed when they said that.
Yeah. That's interesting because, so sure, you made a mistake by passing a seed or Series A, because now your money would be worth many multiples of that. But it still isn't at all clear to anyone but perhaps the founders of the company.
True. I'll give you another good example. When I was MDV, which is the firm previous to my current firm, Larry Page and Sergey came and presented. This is before the Kleiner and Sequoia round. And the most senior member of the firm by age, I'll put it that way, after Larry and Sergey presented, he said, I don't get it. Who needs another search engine? And these guys are totally arrogant, like they know what they're doing. And they've never managed anyone.
Yeah.
And that person, I don't want to name that person, basically shut down the entire conversation. So at that point, we could have bought 16% of Google for $8 million. So I can tell you, about 16 years later, I finally stopped doing the math.
And what's a company either in your portfolio or not that no one's talking about now that we'll all be Snapchatting about in 3 years?
The one that is initially when I funded where people thought was totally crazy is the watch I'm wearing, which is Pebble. It's my fastest growing company ever.
By revenue?
By revenue. So I'll give you some numbers here. We sold $43 million worth of Pebbles last year, the first year of operations. We made a lot of money post-tax. There's 8,000 developers building apps. This year we'll do at least 2 times that revenue and growing. We are beating Samsung in the market. We think we're going to beat Apple in Q3 because we know we have a good idea of what their product plan is and pricing. And we're moving into a different segment than they are. We're focused on watches for everyone in the world. Apple is going to make a very expensive watch. So, my take is this year, Pebble has enough revenue to become a public company, but we have no desires to do that.
Can you talk about what kind of margins are?
We're a 52% gross margin company. Last year, we had very significant post-tax income that's on the scale of Google. Post-tax net income, and that's without any net carryover loss or anything.
So as you hire for Pebble, is the emphasis across the board?
Yeah, we need everyone across the board. I was just there yesterday and on Friday. On Friday we had our 100th employee. I invested when there was 7 employees, and it was at the tail end of they had finished their Kickstarter campaign and they hadn't started manufacturing it. But people said, that's a watch, like anyone else could make a watch. And that's frequently what a lot of people say about a lot of simple products. But we're building a platform. Our focus is not just building a watch, it's to build the next generation of easy to access computing. And I know that sounds like a mouthful of non-meaningful stuff.
Did you come across Pebble through Kickstarter? Did you contribute?
I knew about them through Kickstarter, but I looked at another company that was doing something in the hardware space around photos, which I passed on. I had a good interaction with those founders, and the founders knew Eric, who's the CEO founder of Pebble, and they introduced me to Eric. And that was January of 2013.
I was thinking I would get the scoop on your Pebble numbers, and I realized everyone's tweeting them out, so the world has now seen them. Any questions out there for George? And is there a mic floating around in case? No questions? Do you have a bias, enterprise versus consumer at the moment?
I don't like things that require complex selling, personally. If you look at the investments I've made, they've been consumer versus what I call horizontal enterprise. I'll do things that are like Yammer that go across the enterprise. I don't personally like investing in database and infrastructure and kind of hardcore technology. It's not that I don't find it technically interesting, I just don't want to invest in those areas because I don't know the nuances of those areas.
So enterprise apps that sort of surface from the bottom up, the Yammer-like model you're okay with?
Yeah, I like that. My partner DevDut invested in Zendesk when they were in Copenhagen and then moved them out here at the earliest stage. So, we'll do all layers of the stack, but I kind of focus on consumer and horizontal enterprise.
Zendesk, which just went public. There's a question here, and there's one in the back. I think the mic's in the back right now, so we'll start there.
George, you spoke a bit about the exploding valuations. How do you handle it when a company is going sideways and there's some promise and there's running out of cash and facing a down round?
I have one of those right now. And in fact, my friend is, a personal friend of mine is the founder. So for the last 3 months, he said, we're really going to need a bridge to make the next round. And I told him, I'm not going to name his name, I know we're friends, but I'm not giving you a bridge. Just because we're friends, I'm not going to tell my other partners that we should give you some capital. What you need to do is you need to demonstrate that people actually like the product, even some embryonic growth around the product. So they've pulled it out. 3 months ago, they got to some level of product market fit. It's a SaaS company. And they're now growing about 50% a month. It's only been 4 months. So that gives me the ammunition to talk to my other partners and basically say we should put a bridge into this company. If there's no ammunition, it becomes a very difficult discussion, especially if it's a very capital-intense company. If it's like a hardware company that requires tons of capital and it's going sideways, that's really hard to do because the question is, it's a bridge to what? Like, what's on the other side? Like, we don't do bridges to bridges to bridges. Like, we usually do bridges to an acquisition or bridges to get to the next round, assuming there's a product market fit where we can see that people are starting to use more and more of the product. But that's always a tense thing in our partnership. And part of it is that we have a completely flat and equal partnership. All of us get exactly the same amount of compensation and the same votes in our fund. So I can't make the decision. I have to convince the rest of my partners that they should do this. Thanks.
There's a question up here. Oh.
Okay. Thank you, George, for the presentation. Actually, I wanted to ask, how likely is it that a new company actually is not eaten up by a larger corporation like Google and Facebook and Apple when we talk about this huge valuation, okay? So how is likely that there is the emerging of a new company that is even larger than the former one, actually?
So just to understand your question exactly, you're saying, can a new company disrupt an old company and grow bigger than the old one? Is that correct? Well, I mean, that's kind of, luckily that's kind of the business that I'm in. You know, Google did it and disrupted Alta Vista and Yahoo's search capabilities. So it always tends to recur. I mean, I think right now Airbnb is basically challenging the entire hotel industry, which no one ever thought. I mean, if 10 years ago someone say, oh yeah, I'm going to fund a company where people put down air mattresses in people's homes and people stay there, and this will become bigger than, have a bigger market cap than all the other hotels, I don't think most people would have believed that. I think very few people would have believed that other than people who stay on air mattresses. So things like that can occur. Like, to give you an example, when airlines first came out, everyone thought they would completely disrupt the railroad business. It actually didn't happen. This is an opposite case. Airlines right now have roughly total revenues of 150 billion and a market cap of around 30 billion. In the railroad space, there's a company called Union Pacific that has roughly a $20 billion amount of revenue and has a $60 billion amount of market cap. The reason why is Union Pacific is in the railroad tracks business. They're not in the railroad business. They control the scarce asset, which are the railroad tracks. So what I'm trying to understand always is, what scarce asset can this startup sooner or later own that gives it leverage and power so that it can become a big company? So I think that continuously happens because big companies get bigger, people get lazier there, they tend to attract people that are more focused on their salary and, you know, feeling safe as opposed to wanting to take a risk.
So I see a microphone back there, and is this our last question? Yeah, this is our last question. George will be around for a bit afterwards. I know he's one of the judges coming up, so there will be time to chat with him.
Alex Trainer, founder and CEO of Pet Wireless. Thank you so much, guys. It was great so far. I have a question for you about Kickstarter. Do you troll Kickstarter at all? And if you do, for consumer products, and if you do, what is the threshold that you would expect company to achieve in a number of customers and or cash raised?
We have people in our group that definitely look at it, but I don't spend most of my time trolling on Kickstarter. We look for interesting products that we think could become a platform as opposed to a one-time purchase. So we try to find products that could become recurring businesses. It's really hard to figure out, and I'm not saying that I'm remotely good at it. I mean, I'm fortunate and lucky to have gotten to this position. So on Kickstarter, I think a lot of those people are as well. So I would say on Kickstarter, there's no specific numbers we look at, but if anything's below 500,000, I'd say below 10,000 purchases, it's not something that we'd pay attention to. It's more the purchases than the dollar amount.
Well, it's always hard to only talk to George for 45 minutes, but thanks
Ari,
a lot.
hold on.
Oh,
We have some questions from Twitter, so if you allow us.
Sure, is someone else asking them?
Actually,
Okay.
just one question from Ken Arnold on Twitter. George, please talk about down rounds.
Down rounds. Down rounds are not fun for anyone. And they usually start happening when the tide starts turning on the public market plus 6 months. So down rounds when down rounds happen in a positive up environment like now, it's usually a negative signal to the future investors. And usually employees find out about it and they're usually really bummed out. They think something's wrong. They definitely do happen, and they don't always mean it's the end of the company. In a down environment, down rounds become the norm. And you see the opposite effect of what you see right now, where people are raising up rounds, which means, oh, the last round was an up round, so the next round has to be an up round. In a down round scenario, the company has to raise, the founders tend to get more diluted significantly, so you have to create bigger option pools, new option pools to invest. Usually the founding investors get weary by that point. So down rounds are not the best thing, but they tend to happen. And you can't, as a founder, you can't say we will not have a down round because you don't control the market.
Are you seeing any signs that we're at or near top of this market?
I do not think we're at the end I don't think we're at a sudden collapse. I do think we have several more years to run in this bubble thing. What I look at is public market indices and how they're moving and the amount of net new highs in the advanced decline lines to get a sense of what's happening in the public market. Right now, the #1 scary factor for me is in 2001, I think, Warren Buffett says his #1 indicator for predicting the future performance of the stock market is to look at a ratio of the Wilshire 5000, or on the Fed publishes something called the Z1, which is all corporate equities and includes some liabilities, to look at that as a ratio to GDP or GNP. And in the last 45 years, other than 2000, we are at the highest point right now. So that doesn't mean it's going to end now, but it means we're entering territory that's definitely in the risky zone. But this could roll on for several more years. Everyone's playing the momentum game now.
Great. Well, thanks a lot to George. Enjoy the rest of the day.
Thanks.
Thank you.
Thanks, Ari.
Thank you.
Ari and George, thank you for great discussion. And please don't forget your marks, your SVOD marks. And now, George, actually, we cannot let you go away. Yeah, so please take seat at our judging table.
Put something in the mug?
Water. We will handle it in a second. Please step up to the stage, George Zachary, Salil Deshpante, Eric Ben-Hamou, and Carol Sand. I'm also asking every investor that we have with this blue ribbon, take seat on the front rows. And we're starting our SWOT pitches just in a few seconds. Travel nuts, please come forward to wait for us. Ron, please take microphone. We need one microphone on front. We are starting our famous SVOD pitch. We pre-selected 21 companies out of over 250, and we have almost 100 investors from Silicon Valley and few from international. We appreciate their help and their participation. So before we start pitches of our company, we're asking our investors, our judges, to make a very short introduction of themselves. Ron, please pass microphone around these 4 tables. And please, very short introduction.
My name is Dmitry Alamov. I'm a managing partner of Frontier Ventures.
Hi, I'm Alex Soroka. I'm head of Ukrainian Business Angels Network.
Hi, I'm Kyle Klink from Phoenix Venture Capital, global VC based in Bell here.
Hi, Nathan Lowe from Sunrise Securities in New York, angel investor in over 120 companies in Israel and in California, and very active angel investor still.
Gadi Nemirovsky, managing partner at Inspiration Ventures, a seed stage venture fund.
Running True Global Ventures, we are 32 proud partners that have done individual 350 angel investments in Asia, Europe, and the US, and looking forward to this.
Ken Arnold, Band of Angels and True Global Ventures.
Hi, Gene Smith with Suha Capital from Honolulu.
Michael Minkiewicz, VP of Technology Services at Luxoft, the global software house.
Hi, I'm Alex Lupachev of Singular Gov, a $10 billion plus New York-based fund of funds.
Oh, wow. Thank you. Hi, I'm Carol Sands, and I'm with the local angel group called the Angels Forum. For the record, we only invest in local Silicon Valley companies. So if you're from somewhere outside of Silicon Valley, I'm sorry, but you don't meet the first criteria for being in our investment pool. We're one of the original angel groups in the world, and we've been investing since 1997, and I'm thrilled to be here. I've been told that in the past, when I've been judging, that I'm the killer judge.
It's why we always like to have you on our panel.
Yeah, so I just want to take 2 seconds and say that for all these pitches, we're not here to hear how great your product is. We're here to hear how great your business is. And I need you to talk about the business rather than spending all your time telling me about how great your product is.
Hi, I'm Salil Deshpande, Bain Capital Ventures. We're the ventures group of Bain Capital. Big Bain Capital is very big. It's a lot of things: hedge funds, private equity, debt, Europe, Asia. We're the ventures group. We've got 7 managing directors in Boston, 2 here in Palo Alto. The Palo Alto office is new, and 1 in New York. And before Bain Capital Ventures, I was at another firm, Bay Partners, for 7 years. So I've invested about $125 million into 32 companies in the last 8.5 years. Oh, and I focus on software infrastructure. So app servers, NoSQL databases, performance management, those kinds of things, not really consumer.
Oh, I guess it's me. I'm George Zachary, for those of you who didn't see me earlier in the chat. A little bit about CRV. The firm's been around since 1970, but in the last 5 years, a little bit more than 5 years, we've had 7+ IPOs of $1 billion or more exit. And we just got ranked by CB Insights as one of the top 3 venture firms in the 5 of those IPOs. Actually, there's only 3 firms that have had 5 IPOs that were early stage in ventures: ourselves, Sequoia, and Union Square. And Union Square had all 5 of them. They came in on the first round, and Sequoia and ourselves came in 4 out of 5, where we were the original investors, and everyone else on the early stage is pretty far behind us. So we're working to improve our brand so more people know us.
My name is Eric Benamou, and I run Benamou Global Ventures. We're an early stage enterprise IT fund. We're in Palo Alto. We invest in companies that focus on enterprise IT almost exclusively. virtually all of our companies tend to be cross-border. In other words, they start somewhere else in the world and they end up in Silicon Valley, and we'd like to help them become global technology firms. And we're in the midst of finishing the fundraise for our second fund. We're a small fund, less than $100 million, and we tend to invest narrow and deep. All of our partners have built successful companies before, oftentimes 3, 4, 5 times. We probably together in a partnership took about a dozen companies public over the last 35 years. So our money is no greener than others, but what we do know how to do is how to build businesses. So this is our value add to entrepreneurs.
Thank you to our judges. Just last reminder, dear judges, please, you have these forms. Please put your name and name of the company and scores. We will use it to find our winner, but also it will help to give feedback to companies. And first time at SVOD, for our attendees, you also can judge. You have this great application, Bizabu. Actually, one of the finalists of our previous vote. Download it, install Bizabu, find SVOD 2004. You see agenda, bios of every judge and every company. But most important, you could go and put your scores for each company you see on the stage. Please do it. It will be very interesting to compare how good you as the investors. Okay, so now I'd like to welcome our first company. It's company Travel Nuts, upselling for hotel reservation. Please welcome Travel Nuts.
Everyone, my name is Federico, and I'm the co-founder and CEO of Travel Nuts. So in a nutshell, Travel Nuts brings a layer of e-commerce between hotels and their guests. Over the course of this presentation, I'd like to show you what made it possible for us to sign up over 2,000 hotels already over the course of the past 11 months, and how we're planning on rolling out to these people. So before us, hotels have been selling hotel rooms for money from their guests. Thanks to Travel Nuts, hotels are able to sell directly to their guests, not just the rooms, but also everything else guests need around their trip, therefore increasing the amount of revenue. So I'm going to illustrate the story of our first customer, actually, Bill, who runs a hotel in Santa Cruz, California. So since the advent of online travel agencies like Expedia, for example, Bill's hotel has been suffering in terms of revenues for 2 main reasons. Number one is that online travel agencies introduce price transparency. So everybody knows what other hotels are pricing their rooms around, and that drives the price down. And secondly, online travel agencies like Expedia charge a very large commission on the sale of the rooms. So for a room that's $100, if it's sold over the phone or on the hotel's website, it makes the hotel $100. But if it's sold over Expedia, it makes about $70 to $75. So the commission is a lot. So the way for Bill to recover from this situation is twofold. Number one, Bill needs to attract more direct guests that book directly through the hotel and not through intermediaries so that he doesn't have to spend that commission. And secondly, Bill needs to increase the amount of money that's spent on each reservation by every guest. So how can Bill do this? Let's see how we solve this problem. So we've learned that in Santa Cruz, everybody that travels spends just as much money on local attraction and activities as they do on lodging. This is actually true nationwide. So every year in the United States, $100 billion are sold in hotel rooms and $100 billion are sold in local attractions and activities. But where about 30 to 35% of all the room bookings in the US happen online today, and they're growing really fast, especially through mobile, only 6% of all the activities are sold online. So there's a really big gap and a really big opportunity. So let's see why that happens. If you look at the interfaces that hotels are using today to sell their rooms, they don't clearly entice people to book, and they're also not compatible with the sale of other things that are not rooms, because they're built on top of technology that's about 30 years old and that basically underlies the room booking process. These systems are called property management systems, and they basically allow the hotel managers to run the hotel across the whole spectrum of activities, including the room cleanings, etc. So let's see what we built here. We built a platform that sources, personalizes, delivers, and also automatically fulfills every extra that we offer. And then we built front-end solutions for the hotels to adopt as a service. This way, hotels don't have to lift a finger every time anything is sold on this platform, and they can just focus on their core business, and then they get a check at the end of the month from the revenue share by us. The first thing that we built, looking at the timeline of how people travel, is at the time of booking, is the booking engine. The booking engine that we built and is deployed on hotels' websites allow people to book not just the room, but everything they need around their trip. It's obviously mobile compatible, and achieved a conversion rate of 22%, which means that 1 out of 5 people that book a hotel room also book something else that we're offering. And that led to our first distribution channel where we were able to acquire 75 hotels to roll out to. But then we asked ourselves, how do we target everybody else that doesn't book through the hotel's booking engine on the hotel's website? And so whenever we went to Marriott or Hilton, we're all used to receiving an email about a week before we get there. It's an informational email that tells us stuff about check-in and check-out. And so we thought, what if we change the email from informational to transactional, and we actually allow people to buy stuff? And what we achieved with this, tracking the metrics of all the campaigns that we sent out, is that 60% of people open the email, 18% click through at least one of the offers that we put, and then 3% of people buy. Now, conversion rate on purchase of 3% on an email is quite high. And then at the end of one of the incubators program that we did at StartX at Stanford University, during the pitch that I did to the investor, actually there was a fellow sitting there that knew the president of a chain of hotels in the United States. And so she reached out to us, and I pitched the platform, and she decided to go for the app. And so that's the latest application that we've been building that we've been rolling out to 2,000 hotels. Now, the reasons why a chain is interested into the app, that's obviously mobile first, is that once people buy activities through the app, the chain is going to be able to cross-promote in the future, selling both rooms and activities for future stay of their current guests. So one thing that's interesting about this business model, if you look at what everybody else is doing in the competition for activities, for example, Viator and companies like that, is that they go directly to consumer. Therefore, they have to purchase the traffic and pay for the traffic that leads to their website for them to sell something. By going B2B first, partnering with the hotels, we actually get to free ride on their traffic. Therefore, the marginal cost of guest acquisition for us is 0. And in the profitability scheme of how we make money, this means a lot. Additionally, because Expedia and Orbitz and all the online travel agencies charge so much money in commission, there's no way that hotels are selling the bulk of their inventory through them. In fact, over 2/3 of all the bookings online actually happen directly through the hotel, and that's logical because no business would ever want to give up 25% of their top line through an intermediary. The business model of how we monetize with the activities is very well known and very well recognized. People have been dealing activities for a long time, and that's certainly not where we're innovating. The team met all at Stanford. I was at the business school until last year in June when I graduated, and Luca is also graduating this week. And Elliot was a computer science engineer at Stanford, graduated last year. Together we went through Tony Hsieh's incubation program in Vegas, then StartX, and we're now building this company together, helped by people that we purposely selected along 3 main lines. Number 1, people that operate hotels, so they know what it takes to sell to a hotel and who are the right people to talk to. Number 2, an executive that used to buy technology for big chains, because down the line, about 1.5 years, we're going to be starting to acquire, or we plan to start to acquire chains, obviously, to get more scale. And so Israel has led Intercontinental and Starwood in terms of that. And then the third dimension that we wanted to fill was somebody that scaled big companies quick. And that's how Mike has been helping us a lot. In terms of fundraising, I'm happy to announce today that as of yesterday, we reached our goal that was for $900,000. We have a lot of people that understand the industry and the space really well, including the former president of Hotels.com, and one of the people on the founding team of Travelocity. We did extend our note to 1.3 million because we have a lot of interest, but I'd love to talk to you guys. If anybody's interested, please email me at letterf@travelnuts.com. Thank you.
And now time for questions. Please, Any questions from the table?
Just questions?
Or comments, whatever.
I like it. And
You could also
like,
sign a check if you like.
Is this?
Oh,
what we give
yes,
them?
yes. Actually, good reminder. We have, they have it, virtual SVOD IPO, so please don't forget everyone have $300. You could invest in 1 or 3 companies, and companies that get most number of the SVOD dollars will have a special price. So don't forget to invest.
I just invested my McKinsey signing bonus in TravelNets.
Okay. Yeah, so Federico came across as credible and seems to know what he's doing, and he's found an interesting wedge. My only hesitation is that travel is hard, and all the companies I've looked at, travel, they all seem to have found a certain wedge, but it never works out for one reason or another. Of course, I didn't look at Airbnb, so the ones I haven't looked at have done well. One of my colleagues actually just 2 days ago in one of our team meetings made the joke that people coming out of business school, they focus on 3 categories: travel, e-commerce, or dating. And that's because those are the pains that they feel. You know, and I think the challenge with that is that a lot of people understand those areas, and a lot of people focus on that, and so it's hard to figure out whether you found something really, really unique. But I think based on your first presentation, I really feel like spending more time with you and sort of understanding how you work and what you've found.
Thank you.
Thank you, Khalil. Carol. Eric?
Yeah, my question is this. Most hotels at some point decide to build their own website and to build their own e-commerce layer and to sell some of the things that you talked about. So I'm not sure how differentiated your solution is compared to the sort of a self-grown website that does e-commerce on attractions and food and other things.
Yeah, thank you for the question. I'm sure people are familiar with the fact that sometimes you go to a hotel's website and a package is available where you can get the room and also other stuff. In that case, the hotel actually that has to deal with the fulfillment of what they're selling. So they might buy some tickets for an event and then give it to you through a package, or have a relationship in place with some provider. That's costly, and that's the reason why that hasn't happened very much in the industry, because hotels don't have the time and bandwidth to actually deal with the sourcing and fulfillment of that. The first thing that it interests hotel when we pitch our platform is the fact that everything that we sell is automatically fulfilled, because it's brought onto our platform through the utilization of APIs that have instant fulfillment capabilities. So this is the issue with hotels is that they haven't had the technical bandwidth and capability to actually implement something like that. This is actually, I believe, pretty true in situations where the market is really fragmented and people don't have a lot of technical expertise. And I think that this could be a space where a solution of enterprise software as a service that hotels can actually adopt might be a good way to go.
So what I gathered is that you're aggregating basically all these long tail of activities and the mid tail of activities.
Well, not necessarily just a long tail. See, at a first stage right now, we're integrating with verticals that have very successfully aggregated just what they're really good at. So I'll give you a few examples. There's a company called Mozio.com that just raised a nice seed round that has been doing a really good job at aggregating all the airport shuttles and transportation from the airport to the hotel. And so we go and talk to them. Viator obviously is really great at activities, and so for the activities we talk to them. Then somebody just built a really good aggregation system for secondhand tickets for live events and shows and sports games, Ticket Evolution, and so we go and work with them. So at a basic level, the sort of like mid-tail and long-tail is served, but we do actually prioritize for what the hotel has always been recommending. Because one thing that I didn't have the time to say is that the reason why OTAs like Orbitz and Expedia don't really sell that many activities is that if you book a hotel 2 stars or 5 stars in the same neighborhood in San Francisco, you can always offer the Fisherman Wharf tour. So there isn't a mapping between what the hotel usually recommends and the demographics of their guests. And so we always make sure that we sell those things that they recommend. Sometimes they're not part of an API, And that is one of the issues that we have, but we're building technology to allow them to invite them seamlessly onto
Got
the
it.
platform.
And how do you view TripAdvisor as a potential form of competition?
No, I think TripAdvisor is actually a terrific partner for us because just recently they've implemented the Trip Connect feature where people that search for hotels can actually go and book directly through the hotel system. And so this is actually an even better way for us to get that traffic that we then monetize.
But wouldn't they, if your business is so profitable, wouldn't they want to enter it or acquire you, is my guess?
Well, you know, obviously,
I guess you're open to that.
But this is something that OTAs have been doing for a long time. So Orbitz and Expedia have been selling activities. And actually, just recently, I don't know if you guys followed, Airbnb is also entering this space, which has been a really, really good validation. And I do agree with what you said earlier, that Airbnb is completely disrupting that market. But if we look at relative sizes right now, the hotel business still has about 1 billion room nights per year. It's difficult to see that in the near future hotels just will cease to exist. Thanks.
Question from the investor tables? Okay, no questions. Thank you to Travel Nuts.
Okay, thanks.
And just to remind, Travel Nuts company, Stanford company, sponsored by Phoenix Plus. And to our corporation, if you like to sponsor next SVOD companies, please let us know. We have great chairs of the companies who need your support to present at SVOD. Okay, so next presenter is Art Gorgi, Art Commission Marketplace. Please welcome Art Gorgi.
Art Corgi is the marketplace for illustrative commissions. For an average price of only $100 and with an average turnaround time of only 1 week, you can have an artist create anything your imagination can conceive. So how do we work? We list hundreds of styles on the website by many, many different artists. Here you see 4 styles. I decided I wanted to have a new Facebook avatar commissioned. So I sent a photo of me, chose one of the styles at a predetermined price point. Right here, it was $90. The artist sent me a sketch. I provided feedback. Then I had my new Facebook profile picture. Of course, I could have it print out however I wanted to as well, whether it be mugs or a wall piece. Now, you're probably thinking to yourself, art commissions? That's Renaissance stuff, man. What place does that play in this modern age of technology? And a year ago, I may have been right there beside you. But last summer, I proposed to my fiance and co-founder through a series of art commissions. And it went crazy viral. And it made me realize something, that today, because of technology, the art commission is more valuable than it has been at any point in human history. In the past, we represented ourselves to the world through the clothing we wore, and we spent a pretty penny doing it. But today, we represent ourselves to the world through images, through Facebook profiles, through Gmail avatars, through LinkedIn avatars. But Art Corgi's usefulness isn't limited to controlling our online identities. It makes the perfect gift. You know they don't have it. And it can be made deeply sentimental. This piece here was made by Neha for her parents' 30th anniversary. They didn't have any photos from her first date, but she was able to recreate it using an Art Corgi commission. Just this weekend, we had a very special piece commissioned. An Art Corgi piece was used in another marriage proposal. I can't think of a product for an equivalent price as ours that has an equivalent amount of meaning. So I urge everyone in here to think to yourself, is there someone in your life who would appreciate the gift of an art commission? And if so, go to artcorgi.com as soon as lunch rolls around. So now to the nitty-gritty, the business stuff. These are the companies that investors often compare us to. They hear art and they think, oh, they're like the other art companies. And truth, some of these companies are very close competitors. The closest competitor among them is probably 99 Designs. But 99 Designs, an equivalent piece would cost literally 10 times what it costs on Art Corgi. And they primarily target the corporate commissions market while we target consumer commissions. In truth, our real competitors are Tumblr and DeviantArt. Analogous to the situation when Airbnb launched, you could rent a room from a random person. You did it on Craigslist and it was sketchy as hell. Today, before we launched, when I did my proposal, I was able to find the artists on DeviantArt. I had to cold email over 300 artists just to get 16 yeses, and then I had to haggle over prices with them. It was a nightmare. So where are we today? We've done the rounds in the press from TechCrunch to VentureBeat. We've been through the Stanford Venture Studio, and we're now in 500 startups, and we have hundreds of artists in our network, and our customers love us. We have a 17% reorder rate, despite the fact that we've only been around for 5 months, and the majority of our orders have almost always come in the last month. And this growth thing, we're beginning to figure that out as well. We doubled our revenue last month. Whenever somebody buys an Art Corgi piece, and I think it is unique among products in this, is they put it on their Facebook wall and it becomes their most liked piece. And more often than not, they also make it their avatar and their cover photo. So who are we? I'm Malcolm Collins. I graduated from the Stanford Graduate School of Business just a week ago. And I have intimate knowledge of this industry because of the proposal. My fiance here is my co-founder. She left her position as director of marketing at HubPages, which was during her tenure the 45th most trafficked website in the US. And she's also regarded as an expert in online cultures and has been invited to speak at events like South by Southwest on the subject. We are currently raising a very small advisory round for people who are interested in being value-added investors. If you are interested in this round, I can probably squeeze you in, but I do need to hear from you from the next couple days. Next week, we'll be opening our seed round if you're interested in the larger game here. And that's us.
So are these cups from you guys?
They are not, though before I give more answers, I'd like to say that these answers are sponsored by Tech Ventures. Just saying, for SVOD.
No, the cups, it's a longer story than we have time to talk about here, but it gives you an example of what you could do through Art Corgi.
Okay.
So I'm going to attack the most obvious. Silicon Valley doesn't typically like to invest in husband and wife teams. So what have you put in place to make that easier for us to say yes?
They're not married yet, though.
You know, that's an interesting question, and I can tell you that today, Art Corgi would not exist if it wasn't a husband and wife team, because her emotional support has meant the world to me in the hard times. Before Art Corgi, we tried a company together that failed. And it was a very, very difficult experience, and we pitched at the last second, and then we immediately started taking off with Art Corgi. But, you know, when I think about it, if we were able to make it through failing together, I don't know,
Would you consider a third
founder? Oh, of course.
That would be a really good solution.
We actually have one who are sort of training.
I have a quick question. It looks like the average selling price of these items is about $200?
About $110 is the average price so far.
And how long and how much money does it take you to produce one of these things?
Oh, well, so...
Right, so we take a 20% cut currently of all of our sales. It's usually a 1-week turnaround on average, and it doesn't cost the artist typically anything aside from their time, because the vast majority of the pieces that we sell are 100% digital. So there are no materials that go into it. It's just what they're doing on their free time.
Yeah, but it does take time to produce this, and and the computers don't do this automatically. There needs to be a human touch,
Yes.
even if there is a sketch produced by.
Yeah, we're not an app that changes your photos into sketchy
Okay.
renderings.
So is it reasonable to assume that, in average, it would take less than an hour of an artist's time to produce one of these things?
It really depends on the style. Some of these pieces take less than 30 minutes to make. Some of them take days to make. And the price is a reflection of that. So when artists sign up with us, they tell us how many hours it takes to complete a piece, and also what their personal minimum price point would be. And then we adjust the price up from the minimum based on what we think it would be in a fair market.
Okay, so the price is set such that the artist makes money and you take a cut.
We take a 20%
Okay,
cut,
get
which
it.
is standard for Illustrator agents.
Good, thank you.
You know, so full disclosure, our firm invested in a company called Patreon, which competes with what you do.
Oh, we're fans of Patreon.
That's good. So the question is, how do you define art? Because Patreon made me think, you know, they have a similar model. So the question is, you know, what is art? Just so you just focus on print.
We're an illustrative commission marketplace.
Got it.
So Patreon focuses more on videos and music, at least in my experience. They could move into this space, but I think it would be a sort of a more difficult proposition for them given their background and their model of recurring pieces. Although we have tossed around the idea of a subscription model for some of our more fanatical customers.
Yeah, because the point I was trying to get to is not just giving you the disclosure that I'm an investor in Patreon, but sometimes when people start off in narrow categories, the cost of customer acquisition is really high because the frequency of purchase isn't really high. So what will you do to basically, I think you will have to expand your product line.
We do intend to over time, though I have to say with art commissions, it's a very different market from Patreon in that none of the pieces that we sell exist before someone approaches an artist and asks for them. And we're actually using people who are on Patreon, people who are YouTube stars mostly, to actually endorse and test our products. They're our go-to-market strategy with regard to marketing and endorsement-based marketing specifically. So we see the success of companies like Patreon, and even the success of other commissioning sites or art sites is helping us all. Here, you can expand on that if you want.
Okay, so our long-term goal is actually not to stay within the art space. We want to expand into adjacent marketplaces, but we want to master a vertical first. We don't believe that it is good for a company to go out targeting, for example, all online freelancers to begin with. And you know, that's why we think our last company had trouble, is we just targeted too broad of an audience. We need to start with a narrow vertical, master our strategy, and then expand.
Great, thank you.
Question from the investor table? Any questions? Thank you, Art Korgi. Thank you. And just short reminder to our judges, both in tables and on stage, please fill up this form. And our next company is Teamable, company sponsored by CRDF. And Teamable is visualize your talent and project pool, intelligently composed team. Please, yes, please welcome Teamable. Please switch.
How do you?
On the back, please switch. Okay.
At Teamable, we are obsessed with using technology, science, and data to put the right people on the right teams and the right projects. We thought the best place to start to do this was project-based organizations, so services organizations that are forming teams daily, and the team fit and the skills of the individuals really lead to success. But what we found was that team forming in enterprises, even project-based ones, is really manual. It involves a lot of sent emails, phone calls, et cetera, et cetera. It's based on, usually there's someone called a staffer or a resource manager who tries to put people on teams based on their memory of what that person's done in the past or what their skill sets are. And because it's involving people, it's very painful and slow. And on top of this, enterprises now are very distributed. There's dozens of offices in dozens of countries with people with different skills. So this is a visual of how the team forming process looks now. As you can see, it's a bunch of spreadsheets and you know, something like this is an org chart. How can you tell what someone knows by looking at that? Go ahead. All right, so we're gonna, okay, so hold on, I wanna introduce this. So at Teamable, we're obsessed with teams, and we're very competitive, and so we said, we're gonna accomplish this, and we're gonna do it in less than a minute, enable someone to form a perfect team. We don't have the video. All right, I'll narrate this. So what this is a manager's dashboard of all their talent and what they're working on. This is a project description. They're able to go into a search engine, search by skills, and our results are coming back, and there's a score for team fit. And in this case, we don't want to use an internal thing, so we're doing contractors instead. The adding to the team is a press of a button. That person has been added to the team now. Gavin Belson is flying over on his helicopter. He's got this email of, this is a good resource for you. He goes and checks them out. This is an internal resume of all the projects Felix has worked on. He sees that he's worked with Richard, and he confirms him. And that was with 6 seconds to spare. Okay, so. Did everyone follow that? Really? Cool. Okay, so what are our technological advantages? Well, by having the skill sets of projects and people, we're able to look at a business in terms of skill sets. So what that lets us do is we can see, okay, your people have these skill sets, your projects have these skill sets, they're trending in a certain direction. And by the way, because we're logging in with LinkedIn, we can also see what your people are saying are the important skill sets in the future, and we can identify gaps. Both and managers can either attack training or hiring new people. We have our team fit algorithm, which looks at things like past shared experience, common interests, and we can get into that probably in the questions. And then we've also developed an intelligent way to understand skills. So this is really cool. We analyzed, I'm blanking on the name of this, what's it called? Stack Overflow. And we analyzed their boards, and everyone has a tag for their skills. And so we're able to say, with probability, for every title, what skills go with that title. For every skill, what's the most likely next skill that's with that skill. And then eventually we'll be able to do natural language processing on project-related stuff. And then last, because talent conversations are painful, we've tried to take conversations out of the equation. So this is our team. This is the founding team. We actually have 6 more developers and data scientists. So it's 10 years of software development and algorithm design for the 4 co-founders. They also have advanced degrees in IT and math, and Hovanes is a PhD. I'm a Wharton grad, although don't worry, undergrad, and I've unlearned all my business school stuff by now. And we have offices here in Redwood City and Yerevan, Armenia. Quick show of hands, who knows where Armenia is on the map? More than usual. Okay, we're trying to put it, all right, good. So what's our business model? Well, we're trying to start by selling to the highly talented divisions within companies. So think software architects, tax consultants, and we charge a small amount for the employees that we're tracking their skills and preferences and projects, and then a larger amount for managers. And we have 2 paying customers now, and they think like this pricing is really low and a joke compared to the ROI that they're going to get, but we need to move quickly. So how'd I calculate the market? Well, I took that pricing, I halved it, I took LinkedIn's projection of how many skilled workers there are, and I said about 25% of them are project-based workers. So these are our initial verticals. These are all companies that are here, so if you want to get in on the trial, let me know. And what are our milestones so far? Well, We have 2 paying customers. This really, I want to talk about this one because this is really validating. It's a $1 billion Silicon Valley company that has all kinds of software and services to do what we do, but in a bad way. So from forms to data visualization, they tried, and they chose us at the end of the day through our proof of concept. And this is our first day that we really have, we're implementing with them, and we have a trial product, and we've built our team. So that's where we are. And if you're interested in any of this, you go to our links and log in. All right, give it to me.
Well, I keep starting, so just should someone else start? I don't want to set the tone every time.
Okay.
So my question is, do you use your own software to build your own teams for the company?
Absolutely, we use it. We use our, I mean, we're not project-based in terms of client-facing, so we don't need to do it. It's like, you know, sometimes the devs just work on the synonym engine, but we absolutely use this to manage our business. We have a backlog of 150 applicants in it. We have our contractors in there, and these are the links for anyone who wants to get in on that to do it. So we absolutely use it, and it gives us a big advantage when we're talking to customers because we understand it.
Do you have any IP?
Yes, we have a lot of, in terms of patents or IP. So we're going to move towards patents, but we have the team fit algorithm, which, do you want me to get into the details? Or, okay. And also that skill search prediction engine as well is pretty powerful.
So how do you deal, I've interviewed a lot of people in my life.
Okay.
And my biggest problem is that they state that they have skills. They say in the interview that they have skills.
Mm-hmm.
And as soon as you start the interview and you ask somewhat of a technical question, you're clear. They don't have the skills.
Yep, that's a great question.
How do you handle that?
That's a great question. So one thing I want to distinguish is these aren't applicants. These are people who have already been hired in a company, and they know that this is for putting them on project. It's not related to review or anything like that. So they have a disincentive to lie about their skills because then they're going to get put on a project with a skill that they don't have. And talking with our customers, we were thinking, even if they do lie and they're interested in, that means they're interested in that skill, like they'll get it done.
Okay.
A question from tables. Ron, please pass the microphone.
So based on my experience so far, I think building team is about the future skills and the chemistry of the team to be successful.
Mm-hmm.
And those are the 2 big things that I look at any team.
Mm-hmm.
But your whole application is based on the past.
I don't know if it's based on the past. I mean, we're pulling in LinkedIn skills, right? So that's kind of people's projection of what's important in the future. We're also looking at the experiences in the past do kind of drive as a prediction for the future, but it's more like who they've worked with. And if you've worked with someone in the past, you're likely to do better with them in the future.
So what kind of expertise do you have in dealing with enterprise adoption and sales?
Okay, me
sales and adoption.
Okay, so me personally,
the company.
Okay.
And you individually.
Well, right now we've been focused mostly on development. So the team is, you're looking at the sales team right now. So I sold this company. In a past life, I was an investment banker, and I convinced people to help, entrepreneurs that had built their businesses over 20 years to let me sell it from a no-name firm. So I have an understanding of the sales process, and we have angel advisors that have also built huge sales teams as well.
More questions?
What would have been helpful for me, I was trying to put this in a box the whole time you were talking. Is this like Cornerstone on demand or success factors or what? So I think what would have been helpful is to say, we're like them, but they do these 400 things and we only do these 3 things really well.
Yeah, so when we developed iteratively with interviewing customers and understanding what they need, we tried to stay out of boxes, really. And so we think we found a gap between 4 boxes, which would be, it's not a human resource system, it's not workforce planning because that's like a one-time software event. It's not social business because you're not using that to form teams. And it's, I'm blanking on the 4th one, but it's not really in a box. It's in a niche that's, you know, in between all those things, although they're all probably coming our way. Good?
Thank you.
Thanks.
Thank you, Trimable. And our next company. Our next company is Nedelba, Intuitive Business Intelligence for Financial Industry.
Hi, my name is Michael Medvinsky. Hello, my name is Michael Medvinsky. Our company provides financial business intelligence platform, and we offer it as SaaS. Financial industry facing several challenges. Tremendous amount of data, it's keep increasing, and the problem is when financial company collects this data, they need to be analyzed very fast, dynamically, on the fly, on the go, by different financial business users. Could be investors, could be traders, could be portfolio managers, and they would like to do it by themselves without help of IT department. Very often they're in situation when their business colleagues reach out to them, instead of giving them answer, they answer, I'll get back to you, because they don't have fast access to data. Before starting this company, I had a senior position in Goldman Sachs in technology. And very often during subprime crisis, traders used to call me, tell me, Michael, come immediately. We have a meeting in 2 hours. We need to change this report. We need to add this chart, delete a couple of columns, add a couple of lines, change labels, and in 2 hours. And they're saying, it takes us 2 months, maybe even more. And they're saying, Michael, you don't understand. We're meeting with investors, and it must be done very fast. And I was thinking, if Goldman Sachs, the best bank in the world, don't have solution, what happens with smaller companies, with 1,000 smaller companies? And we decided we create this platform that allow business users by themselves do things, what they want to do, anywhere in the world, on different devices, in their office or on mobile devices. And we created this platform. It's pretty complicated because we allow business users to support any assets. They can invest in stocks, in bonds, in airplanes, in hotels. We can process this data. We collect this data, and then some magic happens in the cloud. We have our proprietary technology. We can deliver very fast in encrypted format to different devices. Could be desktop, could be iPad, and business user can use it intuitively by themselves in any language, in any currency. We even have client, private equity firm that invest in wines. It means pretty much any asset we can support. And our clients across financial industry, it could be banks, could be family offices, could be hedge funds, and all of them need to have efficient tools that allow to them make a decision very fast. Because efficiency for them means competitive advantage and making more money and provide better services to their investors. I want to tell you about the size of the market. It's humongous. Global asset management had assets more than $63 trillion last year. And business intelligence, it's booming. Estimates it will double from 2012 to 2016 and will reach $143 billion. Our competitions comes from 2 streams. In-house systems that available only to big companies, because it takes a long time to develop it, and it's very complicated and risky process. And there are very good companies that develop products, but they're very generic, like SAP, Click, DOM, Burst, and they cannot be used as is for financial companies. And this is a big challenge for them. And we decided to combine these 2 things and deliver a product. And the reason why we were able to do it, we have very good technical and business expertise. I had senior positions in Goldman Sachs, UBS, GE Capital, and Priceline Waterhouse. And people who work in our company have similar financial expertise and technology expertise. Our clients come from different verticals of financial industry. We have clients in hedge fund industry, private equity, and we have a distribution channel. Our funding is bootstrap. It's completely self-financed. We're seeking round A. And our goal, if everything goes as planned, to achieve $35 million in annual revenue in 3 years. And ladies and gentlemen, I would be delighted to answer any of your questions. Thank you.
I have a question for you. Your former employer, Goldman Sachs, they actually own a lot of the data that they process for BI purposes. The data is in their own database. They have their own tools. You don't own this data, so you have to have access to third-party data. How much does it cost you to buy all this data? Because you're trying to be very, very comprehensive. You enumerated all the different asset classes I could imagine. So this must be costly. Do you pass these costs to your customers?
Very good question, but what we do, we offer a software product. We're similar in idea, not in a size, but the approach like a Microsoft. When you go to Microsoft, you buy Excel. You buy a product. You can put there any data. We have a similar approach. We come to you with a product that doesn't have data. And we ask a client, what is your pain point today? And client says, I want to see my positions, or I want to see some risk information. And we build a small adapter to their defined data. And adapters we can build very fast. We can have, for example, demo of client data almost overnight, because we have very specific mapping mechanism that allow us to do very fast. And another big benefit in financial company, if today they want something, that 2 hours from now they want something else. And with our tools, we're not saying to clients, you go live, you have only this and nothing else. We're saying if your need changes and you would like to see some documents or send investor reports or even have videos, we can handle all of this. And based on your needs, we just add in additional adapters.
What's the special advantage or specialization you have over people like Domo and other people in the space? I mean, can they build something like a style sheet, just to use a simple term, you know, or a simple adapter or a simple presentation system to do similar things as you do?
Gregory, I really love your question, and the reason why it's very good, we are talking right now to a very big financial institution, and they mentioned Domo to us, and they said they will not talk to Domo, but they're talking to us. And the big difference is Domo is generic. And what happens is, when financial company look at generic product, their first question is, how long it takes to develop graphic user interface? Because it looks simple, but it's an effort. And they don't want to spend time on it. And we're telling them, you can take our product as is, with no changes, almost immediately. And the only thing what is required, writing some adapters. And this is big difference between us, who companies that develop specific product for financial industry, and company like Domo, that is very good, but too generic.
Thank you.
Who is us?
Our company has 2 development centers in Eastern Europe, and there are people in US, but in US it's much smaller. But we have only one founder. I'm a founder of a company.
Do you have anybody else that works with you?
Yes, absolutely. There are some developers, as I mentioned, in Eastern Europe, and there are some developers, much smaller
So
team.
if something should happen to you, who would run the business?
There are several people. There are people who support sales. There are people who are responsible for development.
Who?
They're in US. You would like to know their names? I can provide you information if required.
Okay.
I would be delighted to do it.
I was trying to understand the product. Is this like Novus? Have you heard of Novus?
Yes, but it's different than Novus, because Novus also has some specific calculations. We are financial business intelligence. It's a pure financial intelligence, but very specific for needs of financial industry.
Dusan Stojanovic, I might have missed it. Do you have a beta customer or somebody that you are working with right now to develop the services in terms of customers?
We already have paying customers. We already have paying customers. In hedge fund clients, private equity clients, we have a distribution channel.
Can you name them?
We have specific NDA. I can provide you information. If you're interested, I would be delighted to do it. I just cannot say from a stage name of financial companies, because financial companies are very protective of their information. But as I mentioned, we have a private equity clients that invest in wines, and we have a hedge funds that invest in different kind of financial instruments.
Would you say that the primary value of your product is in kind of collection display of data these clients already have, or in an analysis of the data?
Collection, display, and the ability for users to do it dynamically by themselves on the fly without need of IT department. This is a big difference if you're in the airport and your client calling you and saying, today is a bad day in the market. What's going on? Instead of giving an answer, I get back to you, immediately on the fly, on the iPad, generate report, and send a mail to client in Japanese or Chinese.
Thank you.
So if I create a spontaneous analytic view, can I save that view and share it with others?
Absolutely.
Okay.
You not only can save it and share it with others, but for example, on mobile devices, you can share data. And if, for example, you're my investor, and you're saying, let's meet for a dinner in a restaurant. I come in for a dinner, there is no connectivity. The restaurant in a basement. On my iPad, I can pre-store all data, and it's not a can report. But if you're going to be asking me a question, how are we doing by sector, by industry, by particular class, I can dynamically on the fly keep generating reports for you.
So how do you vet the quality of data that's being misrepresented, is being represented? How do you vet the quality? Because what you're doing is writing software on the fly.
It clients data. It's similar what Microsoft does with Excel. It means we run it in adapter, we put in some validation rules, we're discussing with clients what validations they need, what data can get in the system, what data cannot get in the system. But in the end of the day, our product addition to client system, and it's based on their data and their needs. We're not a data company.
So one quick question, and I'll be quiet. Sales, what expertise do you have in the kind of enterprise, and I mean your whole team, in terms of enterprise terminal life cycle? You know, how they have awful sales life cycles. So what kind of expertise do you have in selling to large enterprise customers?
We work for large companies. I myself work for UBS, Goldman, and General Electric, one of the biggest companies in financial industry, and we know their needs. We know their pain points. We know what they're looking for when they sell a product. I used to buy a lot of products myself, and I know what's the life cycle, what is required, and what is important for them to have.
Okay. No more question? Thank you, Nedelma. And here we conclude our first panel. Please, our investors stay with us for as long as your schedule permit, and in a few minutes we continue our program. Thank you to all our investors.
So our next panel is building a startup from garage to Skype, but I can hardly speak because I cannot hear myself even if I'm speaking in the microphone. So there was a very small startup called Quick. That was a mobile-based live video sharing website and two-way video conferencing application that allowed users to stream live video from their cell phones to the internet. And as everything in the Silicon Valley, they started in a garage, and not only in Silicon Valley, in fact. So then Quick was acquired by Skype in 2011 for $100 million. And Quick video messaging technology has later been incorporated into Skype. So here, we're fortunate to have the CEO and co-founder of Quick and the investor, Almas Capital. So let me just say a couple of words. So Vijay Tella, the CEO, a computer science grad from India and UCLA, outstanding MS graduate of the School of Engineering, serial entrepreneur, was VP of Core Technology Group at Technicron, which was acquired by Reuters for $275 million in 1994. Then he was a founding SVP of engineering at Tipka Software. And Tipka went public in 1999 and was doing $300 million in annual revenues when he left in 2003. As Chief Strategy Officer, he helped launch and grow Oracle Fusion middleware platform, which was a $2.6 billion business for Oracle when Vijay left in 2008. What's amazing is that Vijay, with his wife, has been active in children's projects in India over the past 10 years, where he helped rebuild and expand several rural schools and 2 orphanages. After a couple of years getting caught up on life, Vijay is now on his 4th startup. Bhaskar Roy, co-founder and now Chief Product Officer at Playphone. Bhaskar brings more than 20 years of experience in building innovative products and taking them to market. Prior to Quick, he was a senior product developer for SMB products at Oracle, and while at Oracle, he also served as director of product management for unified communications products. And finally, our moderator, Daniel Stolerov, investment director of Almas Capital Partners. Daniel is responsible for bridging Almas partners and portfolio companies in Silicon Valley with Russia and former CIS countries. Daniel is a seasoned investment professional with over 10 years of experience in advising technology, media, and communication companies. Previously, he worked at Cohen & Company, Lehman Brothers, and Renaissance Capital. Prior to his work in banking, Daniel co-founded and served as a board member of iTour.ru, a Russia-based online travel company with operations in Russia and Ukraine. Daniel graduated from Finance Academy in Moscow and earned his MBA from Tuck School of Business at Dartmouth University. Welcome.
Thank you, Anna. Hello, everyone. I want to start our panel discussion by saying that what I find the most exciting part of venture capitalist line of work is seeing the marvel of birth. When an idea turns into a business, sometimes a big and successful business, and it happens because of the vision, because of adaptability and perseverance of its founders. Some kind of magic is happening in startups, and the only people that are there to see it are the founders. And the only way to find out what actually happened is to talk to them. So this is what we're doing today. I find Quick story particularly exciting because that team successfully navigated through a very turbulent period. Quick was born in 2006, which happened 2 years before Apple announced its iPhone, and with it brought the revolution that turned the mobile communication industry inside out created massive opportunities to a lot of businesses, but also rendered some of the other businesses weak and irrelevant. Next came the biggest financial crisis in decades, which resulted in a huge economic downturn, which Sequoia Capital famously dubbed "rest in peace, good times," and yet we have a company that persevered and succeeded. Quick was acquired by Skype in 2011, and as Anna said, the amazing technology that Quick developed even before smartphones came into our life are now part of the Skype product that all of us use. So with that, I would like to pass the baton to Vijay and Bhaskar here and ask them the first question, which is, what was the opportunity that you saw in 2006 and how Quick get started?
Okay, I'll start. Can you all hear me? You know, the way Quick got started was essentially myself and my co-founder Ramu and Nikolai, the third co-founder. We were just bored at Oracle. We wanted to build something which could reach mass consumers, and we realized that sitting at Oracle we just couldn't do it. And we were all in real-time video space. So we were building unified communications at Oracle itself. So we left and we went to Ramu's garage, the three of us, and started looking at various ideas. And what we found was, you know, Skype was still there. They were doing video calling. They had started using video chat. But what we found was that whatever the products were, they just wouldn't work well in wireless networks, which is inherently unreliable. You know, you get into a pocket and they would constantly drop. So we figured out and built a technology which could make things work across wireless networks. And so we started with a desktop video conferencing product out to beat Skype. That's how we started in a garage.
You mentioned mobile networks, and I assume you mean cellular networks.
No, when we started, we were just looking at Wi-Fi, wireless networks, or even people connecting their laptops with data cards, right? Because back in 2006, if you look at the smartphone market, it was nascent. You know, there was Nokia, Windows Mobile, and BlackBerry. BlackBerry didn't even have a camera at that point in time. So we were just looking at Nokia, Symbian-based devices and Windows Mobile.
Right.
So it was a nascent smartphone market. So we were looking at desktop as the key way to get, you know, people to communicate with each other through video.
So Vijay, let me ask you the next question. There's this three-person team working out of the garage, and you soon joined, first, as I understand, as an investor, as a seed investor, and then as a CEO. What did you see in that small team, and what did you see in the opportunity?
So, you know, it was all about the team, right? I knew Ramu from my high school days, and I knew Bhaskar and Nick from Oracle days. I have a tremendous amount of respect for them. So when I met with them, I saw this like really amazing video demo, right? But it was not the demo. It was, you know, all of them had these game faces on, sort of like when just before Peyton Manning goes out onto the field, like, you know, the look they have. That's the kind of look these folks had. And it was really a bet on the people. I felt that, like most startups, where they'll end up is probably going to be very different from what the idea they were showing. The idea was impressive, don't get me wrong. The quality was better than the Skype video chat at that time on the desktop. But what really got me on board was the people, and I think they were just dialed in, and I could see how serious they were, and I wanted to be part of that.
Mm-hmm. You fairly early on, the company made a pivot, and that pivot probably defined the ultimate success of the story. You pivoted towards a more mobile solution. What was the genesis of it, and how did that happen?
So it goes back to, you know, the technology premise that we're building on, that you know, all these video calling or video chat products on desktop would fail on wireless network. And the desktop video calling was becoming a complete red ocean, right? So there were just so many players coming in and trying to do video chat. So when we started looking at this, we said that, okay, what's the right use of the technology? Where is the blue ocean around this? And how can we take our company to that level? And mobile was it. Even though smartphone was nascent, we all strongly believed that one time smartphone will become the dominant thing. even though Nokia devices that we started with had a very small penetration in US, we realized that whether it be Nokia or someone else will come and disrupt that. And so we just moved towards mobile, which was a completely blue ocean at that point in time. There were carriers, some folks doing 3G video calling, but we took a completely different approach to it. And that's how we pivoted, saying that the technology is better used there. The problem is more acute on the mobile networks, because if you look at typical wireless network compared to mobile, mobile is inherently even more unreliable. So how can we make that even work there? And so we made that pivot, and it was a great pivot.
What was unique about Quick technology, and did you have any competitors at that time?
Well, the key thing about the Quick technology, even from early days, was to get the most of the bandwidth that you have at any given moment. So, even over public internet, at any given, as you're doing a call, the amount of bandwidth that's available goes up and down, not a lot. On mobile networks, it goes up and down a lot. It drops off altogether at times. So the technology that Quick built to adapt the streaming to the available bandwidth, so you're sampling the bandwidth available about 10 times a second, you're adjusting it up and down, so to give you the best possible live transmission, but seamlessly kind of stitch the bits that you drop during the live transmission back after the fact, so that users that are going to come in and look at the video after live don't get a replay of the live, but they get the full video. So this whole idea of adaptive streaming that is progressively stitched up together after the fact, that idea was so much more applicable to mobile networks. Obviously, they were very nascent. The 3G was just getting rolled out. Cameras were getting on the phones just then, a little bit on the high-end phones. And the compute power on the phones was still going up there. So the question for us was whether we can actually deliver a meaningful product, given the state of the industry at the time. We did a prototype on a high-end Nokia phone, and we were just blown away with what we could do. And we felt like if we could do it with that in 2007, down the line it was going to be on all phones and much better. So we just thought we'd be in a good place to kind of ride the technology convergence that was happening between 3G, camera phones, GPS, all these things that were getting onto phones.
This was a very exciting time for the mobile communications industry. Nascent 3G networks, still no Apple visible on the horizon, although coming very soon. Nokia at the helm of a sort of smartphone revolution. But those were the days before app stores came to our life. And yet you had a program that worked on smartphones. In the days before app stores, how did you go about distributing your product?
Oh, that's a great question. So there are two components to it. One is building it out so that people who are experiencing this, or when we distribute this, they can easily download it and it comes straight to your phone. So we built out a mechanism whereby we can send a link to anyone, they can click that link, and the application would automatically install on it. So that was one of the key parts that we solved in order to get through the distribution hurdle. The other thing, as we went into doing live streaming from the phone, a big part of our user base, I think I believe in our initial couple of hundred users, 100 users were bloggers. And what they were doing is taking the camera phone and just broadcasting or looking at, capturing everything, interviewing people, and massively distributing to their entire audience. And so that helped us, because anytime they would distribute or do a video and people would watch that video, we would have a simple call to action saying that, hey, you want to do the same? Download the app. And so with one click, they would be able to get it on their phone themselves. So we created this entire distribution, which is all around content creation and being able to get people to just distribute massively. And that helped us get to this kind of distribution and build that entire distribution ecosystem in order to get consumers coming in, downloading the app, and experiencing the product.
I think Robert Scoble was our 50th user. We're talking about bloggers.
Right.
And I think he went to South by Southwest and started live blogging the whole event. And I think it was just created a bit of a riot in the in that crowd that follows South by Southwest. And I think that just changed the trajectory. There were a lot of other bloggers, but there were some moments where it definitely took an uptake. And we were overwhelmed. I mean, we were, I don't think, ready internally to deal with the volume that came through. So it was.
In fact, it was very interesting how the sequence of events happened. If I remember correctly, it was around December 17th when Scoble first somehow means we were doing a private alpha, but he somehow was able, got the app on his phone and started broadcasting. And we were like, oh my God, we are not ready for this. So, but then late night, we got together and we said, what do we do? How can we ask him to just scale back, not do it because our servers are not ready yet? But then we internally discussing that, you know what, maybe we just launched. Let's just go with it. So we running to Fry's, all possible places, picked up hardware. Ramu was running around, putting it in data center. I was looking to figure out, how we can get users to come in more, how can we get the distribution built out. And it was those period of crunch time during this 1 week period where we went from just being something which someone was using on an alpha basis to actually where thousands and thousands of users were using it and viewing those videos. And interestingly, that progression followed because after that, Scoble announced saying that I'm going to take it to CES first week of Jan. And we were like, okay, we know what we need to do because we don't want the video quality to be poor. So let's make sure that we get to, at that point in time, 640 by 480 VGA quality, before we hit CES. So that drove us to, in order to continuously push in order to get to that. And once CES happened, then it was World Economic Forum. So Scoble and others announced, hey, we are taking this to World Economic Forum. We said, okay, we know what we need to do in order to get to that before February. So there were all these sequence of events, which actually were great because it pushed us in order to get to that level of quality and that level of reliability so that all these great events can, be broadcasted using Quick.
Amazing. It's, I guess it is much harder these days to get noticed if you have an app for an iPhone or a smartphone, and you get buried in the thousands of apps, that are in the App Store. Those are different days. Let me take a sidetrack here and. When did you raise your first side fund, side money? When did you go to investors? When did you start talking to VCs?
Sure.
At what point did you decide to do that?
So I think it was, we started in June 2006 and we closed our first angel round in which Vijay was one of the participants in March. So the first 6 to 9 months, we were just tinkered, in the sense, just focused on getting the product built out. And this was desktop video at that time. And once we had a prototype, that's when we, showed to Vijay, showed to 2 other investors, and we raised around $900,000 with 3
it was
investors.
interesting. They, after spending about 600,000 of it, we had this interesting meeting where it said, this desktop stuff, it's great, but I don't know how we're going to unseat Skype from this, right? So we're going to go mobile. We don't know anything about it, and so it was an interesting call to make at that time too. But we were all aligned. We felt that strategically that was a better fit. There were a lot of open questions,
So did you get investor support at that time to do that
Yeah.
pivot? Did it take much convincing?
It actually didn't, mainly because, of the 3 investors, the 2 investors were very, very engaged, right? For example, Vijay, even though he was an investor, he's a founder to me, right? So was Kanth, means they're founders. They were actually with us. And as we were building things, they were with us, guiding us, providing us the wisdom and helping us through this process. So when we decided, or when we started figuring out, okay, desktop is too crowded, it's how do we maneuver to a market segment which is much more blue ocean so that we can target that and, really build our name around it. They were already on board with that. So it didn't take much convincing. It required more effort on our side to be able to, do the proper due diligence before we move to that space. But I don't know. I didn't feel that, it was a challenge trying to convince investors.
And then you went on after you made the pivot, and you made a couple more rounds of financing before, over the next couple of years or so. How did you go about choosing investors? What are the qualities that you're looking for when you talk to VCs?
So we went through a couple of individual rounds of investment. So after us, We did another round, a little bit larger round with people like Mark Benioff, Mark Andreessen, and Ben Horowitz, and a few other people as individuals, not from their funds. It was not an institutional round. That helped us scale the demand that we were seeing and grow. So it was, and the way we kind of, with those investors, it was really these folks have built some serious businesses. They understand how to scale. They had good, I think they had good advice, best practices. It was pretty easy to go with them, right? We did 2 VC rounds. We ended up doing 2 VC rounds. The first one, it was really, we did it at the sort of the depth of the financial crisis. We had the impeccable timing of going to raise our round in October 2008, about 2 weeks after the Shearson collapse. It took us, 3 sets of term sheets and 8 months and a lot of pain to get funded. And it was really, Quest Venture Partners. Marcus is here, Marcus Fukawa. He was brave enough to, sort of go against the grain. A lot of the VC industry was pretty well shut down at that time. We were pre-revenue. We had a lot of momentum with users. We had partners like Nokia, but we were pre-revenue. So there, it was not like what are the criteria for selecting. It was really, who was brave enough and contrary enough to come on board and help us get there. And Marcus did that. Marcus and Quest did that for us at that time. And so we closed that round in 2009, in May, June 2009. So we had about 150,000 users at that time. So the second VC round we did, which is when we met Almaz, was about a year later. And by that time, we had about 5 to 6 million users. We had a great year. We had good traction with with users. We had almost all the handset OEMs and many of the major carriers. From a revenue point of view, we were getting pretty close to break even. So within about 12 to 14 months, I think we came out of the financial crisis very much hardened and determined and super focused. So I think that was just a great year and a half of solid execution on all fronts. And when we got to, we wanted to raise a fund to kind of accelerate that. We had a number of VCs that were interested in at that time. We had quite a number of people that were keen to participate in that round. There, I think for us, we looked, the selection criteria came into play that you're asking about. So the number one thing we felt was this whole mobile, consumer mobile video space is very dynamic. The technologies are changing, the customer behaviors are changing. The market is so dynamic that the investors need to have the stomach to be able to ride up and down. It's going to be a roller coaster. We've been through the roller coaster. We needed to have people that were not looking for a very clear 12-month plan or 18-month plan that we're going to stick to, right? And we're going to check ourselves each month on how we are progressing against the 12-month plan. But people that understood that there is just a lot of variability and we will need to be able to handle that. So that was one criteria. The second criteria were people around the board who can be smart and ask us really good questions and hold us accountable to what we were doing. And there were intangibles, right? Ultimately, we went with Almaz. I think one of the big factors was 2/3 of our team was in Moscow. Almost all of our engineering was in Moscow. One of our founders was based in Moscow. It was a very important part of who we were. And we loved Almaz's sort of focus on, Moscow and Silicon Valley and being able to bring those things together. I think in the end, all of those factors and intangibles led us to working with Almaz, and we had just a terrific partnership.
Excellent. Well, this is a good segue into the topic of running and having distributed teams, which is quite common these days as the hunt for talent is getting even more challenging, especially if you're limited by the geography. So you had a team in Moscow, you had a team here. What were the challenges that you were facing? What are the things that worked out? What are the things that didn't work out? Any advice to people who are building teams like that in their own companies these days?
Yeah, so the challenges are something that I think anyone who has worked with distributed teams would know. is just communication and being on the same page pretty much all the time, right? Because we could be seeing something differently, the Moscow team would be seeing something differently, but we just have to be aligned as to what we are building and how we go about that. So I think it just came down to just late night calls, early morning calls, working really hard, making sure that there's a good 4-hour overlap, 4 to 6 hour overlap between us. That was one thing. Every 6 weeks, being in the great city of Moscow and Zelenograd, so we made sure that we traveled back and forth. And, it was, it's another thing which goes back to intangibles is, we were really great friends, Nikolai and all of us. So when we would actually travel, we would never stay in hotels. We would stay in Nikolai's house. When Nikolai would travel, Nikolai, Alex, and the team would travel, they would actually come and stay with us. And a lot of times, it was the week or 2 weeks when they would be here, we would be just telling our wives saying that, okay, take a vacation, right? Because the next couple of weeks, we are just going to be in the house and doing a whole bunch of stuff together. And in fact, a lot of interesting ideas came out from, I would say, from Nick's kitchen in Moscow. And so it is just constantly communicating, over-communicating, which I think helped us in the long run. But, it is one of those things where, we really felt that over-communication was so much desired, just to keep the team aligned.
And the other part of it is having one of your founders be based in Moscow, and who has got such a great reputation locally was very helpful. So he built a very strong group of senior leaders out there that even as we were going through a lot of difficult times here, they were pretty well insulated in terms of the work they needed to do, right? We kind of localized whatever actions we had to take to cut expenses and all that. We tried to localize that to Silicon Valley because it's kind of hard to manage morale 6,000 miles away. But we had a great team that could just keep marching ahead even as we were trying to figure things out here.
So you think that
it was an advantage? What I'm saying, it was actually, in that instance, it was an advantage to us that they were not here, just getting caught up in all the stuff that was going on in 2008 and 9.
Right. So you think it helped you that one of the founders was actually in that geography where the team was?
Absolutely, no doubt about it. Because we built that entire team around Nikolai. He was very well respected in the video space. And so he just put together teams and people who he had worked with before together. And often, jokingly, we used to call our Moscow office our doctor's office, mainly because there were just so many PhDs, just cranking on this, working out the best possible technology, the algorithms that's just going to build us towards this great success. So, yeah, it was a huge advantage.
How big did your team get? How many people did you have?
So I think at the time of the acquisition, we had about 60 people, about 40 to 45 were in Moscow, and the rest were here. So all of the engineering team was in Moscow.
Good. Well, after Quick became a success, no doubt it brought competition. How did you stay ahead of competition?
So I think competition was interesting. There was not this. So we pivoted like at least 2 times. From desktop to mobile live video, from mobile live video to really much more of a personal and social video sharing, sort of like Instagram for video, right? And then we added two-way communications and all that. So the product changed quite a lot over the period, and the competition was very different. So there are companies that maybe you don't know now, but in those days, there's a company called Kite and a company called Flixwagon that were competitors in this live broadcasting space. So when we went into the social video sharing, companies like Ustream and Justin TV were seen as alternatives, though they were focused on a more broadcast model, and we were like going towards more of a personal use case. And when we added video chat, Skype and Tango were probably seen as the biggest competitors. So the competitive landscape kept changing. We were really not focused on that. We were focused on what we were hearing from the users on what's going to be compelling to them.
How did the dialogue with Skype begin? How did you get on the company's radar screen, and sort of what prompted
Right.
what ignited the discussion initially?
Yeah, so I think the initial discussion was very much around partnership. As we went into the details, as they looked at what we were doing and our roadmap, and we looked at what they were looking at, our ambitions were the same. They were coming from a video chat, and they wanted to become more like us. And we coveted the community they have, like 800 million users. So it became pretty clear that it was either going to be, we're going to be very aligned together, or we're going to compete. So there wasn't a lot of middle ground in terms of a partnership. But it started out as a partnership discussion.
What kind of partnership would that conceivably be? Were you thinking
it would have been,
technology, or?
It would have been a technology partnership. So their vision was to, Skype always was very strong with video chat, video. They've had that since 2005. They have not really done much in the social video communications area. So that requires asynchronous video messaging, asynchronous video communications technology that we were strong in. So it would have been a technology partnership where they would take our asynchronous video communications technology, add that to Skype product, and essentially the Skype product would look like the Quick product with video chat, video sharing, live communications, and all of that. And that was the partnership would have been a technology partnership.
And from that stage, how did it progress into the acquisition talk? Was that fast? Did it happen over time? What was the sequence there?
Well, I think there was we had a discussion, and there was 2 months of silence, which there were a lot of things going on for us at that time. We had this fantastic rollouts with Sprint and T-Mobile and Verizon. We were on national TV, like the Giants were playing baseball game. Every third ad was this quick ad, like from end to end from Skype. So we were like a lot of, we were experiencing tremendous growth. So we kind of forgot about it. And 2 weeks before, but actually a week before Christmas, they contacted us saying they would like to, Tony Page, the CEO at the time, wanted to meet and talk about options. And that's how it started. Then it was clear that they were, leaving the meeting a couple of months earlier, we felt that it was either, it was really not much of a partnership opportunity, because of, doing a technology partnership is enabling a big competitor with all of our capabilities. That doesn't make sense, right? So we were not surprised that if they did come back with, we were expecting that to be more of an acquisition discussion.
So what do you think actually turned them on, in the sense that from sort of the initial discussions, the technology partnership, what made them make the move eventually?
So I think
were they seeing you as a competitor at that time, or?
Yeah, so there's a couple of things going on, and I'll let Bhaskar add to that. They were on the product side, their ambitions to sort of transform Skype from like a video chat application to something that was much more social and engaging. That it fit exactly with what we had. So there was a good product fit. Back in the year before the acquisition, we pretty much won all the major handset video communications deals, with Nokia, Motorola, Samsung, LG, pretty much everybody out there. And also with all the major carriers. It started with Sprint and T-Mobile. It went to, AT&T, Verizon, and Docomo, and all these other guys. So we were winning pretty much all the major deals in the handset and the carrier space. And that's something that, and a lot of times Skype was the competition there. And I think so they loved the traction that we were having with partners. And I think that was, there was both a product driver and I think partnership and a BD kind of a driver to the deal.
Was Skype on mobile at that time? Did they have a mobile
yes, they
solution?
had a very popular, the Skype, the iPhone and Android apps were out, and they were pretty heavily used. So yeah, they had a solid.
Yeah, but one of the other things that they saw from a tech standpoint is, Skype inherently, at that point in time, was a full peer-to-peer technology, right, as to how it works. And that premise doesn't really work on mobile, right? Because you're constantly hitting the battery and the radio network, right? Peer-to-peer, you're pinging all your peers all the time. So they realized that, and at that point in time, anyone using the Skype apps on their phone, their battery would die instantly, right? Or in a short period of time. So they realized that, they needed to make a technology shift, which is more towards mobile. And we were mobile only, right? We didn't have a desktop product. We were built around the fact that how can we conserve battery life? How can we make sure that we are utilizing CPU correctly? So there was another fit whereby even they had the mobile products, they realized that, this was the right architecture, this was the right way to build it out. And that was another advantage that they saw.
That's a key point. I think they, so we talked about asynchronous, they had synchronous peer-to-peer, we had asynchronous technology, but also we had video chat, which was synchronous stuff, which was server-assisted. So augmenting their peer-to-peer architecture with more server-assisted communications, both even for real-time communications. They needed to go in this direction to become a bigger player in mobile. And that's, post-acquisition, that's really been the focus of the technology integration from.
For a smaller company, having an acquirer around can be a very distracting process. Sometimes the deal just falls through, right. And yet it takes a lot of time away from running the business. Right. How long did this process last until you were actually
not very long.
Them?
We've done other startups before, and we're totally aware of the distraction, not just when it happens, but if you actually start thinking about acquisitions even before it happens, as I've seen with a lot of companies. It's so we had a couple of other acquisition offers, not formal term sheets, but offers from two other companies in the year before, year and a half before Skype came up.
Were they solicited, or did
no? They
approached
us. Okay. Right? They were both players in the valley. So we made a very quick determination within the day. We just consulted with our board and made a very quick determination that it didn't make sense and moved on. And when Skype happened, about it's a week. It was just a week before Christmas. We both wanted to get this done quickly. Everybody wants that. But we set a target for Consumer Electronics Show, which was June 5th of 2011, and said, look, we want to get this done in this time frame. We don't have time to have this drag on. So we had set some pretty hard limits. So Skype and Silver Lake, which was running the process for Skype, and us worked through Christmas and New Year and just got there just the night before CES. We were very hard set and determined about the timeline. There was so much else going on for us that we couldn't afford to have this thing drag on. And so during those 3 weeks, we were open and totally, we supported them with everything they wanted, but we just needed that to march along. And to their credit and our team, I think everybody worked through the holidays and got there. Yeah, I think acquisitions can be a distraction. People start thinking about acquisitions too soon, and when they come up, it just totally, I've seen it sort of take people's eyes off the ball. Right. So this was, and we were not really looking to be acquired. So when this came up, we agreed that it made sense strategically, but if we do it quickly. Right?
Well, most exits for venture capitalists these days in technology happen through strategic acquisitions. So it's a common situation for a lot of startups to eventually find themselves in discussion with a buyer or multiple buyers. Skype was your third, Quick was your third startup at that time, and you had previous exits. What would be your advice to entrepreneurs in the audience who find themselves either, under the microscope of an acquirer? What are the do's and what are the don'ts if you have an acquirer?
So I think the first thing is that I think as a small team, you've got to be completely focused on the product, your customer, business model, and making that real. Anything else is a distraction. I think that's where the value comes from. I've been in the last couple of years involved with a number of companies. I've seen in cases where when there's an acquisition interest takes risk, it just disrupts the whole team. So my recommendation would be to just not really think about acquisitions, worry about acquisitions. Now, this advice doesn't hold for certain types of entrepreneurs. There are people that have sold 2 companies to Cisco already, and they're doing a 3rd company in some networking technology that they feel could be, they're building it for acquisition by somebody. So there's not a single rule. But for most entrepreneurs, you're not building for acquisition. You're building a real business. And if acquisition interests come, you deal with it very quickly and then move on either way, right? Not get distracted by it before, during, or after. Yeah.
And just to add to that, the other thing that, as Vijay was talking, came to mind is another thing that helped in our case was our engineering was in Moscow, and product development and moving that forward was all over there happening in Zelenograd. So we still kept that cadence whereby we were just not distracted on the product side. So as acquisition talks would happen, whatever was happening, it's not that we took a pause and all of a sudden we are thinking as to what we do. We said that, no, we are out to do this. And we kept building our product based on what we are seeing, the market evolve and how users were using it. And even through this entire 3-week period of Skype, we just didn't take a pause. We were just constantly delivering during that period of time. So I think that helped quite a bit, right? Because there was this entire team of engineers who were just cranking, even though there was acquisition talks happening in the Silicon Valley office.
I mean, we did a major product release on iPhone a week after the acquisition. It didn't slow us down.
And that's an interesting topic too. The fact that you had a distributed team and a large part of your organization was actually not here, not even in the same country as the acquirer, was that ever a factor? Was that ever something that they, considered or doubted?
No, I think they actually liked it, mainly because if you look at Skype's origin, they are in Estonia. They are an Eastern European company. Right. And the fact that we had such a big team in Russia, it's like a couple of hours from Estonia, was a positive. Skype also has a number of offices in Europe, all over, right? If you look at Stockholm, Prague, all these places, easily accessible from Russia. So they saw this as a big positive, that a big part of engineering is in Russia.
And when the Skype and Silver Lake team went to our offices and met the team there, they were just blown away by the depth. I think it's very hard to assemble a team of that caliber in the Valley for a company our size. So I think when you have this kind of accelerated due diligence, there are some things that stick out. And for them, the thing that stuck out for them was the depth and the strength of the team we had. So I think in that instance it was definitely a positive.
And did you join Skype after the acquisition? Did you spend time with them?
Yeah, I was there for about 8 or 9 months to complete the transition, and then and left. Yeah.
So what was the life after that? What
life after Skype?
Life after Skype. What?
Took a lot of vacations. Spent a lot of time with family, getting to know my kids again. I'd forgotten, or they had forgotten me. So there were all these things that we did. But then, it was, we were just joking about it. After a few months, you just start itching to go back to work. And so after Skype, I joined the startup called Playphone that I'm at now, leading products there. And we are doing something very interesting on the mobile gaming space, building out a platform. So after a few months, just had to get back and start working in a small company.
I was able to hold on a bit longer. So whenever I had this urge, to I was working with a number of startups, but it didn't feel like, at the end of the day, it didn't accomplish much. So whenever I felt that urge, I went for a long bike ride and let the urge pass. That held up for like a year. I was really took a couple of years off, and then. A few months ago, late last fall, I got together with some really great people I'd worked with in the past, and I've been working on a new project, and we're excited about a company called Workato.
A lot has changed in the mobile apps world. It got crowded. The whole ecosystems got disrupted. Carriers are no longer a major force in the economics of it. Some call them dumb pipes. We've seen some amazing deals in the messaging world, some huge valuations and acquisitions. what are your thoughts on the sector? Is there anything left to do? What
You know, when we started Quick, we thought that messaging was done already, right? At that point in time. So that's why we went video.
Yep.
But what has happened is with all the proliferation of smartphone messaging is, I believe there are still a lot of opportunities there. You can see today, even the likes of WhatsApp and others who provide the basic messaging capabilities, there are contextual communications, right? That are focused on certain types of communication, the likes of whether it be secret, whether it be anonymous communication. There are just different variations as to how people want to communicate with their friends, with their close family, with their kids. And I still think there is a whole bunch of innovation to be done there as to how to really focus in those areas and build out a product that suits a very specific segment.
Yeah, no, I think there's definitely, I do feel there's a lot of opportunity left. I mean, just, some of the companies, I've been involved with and I'm excited about, there's, people, working on this, some contextual communication networks like high school kind of networks. There is anticipatory computing and communications around getting context for you and, helping you be smarter in your communications. And there's, moderated, kind of things and safe communications for kids. I see some really, really interesting ideas that, problems that, that haven't been solved or opportunities that are there right now that I think we're just seeing, I think, the start of that. Like Bhaskar said, back in 2008, we thought this whole messaging and networking was played out. Facebook and all these guys have already done it, and there's no need to worry about that. But we were, obviously we were wrong.
Thank you, Vijay. Thank you, Bhaskar. I want to give a chance to people in the audience to and ask their questions.
Daniel, we don't really, I'm sorry, we don't have time for questions, but I hope you're staying for lunch. So if our attendees have any questions, then please find our speakers, share lunch with them and ask your questions. And now it's time for lunch, so we would like to invite you all to share the meal. Thank you.
Lunch is important.
All right. Testing.
One, one, two, three. Okay, I would like to ask everyone to take their seats. We're getting ready to start. I hope you had a good lunch and a good opportunity to talk to each other. Just a couple of reminders. Don't forget to invest your SVOD dollars in the company of your liking. Don't forget to play the game where you fill out the business canvas form and place it against the company name. And now, back to the conference.
It's always fun to get everybody who has full stomachs. We'll try and keep this going. My name is Robert Langer. I am a partner with a law firm called K&L Gates. We're one of the sponsors. We've been sponsoring this for the last 3 years, at least 3 years. We love this gathering. I think it's a great group of people, and I think the speeches are great. I'm going to just say 2 sentences about K&L Gates, and then I'll get to the much more important part, which is to introduce the next speaker. We are a law firm. What we focus on, as you can imagine being here, is on the venture capital world. We work on both the venture capital fund side, the investor side, as well as on the company side, startups through later stage companies. My partner is here. His name is Lars Johansson. I hope you get a chance to meet him. He's based on the West Coast. So I hope to get a chance to meet all of you while we're here. So let me get you to the next most important part, which is our speaker. Our next speaker is Ed Kozel. And Ed, and I'm reading from this, I'd love to tell you we grew up together, but Ed is described in your program as a technology visionary and Silicon Valley veteran. As you get to read his bio, you'll realize that that is absolutely true. Ed currently serves as the CEO of Range Networks, a San Francisco-based leading developer of open source mobile infrastructure. Previously, Ed was a Chief Technology and Innovation Officer with Deutsche Telekom. Before that, he spent 12 years at Cisco Systems, where he served as the CTO, Senior Vice President of Business Development, and as a board member. In addition, he has served on a number of public and private boards, including Cisco Systems, Yahoo, Reuters, Red Hat Software, and TIBCO, or TIBCO. Ed studied electrical engineering and computer science at UC Davis and worked at SRI International during the 1980s, developing distributed database and other applications on early packet radio and internet infrastructure. Today, Ed's going to share his vision and passion for the future of mobile networks transformed by the power of the software-defined mobile infrastructure and the open source systems. So let's join me in welcoming Ed to the stage.
Robert, thank you very much. All right. Well, I've never been to a conference before where I felt I needed to explain my name. But since this is an Eastern European audience, and I'm sure many of you know what Kozel means, let me ask you, how many of you have ever had the pleasure of enjoying Kozel beer? Any of you? A few people here, okay. Kozel beer is one of the leading brands in the Czech Republic, and my grandparents were Czech. They came to America about 100 years ago. But I have been back to the Czech Republic many times, and we have quite a bit of Kozel beer and assorted other products in our household. If you've ever seen, the beer is great, but the advertisements are even better, because it has, basically, there is a goat, and the goat is always surrounded by beautiful women, and there's always a large krug, a large beer container in front of the goat, and everybody is having a great time. I choose to interpret my last name as stubborn. Well, virile is always acceptable, but stubborn is maybe a better interpretation. I want to thank Stas and Anna for the chance to be here today. Stas and I have been friends for a long time. I think it's 15 years now. And during that time, I've always known him to be very passionate, very extremely skillful, and extremely focused. And I think that passion and that focus is apparent in the 10-year anniversary of this conference and in the growth of it. You know, Stas, my first thought in driving in today was you need more parking. So you should think about that going forward. My passion has always been communications, and Robert alluded to that as I was the good fortune to stumble into SRI at a time when they were working on finishing up the ARPANET and then just about to move into what we now call the internet. And it's sort of with that I wanted to make some observations today, because although we live in an age of apps and we live in, in a wonderful world of cloud and applications, all of those markets, all of your businesses, a lot of your success is totally dependent on a viable communications network of some kind. And you take advantage today of the internet in many ways, in some ways I'm going to talk about. But I think that when we look to the future, in particular when we look towards the Internet of Things, M2M and whatnot, we need to make some serious changes. In those serious changes, there is serious opportunity, and this is certainly a conference about opportunity, and I'd want to touch on that. So, I think we all would agree that the future is a wireless future, right? We live in a mobile-first world. We're all very happy with that. But what I want to point out to you when you think about your future businesses is that wireless, there's a huge difference between a wireless future and today's mobile networks. Because today's mobile networks will not survive in the fashion that they're built today. They will not do the job that you need to do if you're building a business predicated on the Internet of Things, or you're building a business predicated on broad new audiences that are not yet connected with mobile broadband or services like that. So, yes, it's true, I'm old enough that I remember IBM, SNA, DECnet. I've used them all, and of course, most of you probably don't even know that Apple used to have a protocol called AppleTalk. These were protocols that were defined by large companies. The standard was entirely controlled by large companies. They built a perfectly good working network as they saw it should be built, typically for their products. IBM felt, why do you need more networks as long as all the mainframes are connected, right? DEC said the same thing about mini computers. Well, we all know Apple is not exactly broad-minded beyond their own products. So the internet came along, and we all know the story of the internet, but I think it's been here long enough that it's worth reminding us, and perhaps educating some of you, why was the internet so successful when these other networks were not? It was successful for a couple of key reasons. A, no single body controlled the architecture. So innovation was open to people wearing sandals as well as people wearing suits. In particular, however, the internet brought in a layered model, the famous ISO 7-layer model. And that layered model meant that there were very well-defined interfaces between the different layers. What this meant was that an explosion of investment and an explosion of innovation and an explosion of commercial success happened at each and every layer in that ISO stack. So HTTP, of course, did not exist back in the IBM SNA world, the DECnet world, or the AppleTalk world. Neither did almost all of the physical mediums back in those worlds. So there was a huge explosion of innovation because no single body controlled it, and it was layered nice and cleanly so that people could do their work at a certain layer, whatever their passion was, without screwing up the whole model. IP would work regardless of whether it was token ring, FDDI, I'm naming technologies most of you have never heard about, and the 18,000 flavors of Ethernet out there. The result, we all know, there was an explosion, and everybody's happy about that. But how do we bring this to the wireless world? So we have essentially two worlds in collision. We have the world of homogeneous global standards set by large companies, controlled by large companies, who believe that homogeneity is a goodness, and it's clashing with the world of the internet, which I think we all know it's just paramountly heterogeneous in every possible way, culturally, technically, innovation rates and things like that. We now face the world after the iPhone, okay? We've been enjoying the iPhone for the past 7 years. We all know what it has done to networks, but we're now on the cusp of a massive explosion of wireless attached endpoints. And those endpoints will not always look like an iPhone. They will not have the same usage characteristics. They will not pay the same amount of money that an iPhone pays. Typical iPhone on the AT&T network pays $66 to $80 a month, often more, okay? The Internet of Things, the monthly revenue per endpoint is going to be somewhere between 25 cents, maybe $1 if you're lucky, depending on the characteristics of the device. We also have these great dependencies around the capabilities of radios, the capabilities of amplifiers, antennas, the capabilities of the device itself, and the fundamental capability around spectrum. What is available, how much will it cost to get access to it, and so forth. Technology being what it is, I mean, we're now in the world of RF. We're out of the world of fixed networking, fixed technologies. So these are very, very important questions for us to answer, and I'm going to address each one of these because these they control the rate of innovation around wireless networking. It have a huge impact. So the argument I'd like to put on the table for you, however, is that we're right at the beginning of the point where the internet will simply absorb wireless networking. Now, it will absorb mobile as we know it today, as you know it today, but far more importantly will be its impact, the go-forward impact on the rate of innovation, the rate of economic change, and the tremendous diversity in different technologies, fundamentally because it's going to introduce a layered model into wireless where there was no layered model. So let's look at this very quickly. I think I'm not going to dwell on this. Anybody that's ever spent any time in the internet world knows that it is a world full of experimentation. Everybody in this room has a chance at their idea. You can try your idea somewhere. It works, it doesn't work, it's accepted, it's thrown out. Both the culture as well as the technology model allows you to experiment at different layers in the internet stack. This is not comprehensive in any way. And of course, the world, it's a free market. The internet is a ferociously competitive free market. Technologies go in, they work, they get kicked out if they don't work. On the mobile side, we have a market that was defined by large companies, and because the cost of the spectrum was high and the capabilities of the radios were very primitive, the idea was to have a global standard deployed so that we can get the advantages of scale into a global market. At the time, this was undoubtedly a good idea. However, that was a good idea for the voice mobile marketplace. When we look at the cost decreases, now I've sort of credited Mary Meeker here, and how many of you have not seen Mary Meeker's latest work of art? Oh, this is an entrepreneurial audience. Good. Okay, so then you know that she does this annually, and you know that we always see the same basic idea here, a tremendously fast drop in costs and a tremendously fast rise in capabilities. But what I want to point out to you is why? Why is this so fast? Why is this such a good curve? It's because in the communications world, we have layers. You can do innovation on lasers. You can do innovations on coding schemes to get more in a small space. You can do innovation on DWDM, you can, on frequency manipulation, things like that. The layered model allows a constant and ferociously fast set of introductions of technologies that drives the cost down. On computing, it's even more aggressive. This is cloud computing. Now the challenge is, how can we take advantage of these in the mobile world? In fact, another way to look at it is, any of you who operate in the cloud space or in the app space, you know what a bottleneck today's mobile networks are. Between the cloud with all of its capabilities and its economics, and between the apps with all of their capabilities and their economics, you have this very painful thing in the middle called the mobile network. And coming to your neighborhood any day now is 10 times an explosion of end devices on these mobile networks. So we are all creatures of our experience, and we're creatures of the world we live in. And I think to an audience like this that lives for today, we have to just step back just a few years and think about the technology and the economics when we were connecting PCs, or the technology and the economics when we were connecting mainframes or mini computers. Now we're about to move beyond a world that only has smartphones in it. We're about to move into a massively connected world of tremendously different devices. Some of those devices, there was a great article by a fellow from Google, came out a couple of days ago, and he's pointing out the obvious. Sure, we all have smartphones and they all have Bluetooth and so forth, but what are you going to do about the farmer in Iowa that wants to put sensors in his field to monitor the humidity or monitor the weather or something like that? You must have a wide area network to do that. Okay? Obviously, smart car has mobile sensors. A lot of these sensors are moving around. They come on network, they go off network, they come back on network. We need a different set of economics, because that smart sensor in the Iowa field is not going to pay anywhere close. It's going to be probably 2 orders of magnitude less than what the iPhone endpoint pays today. So when we look at this, we see a market that is tremendously constricted. It's constricted by spectrum standards and proprietary technology, which stands in the way of 2 immutable forces. Forces of innovation and technology on the handset side or on the device end, and the forces of cloud computing. So let's talk about this. My argument here is that what used to be a serious problem is very rapidly becoming a force for disruption. Radios, you know, the number of frequency bands that the endpoint would support. Just a few years ago, Qualcomm was offering, you know, a 6-band radio or maybe an 8-band radio on a good day. They now have 40-band radios, and there's a clear path to, you know, over just a couple of years, there's a clear path to 100 or more band radios. I don't know their exact plans, but if you plot where they were 4 years ago and where they are now, it's a pretty impressive line, and we have no reason to think that they won't continue that line. At the same time, we have a new and emerging class of technology called a software-defined radio, which is something, a very simple radio that is just tuned in software very freely, everywhere from 300 megahertz all the way up to 3 gigahertz, so that you can basically name your frequency in software. So these are developments both on the infrastructure side and on the endpoint side that are very interesting. Now, anytime you have a radio, you need to couple it to an amplifier, an antenna, and you need to get access to spectrum. Now, the amplifiers, again, because you're making millions of endpoints, you need a significantly inexpensive amplifier. But because of the rapid growth in the number of frequencies that are being used, in particular by LTE, on a global basis, there's been an explosion of innovation around wideband amplifiers so that you can tune to any number of frequencies and you can get a good, clean signal amplified, and you can access the network. I realize I'm probably telling you more than you want to know, but there's a very interesting point to this whole story here. Antennas are not evolving as fast as radios or amplifiers, but they are evolving. And of course, the antenna in the end device is equally important to get a good, clean signal. But they are evolving, and we're on the cusp of moving beyond very interesting mechanical antennas to fully electronic tunable antennas, even in high quantity end devices. And so that will be a key factor to unlocking a frequency agile end device. And then spectrum, of course, is always a controlled issue here, but we're starting to see both at the policy level, the governments around the world, including in the United States, are now starting to talk about spectrum sharing, spectrum reuse, concepts where just because you own it is not enough. You need to be using it, and if you're not using it, then there will be a technical ability to reuse that spectrum. And what that does is it releases some of the control that the spectrum owners have. And then I'll speak about unlicensed and lightly licensed. So let's go back to the same diagram, and let's talk about layers. And as you can see in the classical, today's mobile market, we don't have very good layering between the top of the stack and the bottom of the stack. Again, it's pretty obvious in the internet world. So what I am proposing to you is that we will see something new arise, which will be a wireless communications stack based on the internet model, which will take into account what we really need, which is the ability to have frequency agility, to use whatever frequency we have, ranging from unlicensed to perhaps inexpensive, lightly licensed, to very expensive classical frequencies such as GSM, LTE frequencies. And because it's layered, we'll have the ability to innovate at different layers, just like we saw over in the wired internet world. This is the key point. The key point is that we bring the innovation model that worked so well in the wired internet, and we bring it to the mobile world, to the wireless world. When we do that, we can bring capital, intellectual and financial, to play at each and every one of these layers. When we do that, we unlock the grip that the standards bodies have now on today's mobile world, and we open up the technology to people with sandals as well as people with ties. So if you look at this, you know, there's something very interesting, a couple of things are very interesting here. One is the tremendous growth in the number of frequencies that are officially allocated for LTE now around the world. And just over a few years, we see LTE is now, of course, active in 700 megahertz. People are now discussing it down to 450 megahertz, and it's already active all the way up above 2.5 gigahertz. We're using whatever spectrum you can get in the world marketplace. Qualcomm, just a few months ago, put forth a proposal to run LTE over unlicensed spectrum as well as licensed spectrum. This is big news, because this is the first step in introducing layers into the mobile architecture. These are steps away from the homogeneous mobile world into a heterogeneous mobile world. This means that from Qualcomm's point of view, and certainly from mine, you can now use whatever spectrum you have available. If it's 5.8, great, you know, unlicensed, what you would think of as Wi-Fi spectrum, go ahead and rock and roll. If you have some other spectrum or you have the expensive flavor, go ahead, use it, it doesn't matter, which is exactly how the internet looks at life. If you have twisted pair, use it, you run IP on top of it. If you have fiber, you use it, run IP on top of it. So what we want to do is introduce the same model into wireless. So just as one example of this, you know, my company, Arranged Networks, has developed a software implementation of a base station, which of course is the key element in a wireless network. Everything you see here is done in software, with the exception of the software-defined radio, of course, which is a very, very simple, essentially, an analog to digital converter. All the waveform processing is done in software, and it's done in a layered fashion so that we can then start looking at the protocol stack in more of an internet fashion, and we can start just simply adding value at different layers. More importantly, and going back to this slide here, we're putting in APIs because we do not think for a moment we're the only smart people around. So we want other people to be able to come in and add value at, you know, their idea of a good modulation scheme, their idea of a good frequency management scheme. We are working with universities such as Carnegie Mellon. UC Berkeley has a program that uses this technology to do something in the white space area. And we're just starting, and it is early days, but we're starting to engage the type of innovation engines that we saw in the wired internet world. What this means is that we start to open up mobile. I think if I went around in this room here and I said, how many of you were investing in communications infrastructure, I think the answer would probably be 0. How many of you are doing cloud? How many are doing apps? Big numbers. Communications infrastructure in a wireless world, in the mobile world, has been tightly controlled. It's about to get exploded. Why is this possible? It's not just that the bright idea just showed up. It's the fact that the CPUs are now good enough that we can do baseband processing and software. We can do modulation schemes, any modulation scheme in software, including LTE. Software-defined radios were military technology until about 6 years ago. Now they're increasing. They are on a commoditization path of their own. They're not fully commoditized, but they're very inexpensive, and they're good enough for what we need to do. And then obviously software. And so we happen to use a model where we use open source software to increase the rate of innovation. Again, let universities at it. We're simply put, we're playing the internet book. Universities were the early adopters, and they were the early innovators on internet technology. So what does all this mean? What this means to you, because I recognize most of you are not doing communications infrastructure, probably most of you don't care. What it means to you is that the cost of the solution is going to go down at least by an order of magnitude, probably more, because it's all software. It's using simple software-defined radios on the infrastructure side. It's taking advantage of those very agile end devices, frequency agile end devices that are out there, whether they're iPhones or sensors in Iowa. And it means that we'll be able to build lots of different networks optimizing different price points, just like we have in the internet. We have core networks running at terabit speeds, and then we have your metro Ethernet networks. Totally different technologies at play, all part of a global architecture. So we believe that a huge cycle of innovation. I mean, networking in general has been a very quiet neighborhood for the last 10 years. We sort of finished in wired. Mobile was a neighborhood that Silicon Valley was not really invited to. And now Silicon Valley, I think, will have a role to play. So I put in this quote from Don Valentine just because I know there are a lot of young entrepreneurs here, and Don is probably the brightest person I know. And I think that's a very good quote there. Certainly it's one we try and live by. Mobile, the cost of mobile communications today, and I say mobile, not wireless, cuts a lot of people out of the marketplace. And I would just point out to you, because we all live here, we're all here in the Valley, we're all here in the American market. Frankly, most of us are capable, and we don't think twice about our $100 a month mobile bills. The rest of the world actually does care. And if we stay focused in a high-priced marketplace, we're going to develop high-priced technology solutions. And we're going to miss the markets of the future. The markets of the future are going to be dictated by the markets in Asia, the markets in Eastern Europe, where people don't have that much ready cash. And the technology that evolves up out of those markets is going to determine the technology of the future. We're placing our bets on those markets. I think probably the US market might be one of the last to convert. So I couldn't help myself but make an observation to close this talk. Mobile networks today work great. We're all happy. They work just fine. But they're not the future. They are mainframes. They do a particular job just fine. Now, you pay a lot of money, but they do a job very well. I would also point out, I think most of you know, but we don't spend that much time, maybe there's not a lot of overt sympathy for AT&T and Verizon, but these organizations are carrying huge debt burdens. They are, because the explosion of demand on the networks they have It's like putting video over a network built of mainframes. It's the wrong solution. You can make it work, but not economically. And that's the situation that most operators find themselves in now. So we moved, again, this is a young audience, but I think many of you have seen a mainframe before, and probably some of you have seen the original IBM PC. We've seen a lot of evolution in our lifetimes, and laptops are out, tablets and smartphones are in now. That evolution of technologies and end devices, and more importantly, the economics around them, will continue. And it would be a gross mistake to think that the mobile networks that we build and put out today will continue. I think the opportunity to reorganize them and to invite innovation to the party in the same way it did in the wired internet will be both exciting. I think it'll be an excellent investment opportunity. I think the next Cisco lies in front of us. And I think it's going to be the norm 5 years from now when we look back on today. We're going to look back on the networks of today as quaintly as we look back on these mainframes. So I wanted to leave a few moments at the end of the talk if anybody has any questions. Otherwise, I will check out briefly and we'll move on with the rest of the conference. So Stas, how would you like to handle this? Yeah? Yeah. All right.
So Ed, what do you see as key players in this software-defined radio business or software-defined entities? I mean, so you think about endpoints, their nature is going to be defined by software rather than hardware. So do you see any leaders in that space today?
So it is absolutely a software future. And of course, the world is different than when Cisco first came up. I mean, Cisco, of course, really was that company because they didn't care whether it was Ethernet, token ring, fiber, or whatever. They just sort of glued it all together, which is absolutely the future I see in next generation wireless. Having said that, as we all know, hardware is a commodity right now, and in fact, so it is. I think that the hardware elements of it will be deliberately commoditized, as they already are. I mean, all we need is a server. Okay, we just need multi-core CPU of some type and rock and roll. So it'll be a software model, and we will see more heterogeneity in the wireless networks. So we will see, we do see already M2M networks being built, new networks being built on odd frequencies. They just need enough volume of the end device to get something from China, low cost, rock and roll. Having said that, if you have an agile iPhone, which you do right now, of course, your iPhone supports 12 LTE bands right now. Imagine this. Now I'm arm waving, but why not imagine for a moment that it comes on net, it registers on a common band just long enough to say, I have a gold plan, I have a bronze plan, or I have a silver plan. The silver plan says, I'm going to use Wi-Fi whenever possible, and I'll go to the WAN when necessary. The gold plan says, I'm going to use that expensive frequency as much as I can. Or the bronze might say, I'm going to use the less expensive land mobile radio frequencies because that's less expensive. I mean, now I'm arm waving. My point here is that the end device can and will be agile, and the network will accommodate that. We will have some sort of registration process. The network will tell the device what your characteristics are, and then it will rock and roll. Apple is marching down this path, I mean, in my opinion. You look at the recent iOS announcement, they've been doing it for a while, but the most recent announcement on iOS is the most obvious, where your calls will now go over Wi-Fi when possible, as long as you have a Mac sitting in front of you, which is sort of their vision of this. But the point is, the network, the behavior is no longer homogenized. The behavior is no longer defined by the ITU and the four large vendors out there in Switzerland. It's open up to the rest of the world to innovate and develop new business models upon. So there's something we talk about in Range called an Internet Mobile Network Operator, an IMNO. And you know, this technology now is going to be so expensive, you can lay it on any internet infrastructure. You can run it at any frequency you want that you have legal access to. And the resulting cost of operating that network is less than the cost of generating the bill. So sit back and think about that for a while, and you know, why generate a bill? Maybe it's just customer acquisition, customer retention, customer monetization. The trade-off for free network service is I get to watch what you're doing. There's all kinds of new models that will come out of that because you've driven down the CapEx and the OpEx for that network, and because you've layered it, because you can't see what you're doing unless you can get in at the layers and you know, see what you're doing. So I think it'll be be very interesting. My timer is complaining. Stas, I thought it was you for a moment, but it was the iPhone. So.
Ed, I want to ask you about the trend, because all trends have a lifetime, and you have spoken about past. What about future? What are your opinion on the lifetime of this trend? How long it will be continuous?
Well, keep in mind that first generation of networking was very similar to what we have now in mobile. It was DECnet, IBM, and so forth. We then moved into the internet phase, and boy, that has been a good party for the last 30 years. And we don't really see the end to that party. But that is primarily a wired party. It's not really a wireless party. And I now think we're going to move into a wireless analogy of that layered innovation. And that, because we're obviously moving into a wireless world, I look around, you know, I don't know if any of you have been in multiple homes, but I have, and I think about the first time I remodeled a home and I put Cat5 everywhere, lots of it. The next time I remodeled a home, I put Cat5 everywhere, but a lot less of it, you know. And now I don't put it in at all. And we all use our lives, I think, as a learning experience. And my learning experience, even though we talk about wireless and so forth, it is a wireless world. It's just that we want more from it. We need more bandwidth. We need new services. We're in San Francisco. We have app companies coming to us saying, would you put APIs in because our app is mobile and GPS is a battery hog, and we want to know where the device is. Well, guess what? The base station knows where the device is. So, but this is part of the you know, putting layers in and then getting access to those layers. That model of innovation is just starting. It's just early days on that. I think it'll go for another 20 years at least.
Question? Oh, there we go. One more question. What are your thoughts on network neutrality?
You know, network neutrality, I grew up in Berkeley, which must be enough of you that are local to know what that means. It's where the anarchists all hide. And I used to have long hair. I'm a proponent of net neutrality. However, there's one, you know, element that we need to deal with, and that is video. You know, if you took, for a moment, you take video off the table, you could have net neutrality all day long, pure, unadulterated net neutrality. It's video, however, put on these networks that is killing the operators, killing the various players in there. And the internet, of course, was not designed, the IP network was not designed to accommodate the amount of video that Netflix is putting on it now. So there is a legitimate argument to be had between the various players in that argument, but it's an economic argument because ad money, problem can be solved. Better peering, better multicast, LTE broadcast. It's really an economic argument. It's not a technology argument. As a matter of personal philosophy, I favor net neutrality, but I also recognize the crushing impact of the massive amount of video that's being put out there. I think LTE broadcast which you may or may not even know about, it has great promise for some alleviation. It will not remove the problem, but there is now going to be a broadcast notion in wireless networks which will be helpful for some types of video. It's not going to be helpful for the unicast, everybody wants to watch something different at the same time problem. That's just needs money, better peering, more bandwidth.
Thank you for great presentation. Just one short idea to share. Maybe the best way is prohibit to engineers to participate in the ITU meetings. No ITU, and you solve a lot of the problem of open networks.
Can you imagine people, how many people have ever been to an IETF meeting? Yeah, okay. You know, people are sitting on the ground with their laptops, and they really are wearing sandals. And there's a huge democratization there of intelligent ideas, because they come from universities, wherever. They also come from big companies, but it's a wonderfully stimulating place to be. When the ITU starts allowing people like that to have an equal voice in the standards process, I'll take them seriously. So, all right.
Thank you. Thank you.
All right.
Thank you for your vision.
All right.
Panel of SVOD pitches. I'm asking Geoffrey Bayer, Cindy Padnos, Tim Wilson, and Spencer Tile to step up and take your seats on this table. And please, everyone, every investor, please come forward and take your seat at the front table. We have a great panel of about 15 investors going to judge our next 5 SVOD companies. As I mentioned before, we pre-selected 21 company. Oh, you first. Yes. I do it. That's me. Okay, great. 21 company out of over 250. And we'll start just in a few moments. Okay, so every investor, please step up front and take your front seats. Everyone with blue tag. Okay, so let's start from Ron. Ron, please, I need your help. So let's start with introductions. Ron, please pass microphone on the front tables, and dear investors, please introduce yourself.
Hi, I'm Monali Jain, and I'm a member of Harvard Angels as well as Kiritsu Forum.
My name is Dmitry Alma, Frontier Ventures.
Serge Plotkin, Opus Capital.
So, for me to introduce myself. So thank you. So here I am, rarely at a loss for words, but that's me. I'm Dave Mosby, Executive Director of Kiritsu Forum Academy. We help equip entrepreneurs to resonate with investors. So anybody who is either here that is an entrepreneur and wants to get better prepared with their pitches, come see me. If you're an investor who wants to learn how to listen to pitches differently, come see me. I look forward to chatting with everybody.
Yeah, my name is Sven Weber. I just launched 8 weeks ago the Shares Post 100 Fund, which is the first venture capital fund structured as a public mutual fund. We invest in the 100 most interesting venture-backed companies.
I did introduce myself before, Dushan Stojanovic, Global Ventures.
I'm Vish Mishra. I'm a partner at Clearstone Venture Partners, and I'm also a member of Thai Angels and a former president of Thai. So glad to be here, and thank you very much.
Hi, I'm Gene Smith, operating affiliate with Suha Capital. Thank you very much.
Hi, my name is Sergey Patsko. I'm from Project Ventures.
Now time for our distinguished judges at the stage. Please, a few words about yourself, about your funds and areas of your interest. Cindy, probably ladies first.
Ladies first? Okay, absolutely. Great. So I'm Cindy Patness. I'm the founder and managing partner of Illuminate Ventures. We're on our second fund. We're in that category people like to call micro VCs. We invest and have always invested strictly in B2B or enterprise cloud and mobile. That's our focus. We have some pretty terrific portfolio companies like Exactly and BrightEdge and Hoopla who are moving forward in very aggressive ways, and another just last week that merged merged last year, but last week received their first $100 million round in our portfolio, and that's a company called Coupang, which is in Korea. So what you might get from this is we do, you might think we invest outside of North America. That's actually not the case. All of our portfolio companies have started here in North America, but have wings elsewhere, let's put it that way. So that's a little bit about our fund.
Jeff, please.
So I'm Jeff Baer. I'm a general partner in Almaz Capital Partners. We just raised our second $200 million fund, and we invest in companies which are in Russia, Ukraine, throughout the region, and we attempt to build those companies out here if they have products which are relevant for this market, and there if the market is relevant. And our singular achievement is we just did an investment in a company where not one employee is in the same country as any other employee. So we have 12 time zones for 12 employees. So we'll see how coordination works, but we work pretty much in a global fashion.
Hi, Tim Wilson. I'm with Artemin Ventures. We're totally eclectic early stage venture capitalists. So our portfolio goes across life sciences. We're building buildings. We do food. We've done software. We've done a semiconductor company a couple years ago that made us the top semi-investor in the Valley that year. So we're hoping to create big companies. We're on our third $200 million fund. We also have a growth fund. So we go from about 250,000 seed to 40 million in a company.
Spencer Tall from Allegis Capital. Do you want me to move the? Okay, great. We're a venture fund located here in Silicon Valley. We focus on seed and early stage. We're on our 6th pool of capital right now. Of late, we've been investing primarily in analytics, storage, and cybersecurity type solutions.
Thank you very much. So before we start reviewing our startups, just a reminder, dear judges, everyone has this form. Please put your name, put name of the company and scores. It's extremely important for us to find the best company, but it's also important for companies to get your feedback. And for rest of attendee, again, reminder, we have a great support from Bizabu, one of the companies presented previously at the SVOD. Download Bizabu application and you could use Bizabu poll to put your scores for companies, and we could compare how good you as investors compare professional investors and your score at the later stage. So now, without spending too much time, I would like to invite the first company for this slot, Open Topic. It's a content marketing platform. Please welcome Open Topic. Please, can you switch? Okay, perfect.
Alrighty.
My name is Christian York. I'm the CEO and founder of OpenTopic. We are a software company based in New York, in Tribeca actually, and we are enabling content marketing. Very excited to be present to you today. I thought before I talk about OpenTopic, let's have a couple of our customers say something about OpenTopic. Gauthier Barbet, the head of multimedia at the City University in Paris, says, with OpenTopic, setting up 4 newsletters with great contents only takes us 2 hours a week rather than several days a month. Janet Granger, the head of content marketing at Pitney Bowes' $5 billion Fortune 500 company, says, OpenTopic is the easiest content curation tool to use. So the question is, how have we done this? And what we'd like to say is we've cracked the code on content marketing. Content marketing becoming a huge buzzword. It's more than a $40 billion market today. More than 90% of companies say they want to use some form of content marketing this year, which is triple from what it was 3 years ago. 75% of CMOs say we need to spend this year on content management tools. So it's a huge and fast-growing market. But the problem is it's still somewhat difficult and amorphous for the day-to-day marketing executive as to what to do. So what we have done at OpenTopic is we defined a very clear process for successful content marketing, and then we built and provide a platform that makes every step in the process simple. What is very important is behind all of that is that we say content discovery is not search. There's lots of abilities to search on the net and to find things, but that is not content discovery. The huge problem for companies in content marketing is, how do I find the content that truly speaks to my customer or my potential customer? That can be very difficult, especially in the B2B space. It has to be truly, truly unique, interesting content, and it can be found in lots of places. How do you find it? This is the issue that OpenTopic addresses and that we solve more than anything. We have a unique approach to content discovery. We combine search with influencer mapping because we're saying that it's not just in some type of news feeds or other information that's around the net. More especially, it's part of what key opinion leaders or influencers are saying, and they are in a way pre-curating what is interesting to you as a company that wants to connect with a customer. So the combination of search and influencers helps us to make what we call an addictive platform. OpenTopic allows you to find content, to organize it around the very specific topics that are interesting to you, to filter it in many different ways, and then again distribute it through your own distribution channels, be that your social media channels or your blog, your microsite, your website, your email newsletter, what have you, and really deliver very authoritative and authentic conversation with your consumers, which is really good content marketing. So we see ourselves as a surprisingly simple content marketing platform that is very collaborative, very effective, and that is truly a source of endless discovery. The good news is that it's an affordable addiction. We are a SaaS company. We have 3-tier pricing between $500 and $3,000, depending on how many topics you want to curate, how many users you have. Smaller companies obviously will not necessarily have more than one user. We also offer optional services that drive additional revenue for us. Things like newsletter integration, specific CMS integration, custom sources, and the like. Overall, OpenTopic is a very, very high margin product. The way we stack up in the competitive space is that we target the underserved content marketer. There are some large-scale platforms out there like NewsCred and Percolate, both who have raised massive rounds recently, that address the Fortune 500 market. Often they're around $10,000 a month. They're very intricate, targeted tower companies that have large teams doing content marketing. There's also people coming from the other end of the spectrum, like Rallyverse or Scoopit, that are really what I would call sort of Pinterest for content, but that they don't offer enterprise solutions and they don't do it at the right price. OpenTopic delivers a true enterprise marketing solution for people that need to do it and that need help doing it. So this is what this has done for us over the last 9+ months that we've actually been selling the product. We have roughly 30 customers with some of the best logos around the world. Comcast, Pitney Bowes in Europe, Starcom, Vinci, the largest construction company, and Gust and others. So we're very happy with that. We've raised an institutional seed round in January. Actually, one of our investors is here. And we've achieved 20% monthly recurring revenue growth with minimal sales or marketing investment. Actually, we're just hiring our first full-time salesperson now. Our team is myself and Sophie. We're both serial entrepreneurs. I've done 3 startups. I've also been an investor successfully. She's based in Paris. Our technology team is based in Poland. Our CTO, amazing Django and Python developers. And Dujan is a very active board member for us and has led our round for G Global Ventures. So our next step is we feel we figured out what verticals work for us, what we really do well for customers, how we truly make them happy, and we would love to scale the business. We think it's a huge opportunity in a fast-growing market with an amazing product. And we're looking for a Series A this year. Thank you.
Can I ask a pricing question, please? Me, hello. So the question I have is, if I'm the brand manager for Procter & Gamble running a global campaign through newsletters and such for a major brand, shampoo, and my budget is $500 million a year to target social media, how does the price of $3,000 a month compare to the guy who is essentially selling homegrown candles for $500 a month that you charge? So the question I have is the pricing model coherent? There was no mention of scale, scope. Can you address that?
Yeah, so the way we price it again is by the number of topics, which again is driven by the number of sources you curate per topic, plus the number of users. Somehow you must been in a meeting at Open Topic because actually we are doing a trial with the hair care division for P&G in Europe. And what they want to do is they want to provide content for hairdressers. And the way we would price it is, obviously, as they go up in number of topics, as they go up in number of users, it's going to become more expensive. So, at that point it will scale. So it's also when you look at the market, it's kind of the right spot to be, where we're not as expensive as the guys that offer very large workflows. And we are obviously much more expensive than the smaller guys that don't deliver enterprise solutions. So we've seen that as kind of a sweet spot for us.
So on your go-to-market strategy, are you planning on a direct model? Right now, your revenue is small. It's growing fast, and congratulations for that. But are you doing a direct model, or are you going to go through partners? What is your channel strategy, et cetera?
That's a great point, great point. So like you said, so far we've essentially been grown through founders' relationships and sales and introductions to our investors, and that's been very successful. As we scale, we think there's a few things. Partnerships are very important to us, so we have a number of partnerships already with agencies. So agencies, ad agencies are very good partners for us because their customers are potentially our customers and they need to do content marketing and show expertise. So we already have several customers through agencies and we expect that to scale. Where we have 2 or 3 customers per agency now, we can easily see 10, 15, or 20. We're also seeing significant upgrades within companies. So Pitney Bowes, we've upgraded significantly as a customer, starting with 1 newsletter in the US to now several newsletters in the US plus several international territories. So I'm not planning on really a large direct sales force because that would go up against the bigger guys. We're doing a lot of social media and other content marketing ourselves right now, which is driving leads to our website. And then we do a WebEx and a free trial and convert. But I am hiring 1 sales guy to address the larger accounts because we just see we're getting opportunities there because also our product, we have never lost a beauty contest so far against anybody.
So question regarding how you interrelate or how you see any convergence between content marketing and SEO. The holy grail of any CMO is to be able to drive traffic or drive leads or drive whatever connections without spending money on advertising and other things. So obviously those 2 elements come together at some point, including at the CMS level. How do you see a relationship there for content marketing with SEO?
Yeah, so I mean, we've looked at lots of studies, and specifically since we're focusing on curated content, right? And the knock is always you have curated content, it's duplicate content that doesn't get you SEO juice, right? The reality is really good curated content where you actually add your own perspective, gets you exactly the same SEO. But I overall see it more as a complementary thing, because I just think as a company, you need to be able to build thought leadership and build a different relationship. And I think it's going to get harder and harder to do that. One of the things that we focused on as a company was, I have deep knowledge in the media and content space, and companies that want to do content marketing really know nothing about content. They've sort of listened to the ad agency in the past, but now they need to compete on an even playing field on the net, where people have no attention span. They immediately, if they're not interested, they move on. So I think that makes it really, really hard for them to find the right content, which we're trying to do in a complementary way to SEO.
Can you share some insight? First, great logos, by the way, and congratulations on a small team getting that interest. Can you share some insights around the technology and how you curate? Because I was not clear in your presentation. Are you adding value in that, in selecting material for me to publish, or how does that work?
So good question. Too bad we didn't have time for a demo, because that's really what what would have been necessary to show that. But the way we do it is so we don't have our own search algorithm or anything. We access the APIs of Facebook or Twitter or whoever we search, but then we present the content both in terms of the news feeds, as well as we present also what Twitter accounts from influencers or so on are coming. We also rank them by trends in terms of what is going on in terms of social sharing for each one of those topics or for each one of those sources. So they rank higher if the content is being shared more on the social networks. And then what we allow very intricate keywords and filtering that say, I only want to see the stuff that's been shared 50 times in the last 24 hours, and so on and so forth. And so by doing that, one gets more and more specific, and we're seeing actually great success specifically in terms of local content over the last several months, which our competitors just can't deliver.
Okay. Question from investor tables. Any question? Okay. Let's end open topic. Thank you. And I'd like to invite the next company, Make Time, marketplace for unused manufacturing capacity.
Hello, everybody. I love the intermission music. It's quite flattering. Drew Parrish, CEO and founder of Make Time, and we're based in Kentucky. And I'm proud to talk about something that's near and dear to my heart, which is manufacturing. And as you guys know, the United States is built on and thrives on making things. Things like the coffee mugs that we've heard a lot about, things like your Tesla in the back. And these things are made on machines like CNC water jets, CNC laser cutters, 3D printers, etc. Make Time is enabling the future of making through an online marketplace where you can simply buy and sell machine time. This is something I've been doing for about 12 years. I've got a background in manufacturing, grew up in a manufacturing family-owned business. I've run a boutique offline capacity brokerage. Our COO brings a world of operational and financial management expertise, as well as advising and investing in startups and development stage businesses. And our CTO has a very unique blend of capabilities from web development and product development. And this all combines to give us a very unique vantage from the back end and the front lines of manufacturing and the problem that we're facing now, which is quite simply, the transaction process is broken. This is a holdover from post-war ideologies where we build to stock versus just in time. And some sub-problems within there, the quoting process takes too long. Anybody that's tried to make anything, the quoting process could take anywhere up to 3 months. Scheduling problems create order flow issues, which means your product doesn't get developed through the transaction. And then on top of that, if you're trying to move quickly, it's hard to verify your vendors. And so our solution is very simple. Buy the one thing that you know and you can quantify from a manufacturer, which is time. Don't think about parts. This is strategic. It's instant. It's just in time. And the way we do this is a seamless online marketplace, right? Where you simply search. If I'm a bicycle parts manufacturer, if I want to make a chain wheel, I go and I type that I need a laser cutter, and I need it for 10 hours, right? And I want to pay this rate. Or I just leave that empty, and it pops up. Likewise, if I'm a buyer, another part of our technology, I log on, I say I need 1,000 hours of CNC water jet time to cut stone, say gravestones, and I'm willing to pay $100 an hour, send it, mass text blast to our book that's existing right now. The way that we plan on getting our supply, which is a very critical component of every marketplace, of course, is through 3 value-added propositions, as well as a very robust acquisition strategy. The propositions are that we're going to monetize their idle time. That's first and foremost. Second, we're going to help them with scheduling. And third, we're going to help with their quality certification. And do this through a Midwest rollout. Like I said, I'm from Kentucky. There are 500 plus contacts. Give away free hardware and API. And additionally, through policy support, help them to get certified. And the way that we're going to get our buyers is, first and foremost, vendor verification. Helping them know who they're buying from. Simple peer reviews, escrow payment systems, and capabilities or verification as well. Likewise, offer them the things that they need. Most importantly, simple search, quick and effective transaction across 2 customer segments, which are manufacturers, right? And also prosumer-consumer group. Manufacturers, we're doing this already. Like I said before, I've been doing this for 10 years, and my book of business is already rolled up in this, and it's very real, and it's taking revenue. So direct sales, we're going to convert our existing sellers into buyers. We're going to do things like guarantees and incentives, as well as partnerships with industrial machine makers like Mazak or Haas, et cetera. Our prosumers and consumers, I'm very active on a lecture circuit, as well as attending conventions and conferences as is for manufacturing and digital fabrication. Likewise, social media push, referral incentives, and pushing forward through partnerships through natural friends like Etsy, Quirky, and Kickstarter. The way we make money is very simple. It's just a transaction fee based on platform payments. This is a variable transaction fee. Likewise, we're taking an enormous amount of data on manufacturing, energy usage, market trends before they hit the market that stakeholders will have access to. This is across a market. Yes, the top line is very large, manufacturing is huge, but we're focusing on the supplier side of roughly $115 billion. And this is existing within a pool of 226,000 manufacturers and roughly 2 to 3 million prosumers and consumers. And our addressable verticals, just so you know, are machine types. There are competitors in the space. You guys have probably heard of MFG.com as well as Custom Made. MFG.com is simply exacerbating the problem at a larger scale. It's still an RFQ aggregator. It takes forever. I'm actually signed up as a user with them. Custom Made focuses on smaller things, tables, jewelry, etc. Simply, we're disrupting the existing business model. So milestones. Started in 2013, primarily bootstrapped. 2014, first half, the state of Kentucky gave me an innovation award and a grant through the Enterprise Fund. We filed our patents. We are currently in beta where I'm switching all my existing manufacturers to an online platform. And then moving forward to the second half of 2014, we'll do our public launch. We're going to build out our sales, scale the platform. And then 2015, we're looking for our nationwide rollout after we get critical mass in the region, as well as launching our prosumer and consumer products. Thank you all very much.
So I'm curious about the market. Should we start in? Yeah. What are the products? What's the sweet spot for the products that are likely to be built, and what's the scale of them? And then a third element of that is, what's the repeatability of the business?
So we've got approximately like a 20% retention rate on our existing book, and the products that we make can then go from a chain wheel for a bike, all the way to a casing, like a kit case for a phone or something like that, all the way to like car handles. I've done prototyping for headlamps. In this model, that will exist there as well, right? It's just any kind of product that a manufacturer that comes down from a Boeing, a Ford, or whatever, we will capture, and I'll put a definition here, with the contract manufacturers and the job shops. Just so you guys know, the top line manufacturers, most of it is sent out of house. Contract manufacturer will run a devoted line. contract manufacturer won't have enough capacity to handle the load that they're given, and they're giving it to smaller shops, right? So to give a number to that, there's roughly 29,000 job shops in the United States, about 20 or so thousand contract manufacturers. Job shops typically $1 million, right? Contract manufacturers about 5 to 10 million. But so the product ranges greatly, right? And the capabilities range greatly, right? And part delivery is part delivery. It's a machine and it's a file. They need somebody to help the transaction move quicker.
So what's your take on a contract?
My take on the contract is variable. So in our beta phase right now, we're fluctuating. It's gone as high as 23%, right? Which is a great deal. Average transactions floating around $6,000. On the lower end, 10%.
So forecast out 18 months from now, what do you think you're going to charge? You're beta right now, so.
Excuse me?
You're in a beta phase right now, right? So what are you going to charge 18 months from now?
Sweet spot's 15%.
15?
Yeah.
Is that what your model's built on?
Yeah.
So just to be clear, when you send me work, am I doing it myself with my own labor force, and you're moving parts in and out? How does shipping of all that stuff happen?
Referral.
Yeah.
So
Sorry?
referral. So like a very simple thing, when you go through transaction, we've got keywords. It'll say, okay, we notice that you have a steel job, right? Material or Metals Depot is a preferred vendor of ours, right? And we've got a referral deal with them on the backside. And same thing with shipping as well.
So who absorbs the responsibility for defect control or meeting contractual standards? Because it's all over the map between aerospace and medical.
Yeah.
And some of the guys are real sticklers, and some of them, if it's a bicycle gear, well, maybe.
For sure, for sure. Well, first and foremost, the seller is responsible. But as a brand, an intermediary, we're guaranteeing that, right? So we're vetting out people, we're ensuring quality, right? If there's an issue, simple like transaction, we encourage that they first take care of it. But then we also have an instrument on the backside, like to ensure the contracts, right? Assurance. So that if somebody does repeal and say, like, look, you didn't get us the number of parts we want, and the parts are ducts when we wanted wheels, right? So what are we going to do? So we cash in and move on.
So you've guaranteed that. So what have you built in your model in terms of a percentage of that?
It's floating right now. It's high at between 1.5% to 2% of the transaction. But as it aggregates and gets bigger, the assurances, depending on how much in the frequency that we cash in, it'll diminish, probably float around 1% of transaction.
And how much funding you're looking for?
2.5.
And where does that take you?
Sales? Are you talking about like number or?
How long, how far, how long in your process does that
2 years.
2 years?
2 years. People down here?
Hi.
Nice hat.
When you're bidding out the jobs, are your customers only job shops, or could it be a factory that has excess capacity also that doesn't normally bid out jobs but may want to improve their?
It's open. So the supply line that I'm accustomed to and then I see it, the natural relationships, is that job shops naturally will be the first on board. But you know, it's just like it scales up to like say a seamstress or a sewing organization that has too much like work or not enough work. You know, it's got a huge manufacturer like I work with Lexmark in Lexington, and they have their own contract manufacturing firm. It's like a firm on the side, right, that just makes things for them. But they're a natural plug because they're trying to figure out how to get a revenue line out of it, right? So.
But for example, and to take a ridiculous example, if you want to make some big metal thing, would you ever envision, but certainly not at the beginning, that Ford Motor Company would have some extra machines, CNC machines or whatever, that it could be bid through?
Yeah.
Is that a ridiculous example? Or
I would say that I would love that if I didn't have to jump through 55,000 offices to get there. And so, you know, the focus right now is on the 115. If the market like starts to soften up a little bit in the way that we deal with like our supply lines and Ford is more approachable, then sure, there's tons of capacity there. They're probably floating at the same percentage of 70% cap utilization as everybody else and would love to make a line. So.
One last question. Yeah. So if you're charging 15 to 18% as your sweet spot, what is the marginal profit to the person who already has the entire fixed expense and fixed overhead when they get an incremental job? And are you leaving them enough profit for using up their excess capacity?
Yeah. So, and you can do the basis on that two ways. First of all, the biggest problem in manufacturing is a seasonal deficiency and cash flow issues. So on one end, we're helping with their cash flow outside of what their overhead's going to be, whatever their cap, et cetera. Sweet spot with them, ideally, any manufacturer is going to be like loving life if they can get 12 to 15% on a job. That's how tight it is now. The best shops are going to operate about 33%, right? So, right? Yes.
How much are they expected to make and what percentage of their profit on an incremental job?
Yeah, yeah. And I'm talking about GP right now. So GP, a gross profit, like on a typical job for any like job shot, like a good one is about 33%. So they're going to be walking away with 18%.
Yes, please.
One question. So I'm also in this industry. So, in order for this to work, you have to have a network effect for the marketplace to work.
Yeah.
A lot of companies, mid-size and large in manufacturing, they use large systems such as Oracle, AD, NetSuite, and some other ones. SAP and others.
Yeah.
Then you also have Ariba and you have Commerce One, which have the effect. What's your scalability? How are you going to deliver it? What's your connection to accounting systems? Because for me, as a CFO, large company manufacturing, I need to make sure that there's a full supply chain is working, not just your product.
Yeah.
So how do you affect that?
Yeah, I think that's a great question. So right now, 60% of all manufacturers operate out of that ecosystem, first and foremost. So they're independent shops, just like independent drivers, right, on Uber. They're all looking for work. So delivery-wise, and how does it scale? First is, as we take up the ecosystem, which I'm focused on, back to his question, job shops and contract manufacturers that don't rely on serious supply chains. They take mostly overfill or overflow work, right? Or they're back in that stream.
Exactly. So what's the size of the market?
What's that?
What's the size of your market you're trying to...
It's great right now. I mean, you're looking at like...
The size.
The size, 115 billion.
More questions from investor tables? Okay. Thank you. Make time. Thank you. And our next company, TagMap. Please welcome TagMap. TagMap.
TagMap. TagMap is a dating mobile application. Since you all know what a dating app is, I will quickly show you the app and then I will go into what's different about this app versus what we have out there. So that's the team. My name is Igor. I'm ex-Googler. Google was a big inspiration to me. My partner, Philip, lives in Belgium and he's in charge of the whole technical development. So that's how it works. When you open the app, you have to register. The registration is very simple. You put your picture on and you put some keywords, tags as interests. And that's basically going to be your profile. And then what happens, we put every single user who uses the app on the map. This is the current design of the app. Since the privacy is the concern, we put a big green button in the upper right corner. When you hit this button, you go completely invisible. Once you open the map, it's just a regular map. You can move it, zoom in, zoom out, move it to the East Coast. You can filter the results by gender, by age, and by those interests that you put on the previous screen. So what's different? Rating. In one word, we put rating to the users. Basically, the current dating app, they mix everybody together. By putting a rating, you make some users more special than the other users. Rating is the engine of the whole app. It's a combination of likes that people give you, chats, how many favorites, how many chat sessions you had inside the app. It's an intelligent algorithm that calculates your rating. Basically, it changes the whole picture of the dating. So why would you care about high rating anyway? Because we'll allow our users to play with visibility settings. On the visibility screen, it's not simple on and off switch. You can set the first one is the most important. You can set your rating, your visibility to be to your rating or higher, which means only people like with higher rating can see you on the screen. It kind of changes the whole picture. Another one is favorites. Favorites are just people like bookmarks, people whom you selected on the map. And then you can make yourself visible to only those users. That changes the whole picture, doesn't it? And obviously do you know what GLG is? No young audience. Good-looking girls. I learned it from my teenager son. You need a higher rating to get to good-looking people, obviously, in the dating. So why are we doing this anyway? You heard the man. It was a disaster. So basically, we trying to make dating experience better. We trying to separate stalkers from the nice guys. We trying to separate users and create layers of this virtual society. Monetization. Currently, we're making money by the banner, which gives you loyalty points. So every time you come to the app, you get some loyalty points, and you can exchange those loyalty points for like Starbucks card, for example. Some little things. But the real future, we're focusing on making in-app purchases. It's pretty standard for dating apps. Basically, to show off on the screen, you have to pay some money, and then your icon will be more visible than the other icons. Charge for rating points, that's still in debate, because it can potentially risk the whole trust in our app. So this is the new version of the app. It will be launched very soon. It's all built around virality. That's the piece, that's going to be the key piece for the whole application. We give our users lots of incentive for inviting other users, including loyalty points, premium icons, and they will get higher ratings because of that. So I cannot show you huge numbers right now because our second version is still in production. What you see on the screen is the current version of the app, and those are the users that we have. So this is just an example of what we had last week in the US. We had about 350 users per day. They generated, 7% of them clicked that banner that you see on the bottom, and they collected some points, and they made about $6, which is about 4 cents per user. So here's more interesting statistics, because it runs from the beginning of the year, from January 1st until today. So basically, let me explain it to you for a second. In the first column, you see the number of sessions. One session means the guy did not like it. They click the app and they're gone forever. The bottom, when you see 9 through 14 sessions and so on, that's my crowd. Those are people who actually like the app and they keep coming back. And you can see that's the major. So that shows the engagement and people on the app. So basically, what's going to happen in a few years? Let's say I can pull it off. What's going to happen? We will open API to this application so that other apps can use our rating and our statistic for their. We will collect this data and recalculate the rating based on this. Basically, we will create strata of this virtual society, and the most valuable will be the database of users that we have, because now we own basically a proprietary database of users' rating. We're looking for seed round, and the application is almost done. Thank you.
So I'll jump right in there. I have a couple of questions. First, how many women are on your team?
How many women?
Yeah.
So far, none.
Okay. What percentage of those users that are repeat users are women?
We have about 65% of men and 35 women.
Okay.
Is that on the repeat user?
On the repeat, yeah. This is overall stats. Yeah. It's pretty much the same.
So the reason I'm asking is, there's a fundamental assumption in the product around people wanting to be visible, especially, whether they want to be visible or not to people they've never met. And geographically, again, map-wise visible, like this person is here. Correct. They're very attractive, they have this fantastic rating, but do the women themselves actually want to participate in that manner? So my question really is, what kind of research have you done that demonstrates that this is going to attract the female portion of the equation, because it does take two to tango still? And I ask that specifically because my understanding of the dating market, mobile or otherwise, is that it is more difficult to attract the women than the men.
Yes, it is. And basically, what should happen, like I said, this version is not launched yet, so I will be closely monitoring the stats. What will happen, once you have good-looking, typically what happens, when you have good-looking girl on the map, she gets likes. the likes will increase her rating immediately. So if she can put her visibility settings to my rating or higher, she's gone from the main screen, and only guys who work hard will be able to see her on the screen. So we're separating those women from the basic crowd, and we're trying to make them special. Because otherwise, usually what happens, they come to the app, they get so many hits that they're gone in 2 days.
Right, so I guess still the question is, what market research have you done to show that this is attractive to women users?
I can see on the current version that they disappear. I'm trying to preserve those ladies on the app, and that's why we're doing this. That's how we came up with the whole idea of rating on the first hand, because the current version does not have it. And we realized that it's a mistake, it should happen. Does it answer the question?
Yeah, I just encourage you to find a great co-founder that's a woman.
Absolutely. I was looking for psychologists, actually. What we need really is a human psychologist on the team.
So I have a question which is really simple, which is the reason that a large reason that the semantic web failed and all those startups went away was people lie and they don't tell the truth, and they post a picture of themselves as a handsome person and they're really wizened and old like me, or the people claim something which is wrong. So the success of a service that depends upon attribute scoring, which is what this is how well the policing of the data and the preening of the data is done. And there's a fundamental problem with that, which is it's really hard to do that against very clever humans. And that is indeed why the semantic web failed. So how can you, if you'd be so kind to address that, you know, following up on what Cindy said, not only do you have to be accurate, but you also have to be certain that what people are saying is right. And that's proven to be very hard in the net at large.
The short answer is no, we're not policing any of this, and I realized that a bunch of this information would be fake anyway, and that's the nature of business. Let me get it straight. I'm not trying to get those people married. This is a game. This is a game of dating. If this information is fake, it's totally fine with me.
Hello. So the continuation of the question, so let's say I'm a man, I want to meet a woman, and I'm looking at your rating, it says 1,000 positive. It means 1,000 men before said she was good?
She got lots of likes, and she communicates well. Like, she had some long sessions and stuff like this, yes. And lots of people...
Then I don't want to date her.
That is totally fine. Guys, it's a game, really. You take it too seriously. It's a game of dating. If you saw Tinder and the success of Tinder, it's just a simple game, hot or not. This is a game.
More questions? Okay, let's thank TagMap.
Thank you, guys.
And next company to present is Squibble Interactive Collaboration for Designer. You get what you see. And this company is sponsored by CRDF. Squibble? Let's welcome Squibble.
Effective communication occurs only when what I intend to say matches exactly what you understand. Hello, my name is Tatiana. I come all the way from Ukraine, the aspiring IT outsourcing capital of Central and Eastern Europe, with a mission to make distributed work as easy as possible for designers and their clients. So why is there a communication problem between the designers and their clients? Meet Alex, a talented web designer from Ukraine. Alex suffers from loads of emails coming from clients all over the world, sending him corrections to the designs they ordered. Not to mention the endless phone calls and the reports that Alex has to write for the design agency he works for. What about Mark, Alex's client from the United States? Well, Mark has a vision of a corporate website. And getting that vision across to Alex is a big issue for Mark. So what is the solution? It's simple. What I see is exactly what you see. So what Alex sees in Ukraine is exactly what Mark sees in the US. Alex can simply go to squibble.com, upload the design sketches, and Mark can mark the exact places on the images that he wants to change. In this particular case, Mark dislikes the colors of the icons, Mark circles the problem places, leaves a comment, and gets the desired result from Alex. Squibble is perfect not only for web design, but also for interior design, media, printing, editorials, anything that has to do with images. Visual collaboration is a very dynamic market, very young and very vibrant. Our key differentiator in this market is the ease of use for the designer as well as the client. We literally streamline communication between designers and their clients in 3 simple steps. Upload design sketches, mark the comments for your designer, and get the desired result. As simple as that. Squibble has received a great recognition from the users. For instance, Adam from Circle Media New York writes, keeping not just design teams, but the relationship between the designers and the clients in mind, Squibble has made it practically effortless for all parties to communicate. And after being spotted by Mashable, our user base doubled. As of today, we have thousands of registered beta users working on thousands of projects just through organic growth. Already, our users are coming from all around the world. We start monetization in 2 months with a premium package. But as we grow our user base, our step 2 in this process is becoming a marketplace for designers and their clients to meet. Squibble has raised $40,000 from the East Labs, Kiev, Ukraine, and the ANZ Innovize Start Accelerator program in Australia, and are raising $250,000 to launch a global marketing campaign. A marketing campaign that starts here in the US, where our key demographic is. Squibble was brought here by CRDF Global, a US NGO that has kindly selected us amongst many startups. We have a wonderful team. Myself, I'm CEO of Squibble. My expertise lies in digital marketing and PR. I'm also a George Soros scholar in economics. Our CTO is a talented developer, Yuri. He's also a brilliant mind behind Squibble, and his expertise in our IT outsourcing has really drove him to develop Squibble. Dmitry, our designer, is a talented designer, a graphic designer, animation artist, and he really helps us target the needs of designers best with our solution. And our team spent an incredible 3 months in Australia developing our business with an accelerator there and growing our business network. Our goal is to continue developing a truly global business that is registered in the United States with business ties both in Ukraine and Australia and users all around the world. Squibble, get your design right every time. And if you'd like to learn more about Squibble, I'm happy to answer your questions.
Should I jump in? So one question I have, I'm off to your left here. Hello.
Sorry.
That's all right. There's a huge difference between being a product, an app, versus being a marketplace. And I'm wondering what your thinking is around which you really want to be. It's hard to be both, especially as a startup, and the focus that it takes to build the buyer and supplier side of the marketplace versus finding much broader set potentially of users of the individual product. So tell us a little bit about your thinking there.
That's a good question. That's actually our long-term vision, is to become a marketplace. But you are very right. At this stage, we concentrate on becoming a solution that helps designers and clients. But as a lot of designers and a lot of people are registering with Squibble, they all create profiles, so it's part of the functionality of the solution. And with time, they will be able to open their profiles for possible clients. So that's the vision, to evolve into a marketplace with time, taking the first step as a solution. Thank you.
So have you thought about the analytics that would cause designers to want to come and use the service? In other words, are you looking now at the data which says that once I signed up with Squibble, I received 25% more business this month? Or I am now seeing a new class of customer who previously I did not see before. And this gets to how you market the entire offering in any geography.
Oh yeah, definitely. This will come later on. Right now we monetize through a premium subscription where extra functionality will be available. Where extra functionality will be available on subscription, but a very different model will apply definitely as we evolve into a marketplace where designers will be able to get more business with Squibble, and so that's a very good point.
Thank you.
Can you give me insight as to why you picked the conversion from free to premium at those file sizes and minutes of voice? And then translate that into how big of a market do you think that is at $19.95 a month? Just translate it for me.
Am I right? You're asking whether how we came up with the numbers?
Yeah, the breakpoint, but I'm trying to size the opportunity that you have. There are many collaboration tools that allow me to visualize what I have. And so I can understand how you would share or get users to use it when it's free. Usually when you put a price point on, that's when you really know whether you've got a pain point or whether you've just got a nice to have.
Exactly. That's the reason why we are using freemium. So the basic functionality will remain, but it will be limited to a certain amount of files. This is what many are going towards, many solutions are going towards. And as big companies are using the solution and finding it helpful and more simple maybe than others, then we can charge a certain amount, which won't be a big amount. So like $19 per month.
Okay. Yes.
Burkov.
Oh.
Sergey Burkov. So you didn't explain quite well what the product does. Is it screen sharing? Is it synchronous, asynchronous? Is it like synchronous? So
yes.
both
see the
clients
same thing.
see the same thing. But if they are in different time zones, like Ukraine and US, does it work asynchronously also?
It does. It definitely does. So it's like a project management tool for visual collaboration. You can upload a file, you can look at it at the same time and mark it and comment it and talk to each other at the same time, or you can do it when the other person is offline.
And when it is synchronous, if one person writes something that the other instantly sees it. In the US. So in Ukraine, you draw a circle, and in the US, it's instantly on screen.
Yeah, it's synchronized all at the same time.
Okay, thanks.
And no plugins, no installations. All you need to do is to go to squibble.com, log in, and start collaborating.
How did you come up with the price? Did you talk to your clients? How did you come up, what's a break, is there a break-in point? What's overhead cost to support this, your price limit? How many users do you need?
Oh, the pricing itself, that's a good question. The pricing itself will definitely be A/B tested because this is the first starting point that we came up with. We are launching a premium package in 2 months. So
how did you come up with the price? Did you talk to your clients?
Benchmarking.
Benchmark against whom?
Next to competitors. So we saw what works for them and what may work. So
why your product is better than competitors then? Why would people, if people are already using theirs, why would they switch to yours for the same price?
Because Squibble is much easier. I know that's something that sounds from somebody from Squibble, but this is actually what we have talked to customers and what they say. For instance, if you are a web designer, it doesn't matter. You can use Balsamic, although it's quite complex. But if you are a client and you are not familiar with this technology and you see this interface for the first time, it's very difficult to start using it from scratch. So with Squibble, it's easy to start. You upload a file, you mark the exact place that you want to change, leave a comment, and that's all you need to know. So it's very simple.
Okay. No more question? Okay, let's thank you, Squibble. Thank you for great presentation. And I'd like to invite last startup for this panel, BSSL, Employee Performance Evaluation Platform. BSSL, please step up. Let's welcome. Yeah, encouraging. Okay.
Hello, my name is Alexander. I am the BSSL founder. We develop software for the analysis of employee interaction in a company. So we begin. Almost every company performs employee reviews, and most people not happy about it. Well, maybe except the HRs. Main problem are known and listed here. I believe that the major one is the obtained results are usually not actionable. And we know how to make it better. First of all, we want to help companies to discover and solve problems with employee interaction. We want to know who is communicating with who usually initiates the communication, how often other employees join ongoing conversations, how quickly people respond to letters. In general, we want to study instead of evaluating. We want to listen and observe instead of questioning. So how can we do this? I think, well, what about a simple button, a like or dislike button, simple dislike button or like button next to the message in the Microsoft Outlook? It could be a great source of data. So let me give an example. Let me introduce Andrei Skvortsov, our first client and our angel investor.
Good afternoon. And 20 years ago, I founded an advertising agency in Russia. And for the next 15 years, I was dead sure that employee evaluation is just boring waste of time. But 5 years ago, I faced a real problem. I had to fire one of my key art director. And the problem was not how to fire him. It's okay, I'm professional. But what happens next? Would I lose any client? Would any other employees leave with him? And honestly, I didn't even realize his real contribution to the successful projects. And there where Alexander came in with his psychometrical and social networks analysis. And the results really shocked me. First, I saw this map. This is a cluster of friends among employees. And here in the center, he's my guy. You can see that he simply doesn't belong to any cluster. Next, his contribution were judged by employees, other employees, anonymously. And I found that it was even lower than I expected. I've got a lot of interesting information, for instance, informal leadership, which he doesn't have much also. I found the real contributors, real but not obvious. And maybe the most important, I found the hidden emerging conflict between two groups of software designers. So results were really actionable. I was so impressed, and I am really, so I decided to invest and to share this technology to all Russian small and medium companies. But in the next 3 years, we've got only 2 such companies. One of them were my agency, but another was Headhunter. It's a major Russian headhunting agency. Instead, we got a huge interest from the big corporations, Sberbank, Gazprom, Rosnano, like this. And 4 years ago, I was graduating my executive education here in the United States, and I saw interest among my peers. They are leaders and owners of medium businesses here in the United States, but we're still working in Russia, serving big corporations, making all possible mistakes, gathering experience. And here's some of our results. As an investor, I actually like it. But now I think that we dream much better.
As a founder, I like this curve too. And by the way, we have been profitable for more than a year now. I want to stress that about 15% of our income comes from our partners, consulting companies, the users of our system. We achieved these results with our platform, with the main features are shown here. The first four shown with check marks we already have, and the rest we're going to implement. I believe that the 1,000 million medium and small, about 200,000 medium and small businesses in the United States. They employ 40 million people, so we estimate market from $800 to $1,500 million. We don't want to be a consulting company. We will provide online solution, and we will have 2 distribution channels. Consultants for large companies and self-service tools for small and medium businesses. Monetization is quite simple in our case. We'll charge for each evaluated employee. We are opening company in the United States. We need funding for open office in the United States, hire marketing and sales team, and further development here. Here is our team. Thank you for your attention. Please visit our site.
Okay, so our firm, it turns out, has done a lot of looking at the HRIT space, Human Resources Information Technology, and myself, I've been CEO or founded 2 companies in that space as well. So my question to you is that all of this always looks great until it comes to the point in time where you have to collect the data. And so I'm curious about, other than the fact that it's easy to use and it's in the cloud and et cetera, what is compelling for people to use it, and what integrations do you have to other HRMS systems or other third-party products that help create more value around that data?
Now, as to integration, now we have no integration to other HR systems, it's just our plans. What to collecting data? Now they use simple questionnaires with not obvious questions like how fast another person answers to the letters and so on, and then the special mathematical research about these letters. For instance, this map of France made by measuring how, if we both, for instance, assess each other, if we make our assessments slightly bigger than average, so the system sees it and put us together on this map. But Alexander says that not only questions could be useful, but analyzing the calls, analyzing electronic messages, and if you include a messaging button, for instance, like or dislike, was it useful or not useful, just by clicking one button, we can get a lot of information. It's I think it's mostly the most powerful idea we have now in the field of gathering information.
But you're saying, I thought you said you weren't integrated with anything, but you must be integrated with their email systems then.
Yes, absolutely.
Okay.
So I have 2 questions because we have recently looked at companies in this area. And when we went and did the due diligence with the existing HR departments, they hate these ideas because if the idea works, they get fired. The second question is, have you tried this in California, and how many lawyers have you hired? Because the problem is when a machine makes a mistake or collects information that one employee who does not like another employee sends in a bad reference, at least in California, there are not enough dollars in the bank to deal with the number of lawyers who will be on top of you.
What about HRs? if I'm talking about small and medium companies, they often do not have HRs at all, and I was using myself as an owner and director. I was using this system myself. We have about 100 employees. We don't have an HR, so maybe it's not a bad approach. What to lawyers, I think it's not about the system. It's about how to use this data. So it's just a diagnosis. So you found problems, you found some information, and then it's your choice how to use it. I didn't make my decision about fire person or not on this data. I just exploring what will happen next if I take one of this circle, one of this person, and put his out of my company. What changed? What it changed? So. But it's a good question.
I think the point he's trying to bring up, though, is there is a compliance piece to your business, and you probably need to do some more research in that area, particularly in different states have different compliant and regulatory processes, and this one tends to be pretty arduous.
Thank you. I'll think about it.
So I understand if I give you a like or dislike, and I also understand the time element. Are you looking at content and quality beyond like and dislike in the content of the message itself? Or is it just the rating and the speed and the frequency of communications between
Frequency, yes. Speed, yes. Amount, yes. Content, no.
Okay. And how do you know if I pull somebody out of that circle, what happens?
It's just recalculating the it's not easy to explain. Maybe, no. We've got a social network model in the organization, and we know all network connections. There are a lot of networks, network of friendship, network of working, network on likes and dislikes. And so we can modeling, if we put one out, what connections could be without him.
But he and I could be communicating as friends in my business, saying, "Do you want to go to dinner tonight? I like that idea. I like it."
Yes.
Right? You don't, if you're not looking at the content and separating out friendship from business, how does that work?
What's the sense of the friendship to business? This is the question.
Yeah. I use email for a lot of different things, and we communicate differently.
Actually,
with my peers
it's right to push or not this button. So if you receive a business letter, you can like it. If it's a friend's letter or somewhere another from Gmail, you cannot use it. So we use it, nowadays we use only questionnaires. So it's a very simple interface. I answer the questions like the same, like or dislike. And now we get
And if I know there's an impact on disliking your email to me, do I dislike it or do I like it? Because I know you're going to be rated or ranked differently because that's part of the HR system.
Of course, it has some influence of friendship, but the system sees it. So we've got information not from the real answers and likes or dislikes, but what to the average likes or dislikes and so on. So all the difference in statistics. Actually, Alexander knows more, but
speaks words.
Speaks maybe not. I'm not familiar with English, but Alexander was. More questions? No?
More questions from investor table? No question. Oh, thank you, BSSL, and this concludes the second panel of SVOD presentation. Dear judges, let's thank BSSL. Yep. Round of applause. Oh, perfect. Very encouraging. And now, round of applause to our judges, to our investors. Thank you for your hard work. And please don't forget to fill up questionnaire per company, put your name and name of the company, and just short reminder to everyone, invest your SVOD greenbacks to company you like. The companies that collect the more money, they will our IPO. And thank you, and in a few minutes, please give us 3-4 minutes to arrange a stage. No? How much? Okay, in 3 minutes we'll continue, so please don't go away too far.
Excuse me, everyone. One more announcement. That wall for the business model game is still empty. Please fill out the forms that are on your desks and put it against each company over there. Thank you.
Thank you.
Take your seats. It's time to start our final panel.
Okay. Okay, guys. Well, first of all, I'd like to thank Anna and Stas and all the volunteers and sponsors of SVOD for putting on such a great conference again. You know, they really deserve a big round of applause. But thank you, yeah. By way of introduction, my name is Leo Graver. I'm a longtime sponsor of SVOD. I'm a partner at a boutique law firm with a very long name. I'm not even going to say it. We have offices in California and an affiliate office in Moscow. We represent startups and venture capital funds. I mean, what makes me want to get up in the morning is the chance to get to work with you know, brilliant young startups, many of whom are here in the audience, and really amazing entrepreneurs and investors, such as you know, the four gentlemen that are sitting to the left of me. So without further ado, let me introduce our illustrious panel. The title of the panel is Building Bridges Across Seas and Continents. I'm not sure exactly what that means, but I think it has something to do with building global companies. And as you'll soon find out, all the four people here, all the four speakers, really exemplify that idea. So let me introduce, starting from the left. Sitting in a purple shirt is Nathan Lowe. Nathan is a founder of Zion Tech Angels, which is an Israeli-based fund. Over his 20-plus career, he has invested in over 100 startups, delivering an absolutely miraculous IRR of over 40%. Just incredible, incredible. Next to him is Roman Simonov. Roman is the managing director at Russia Partners, which is a subsidiary of Segular Gulf. And Roman is in charge of the technology fund of Russia Partners. Russia Partners is probably one of the largest and certainly I think the oldest private equity and venture fund in Russia. And prior to that, he was famous for bringing Intel Capital to Russia by launching its office in Moscow. Next to him, was probably the best hair on the panel, is Dusan Stoyanovich. All I really need to tell about him is that in addition to speaking 6 languages, he was awarded the Angel Investor of the Year by the European Angel Association. Pretty incredible. And our moderator is Jeffrey Baer, who is the managing director at Almaz, which is one of the most prominent Russia-oriented funds, although Jeffrey works out of their office in Menlo Park. So with that, I will leave the podium and let Jeffrey begin.
Thank you. So I think it would be a good idea for each one of us to define what we think a bridge model is, so that we're hopefully talking on the same page. And let me go first, not because I want to give a commercial, I'll just tell you what we do. And the idea that we founded our fund around was to have operations in Moscow, in Ukraine, in the region, find good engineers and teams to build technology which was applicable to the Russian, CIS, Ukraine market, and build the companies out there. But also, if the engineering and founding team had aspirations to build a global company for the global market, we would probably bring the operations, marketing, sales, and management here and set it up here. Maybe the subtitle for that would be that it's easier to hire a world-class VP of marketing here than it is there, with no disrespect intended. So that is our definition of bridge. And what we see ourselves as doing is not being VCs as much as being good program managers who allow the companies and enforce good communication across 11-hour time zones, good transfer of technology, and cooperation among many different teams. So I'll stop with our definition and ask you what you think a bridge model is.
It's not that different from your definition. Given that we actually invest only in tech, our definition is that we try to have the tech team in the place where we have the best engineers for that particular business. Having said that, we truly believe that it has, one of the founders or key people that are on the cap table have to be where the tech team is. And where our sales and marketing people are where the largest markets are. So that's basically the distinction. We have the tech team where the talent is, co-founded there, markets where the other co-founders are in terms of their largest market opportunity.
Thank you.
Yeah, thank you. So our definition, it's very similar to yours with slight nuances. So development team has to be on the ground in former Soviet Union. That basically a definition was also imposed on us by a few LPs that invest in the fund. These LPs have development mission, so we have to follow our agreement with them. And that can manifest itself in two different business models. So it could be a company out of a region which is former Soviet Union. It doesn't have to be Russia. We've seen companies out of Estonia, out of Ukraine, going globally, not necessarily to US. And it could be a company is here, started by a former immigrant or not immigrant, and has development team in the region. And if it's majority of value creation happens in the region, that's the target for us as well. So we can invest in Class A or in Class B. And hopefully two of them look the same before the IPO or M&A, but it's a long way there. And it's not always between Russia and US. We've seen companies like Viber, developers in Belarus and headquarters in Israel. So we do those deals as well. And we're pretty much looking for them.
Thank you.
Thank you. So we don't have a fund. We have a platform invested in 60 companies in Israel, 40 companies here in California, 9 companies not in California, not in Israel. And over the last 5 or 10 years, 300 multinational corporations have set up their research facilities in Israel. The biggest of which, the original one of which was Intel, then came IBM and Motorola, and all your favorite cell phones and other things have been designed over there. The technologies that come out of the Army are amazing. And it used to be that you used to have to move the company here to Silicon Valley to find the world-class VP of everything. What we found now, over the last 3 or 4 years, is the way to bridge the gaps and bridge the oceans is to go somewhere in Tel Aviv. eBay has an office there, and Facebook has an office there, and Apple has an office there, and they actually have biz dev people there. And these companies who have been started for less than $1 million already have a product, they're already selling, there's a tremendous shortage of capital, which is why we're bringing 11 of them here 2 weeks from tonight to Fenwick and West. Anyone who wants an invitation, come see me afterwards. We have 150 angels coming to see the 11 companies on the 25th. And the idea is that we can help these companies become international companies by doing strategic distribution deals with world-class companies that already have the distribution. There's no reason to reinvent the distribution wheel. We would love to take whomever's distribution system and to take our finished product white label it, whatever it is, and push it through. We actually manage, Zientech, manage the IBM's only high-tech accelerator in the world in Petah Tikva. It's on the main floor of the main IBM building. IBM has 1,100 PhDs and 1,100 salespeople in Israel. It's an enormous research center. We also have Checkpoint, we have Microsoft and whatnot, who are busy looking at the technologies that we are finding, figuring out how they can sell it through their networks. And so we are bridging the oceans by finding the biz dev people for the world corporations in Israel who are there specifically to find great Israeli technologies and to bring them through their distribution systems worldwide.
Thank you. I think one of the things that has become an impediment, at least for us, is the fact that we apply rules. When we invest in people, we're investing in the team. We're investing in you guys. And we're investing in the idea that you have. And we're investing in the dream that you have. And we come along to help them realize that. Fine. That's what we do. But the problem is we have to prove to ourselves that 10 other guys are not doing that. That the intellectual property is yours, is correct. And so what we do is a process of due diligence. And we examine the intellectual property. But we also examine the financial structure. We examine the organization, the governance, all of the aspects of how the company or the startup is organized. And one of the things that we've found to be exceedingly difficult is when there is a mismatch of what is very simply, maybe it's accounting rules in Ukraine are different from US accounting rules. They're not better or worse, they're just different. That the structure of how a company is organized, who has the ownership, all of these things are very different from region to region. So how do we solve that problem? It slows us down a lot, and we spend a lot of time trying to normalize and create a structure where we can justify to ourselves, yeah, it's okay. So it's very difficult, and we don't have the solution. I'm wondering if you guys see a similar problem, and how do you say it's okay?
Yeah, I would love to have a solution on that one. Then I would have got the Nobel Prize immediately.
I was going to copy his answer. Yeah.
But I would say the earlier it's done, the better. So I think we are investing a little bit earlier than you guys, so we're basically seed angel investor, right?
Yeah.
So basically the most painful thing I did was actually moving a company from Paris to New York because it had already accounting principles from French GAAP and then moving to US GAAP, and the legal fees and the accounting fees has been very expensive doing that. Now, given that background, we really prefer to have a US structure no matter where actually the original team might be, and actually do it rather earlier than later. So I guess my answer to that would be we try to do it rather earlier than later. So although we might not it's low cost at the beginning, it becomes a higher cost later on. So that's the only value add I can give on that topic.
Okay, Roma?
Yeah, we usually restructure companies when we invest. It's never Russian company. Right? It's always Netherlands, Luxembourg, even Cyprus, and you tend to think from the exit: is that company going to be acquired or IPO'd? If it's acquired, what is the best structure for the acquirer? Down the road, to have IP there, okay, employment's here, and management there. So we kind of thinking from the exit. It takes time, takes money to structure all of this, different jurisdictions and shareholders agreement, and then a fun part begins. How money flowing, from the company you invest to the operating company on the ground. How you do, deal with all this transfer pricing, accounting rules, of course, different. Not just French GAAP to US GAAP. It can be GAAP to IFRS or just management accounts with totally different recognition schemes and transparency issues. And you solve all of that at the time you invest, and you basically overspend on lawyers, on accountants, on due diligence, and it takes longer. And then after you invest, it also difficult. I'll give you an example. One of our tier one, London-based global fund, I negotiated a CEO agreement with our new CEO, of our portfolio company. Basically, typical, Western agreement job offer, with all the, comps and benefits, and just passed this to us. And to implement in the Russian environment, it basically took us another month, because here implemented will, over there employment agreement, right? You cannot have an agreement like non-competes, non-solicitation, so you have to change that. Different statutory requirements imposed on you by the labor code. If CO, it's called general director, it has special signature authority with the tax authorities, and you have to change that, and in order to do that, it requires us to change bylaws. If you change bylaws of Russian company, you have to synchronize, all the articles, to the holding company. So simple employment agreement to CEO, took 1 month and, $50,000.
Well, so just 1 second, Nathan. I think what the message for the audience is that expectations are not exactly the same as the actual reality of how long it takes to do these deals. We all get them done, but because of the additional complexity due to the international impedance mismatch, if you will, between laws, accounting, IP rules, et cetera, it takes a lot longer and a lot more money to get these done. I think that's the high order message. And with that, I'll give you back the floor.
So with respect to Israel or America, we're indifferent as to where the companies are headquartered. I'd like to make a slightly different comment to the entrepreneurs in the room. If you're starting a new company and all your business is going to be here and in Western Europe, then please locate your company here. If your company is going to be mostly overseas and you're going to do a tremendous amount of business in Asia as the world pivots to Asia, where the growth is, where the lower classes are becoming the middle classes, think about hosting or domiciling your company in a tax-efficient location and having a U.S. subsidiary. So you can pay your employees here according to what you're doing here, but you can hold the IP overseas, you can generate your revenue overseas, and so you're not shopping for a tax jurisdiction after you're making money and spending hundreds of millions of dollars re-domiciling. You're just starting out that way. So if you're a new entrepreneur and you're going to do most of your business overseas, headquarter yourself overseas and create a U.S. sub.
I agree with you completely, and that actually leads into a larger discussion, which is, so what are the outcomes? I mean, we've found, and by no means are we the experts, we just do this every day and we try to learn a little bit. We found that if you tailor your company when you started, when you tailor your company to be sold to Cisco, and this division of Cisco, A, it never happens, and B, no one else is now interested because you have something that's unique for only one outcome. So we prefer to say outcomes happen as they happen, and many times they're by luck. But the question is, so what is the outcome for a bridge company? Say the company is successful and they're domiciled in Singapore, or they're domiciled in the UK. Is it flotation on an alternative market? Is it purchased by an international purchaser? We're not sure. So what we have done in talking to entrepreneurs such as yourselves is to say, don't tailor the company. You can't know the outcome. Just do good work, sell like crazy, grow like mad, the rest will happen. Mm-hmm. Now that's kind of that's like motherhood. Yeah, it's great. It was easy to say that. Of course, it's really hard to do. But the outcomes we have seen have largely occurred outside of Russia and have occurred in the traditional London, Hong Kong, New York markets. So I'd like to hear your opinions on, is there going to be any change here in what happens with outcomes? Is it going to be purchasing by the large Asian electronic companies? Who's going to take these companies out?
Like more of a vision point of view. Yeah, I'm attending quite often a conference called the Global 1000 here in the US, which is every 6 months on the West Coast, every 6 months on the East Coast. And I really believe that the next Global 1000 will be Asia. So that's actually one of the reasons why I'm moving from Stockholm to Singapore. And I believe that the Asian companies will become very, very acquisitive in the next 5 to 10 years. So yeah, I mean, I'm taking a personal bet on that, from that point of view.
In Russia, we see now big influx of Asian money due to political events and some switch to the east. Obviously, but we've done IPO a technology IPO in New York, actually, 2 years ago. Our portfolio company called Epiphan Systems, mostly from Belarus, but developers are in Ukraine and in Russia, 11,000 of those. And they provided first outsourcing services for global, software companies, SAP, banks, and grew very nicely, and became like developer's developer, and to the point that we floated in 2012 in New York, which was basically first IPO, company out of Belarus in US, according to all these, strict rules. And it was quite successful, during the time when, Pandora and Groupon and Zynga and even Facebook, after IPO a little bit collapsed. So they exactly did, as you said, just execute, set good expectations and then exceed it, and then do it constantly, and was one of good performing IPO, over the last, for 2 years, stock quadrupled. And yes, exit is IPO, but we cannot exit at IPO, right? We usually take large stakes. In this case, we had, more than 50% of the company. So for us was, very important, not the IPO itself, but actually how company will perform after IPO, so we can sell along the way. And it worked out pretty well.
The IPO is only one step in the journey, so.
Of the 20 exits I've had over 21 years, 5 of them were IPO, one of which was on the Neue Markt that doesn't really exist anymore, and 4 of them were on NASDAQ, and 15 were strategic sales. All of you have commented about Asia being the future. I was at a conference 2 weeks ago in Tel Aviv. Of the 4,000 attendees at MIXI, fully 400 were from the People's Republic of China, and they are there to buy companies. They're there to partner with companies, but they're there to buy companies. And in the last few months, they bought the largest dairy in Israel. They're not moving the cows to Israel. They're going to take the technology, and they're going to apply it to all of the dairy farms that they have in China. They bought the largest chemical company in Israel. They're not going to move the chemicals. They're going to move the business processes and copy them, sort of buying business processes, if you will. And we are seeing no end of delegations from China to Israel, especially as China starts to get upset with the United States about different security matters. And so there is a extraordinary, and China's the largest single investor in both Israeli funds and in private placements of Israeli high-tech companies in the last year. And that number is only growing, and as wealthy Chinese, there were 30 or 40 family offices from China that had come to this MIXI conference specifically to invest in Israeli companies. So China has decided that they're going to reinvent their processes. But take a company like General Motors. You have the CIO, the Chief Information Officer of General Motors, is in Herzliya Pituach every single month. I guess there are more engineers that are going to help GM just north of Tel Aviv than there are in Detroit. And if you just think about it, 20 years ago, GM wouldn't have been caught dead leaving the United States looking for technology. And now they're there every month to get whatever they can, driverless cars, telematics, whatever it is that they want for their cars. They're going to, the path to GM's revival is through Herzliya.
Interesting. Well, so what we're hearing here is go where the customers are. Take the technology that's applicable to the global market and go where the customers need it. But I think what we're also hearing here is that the teams, the companies that are adaptable and if necessary can perform a pivot or can produce a product that is globally applicable have a materially larger chance of being successful. So one of the questions that my folks and I ask all the time is, so if you as a company, be you Russian, Ukraine, US, doesn't matter, when you decide that you're going to set your operations to address a major development facility or operational base in another country where you don't know the language and you don't know the culture and you don't know the business practices and you don't know the legal structure, this is not getting back into a bureaucratic question. How do you ensure success? And I would say that one of the VC community, at least in the US, over the decade of the 1990s, mid-1990s to 2000s, made a very concerted effort to move into India, made a very concerted effort to move into Israel, actually much earlier in Israel, and made a very concerted effort to move into India. And in my opinion, the people who failed were the guys who are not able to get a local team of native people who spoke the language, had the connections, and were willing to be motivated. And this was the critical fact. The motivation was different in those countries for what made those guys want to make the foreign company succeed. It was different. It was cash? No, maybe it was not cash. Was it social status? Great, I'm working for IBM. Fantastic. Was it, I'm going to get stock? It was different in each case. So that was a very rude, a very difficult education for US VCs. I'm wondering what you guys think in terms of, if indeed we're urging this pivot into China, into Vietnam, into Indonesia, into all of these fast, high growth societies, what are you guys going to have to think about to be able not to fall on your face with us falling on top of you? Thank you. So we need to have some way of thinking about what are the keys to making a foreign operation to yourselves successful.
Yeah. So on that one, you know, I've been in the angel investor, whatever, from 2004 to today. So it's about 10 years. So in 2010, I really said, you know, how do we crack this issue? And I'm still not sure that we cracked it completely, but the way we take really an HR human approach on it. Basically, all my partners, we are all angel investors investing together, are based in 8 cities. So it's here in the Valley, it's in New York, Paris, Berlin, Stockholm, Beijing, and Singapore. So that's only the cities where we are based locally. And then when it comes to the founding team, the company we invest in, it's the same formula. If we are doing whatever, Paris, New York, one founder has to be in each side of the Atlantic. If we're doing Beijing, Silicon Valley, one founder has to be on each side of the Atlantic. When I say founder, a local person actually. So it needs to be, in our case, somebody actually coming from that city. And I would even say city and not country. Because we are even earlier, we are very early. So it's kind of going into depth on the ecosystem. So who is this guy in New York, or who is this guy in Beijing or in Singapore who understands the ecosystem from a founder's point of view all the way down in depth. And then in parallel to that, we have the angels, that us, the investors, understanding the ecosystem in parallel to that as well. So that's how we try to address it. It has worked in 2, 3 cases, but we still have to prove this in the long run.
Thank you.
Yeah, we can actually help you to set up office there and get localized. That's not that difficult if you have a good partner on the ground, and we've done it a few times. What's important is to hire good local talent and retain them. And you have to think about, it's not like going to Russia, Ukraine, or Moscow. Big variance between Moscow and the other city in terms of cost, in terms of culture, in terms of retention rates of these people. And what motivates them, I give you an example. When I was acquiring a team of 650 supercomputer engineers into Intel in 2004, half of the negotiation was not about the price. Half of the negotiation was what projects they're going to work on once they become part of Intel. Right? They didn't want to work on chipset. Right? They wanted to work on a next generation chip to prove that they can do the best and win the world. And until that was ironed out, they couldn't agree to the deal, actually. So, that motivates, good engineers. And if the company is global, obviously, chances are that, this company competes on a global scale and will push innovation forward. So it's more interesting than to work for outsourcing company or for domestic play. So that's the advantage.
Thank you, Nathan.
Jeff, to break the discussion in 2 halves, in terms of companies' formation, I think it's imperative, sitting here in Silicon Valley, that the companies are formed in those cities and countries and cultures that tolerate failure, that celebrate failure, that learn from failure. So Silicon Valley is certainly a place that you can fail once, 2, 3 times, just get up and do it again. You learn from failure. If you're not falling, you're not skiing hard enough. Israel certainly tolerates it. There's a very, very flat model in the army, which is what everybody goes through. And you have to make your own decision. If it's not a good decision, make a different decision. But you're the only, there's no one to call. You just have to do it. I'm not sure that Asia yet is that tolerant of failure. And I'm not sure that I would start companies in Asia because their culture is one of consensus and no one losing face. And to fail is to lose face. The other half of your question, Jeff, though, in terms of once you have your great little company here in Silicon Valley or in Russia, there's absolutely every reason in the world to market into Asia because that's where the consumers are, that's where the spendable dollars are, and to the extent that you can find big companies with established distribution, take your great little product that you created in Russia or Ukraine or wherever and sell it through those great big companies in Asia that have all the developed logistical systems and supply systems and maximize your profits. That's the execution that you spoke about. So I wouldn't start a company in Asia, but I would certainly sell every widget I had or every software I had in Asia.
Well, I would say that in terms of failure mode, you're looking at the guy who said no to Skype as opposed to yes. Thank you. And so you have to know as a VC also when to say, hey, I was an idiot. But to learn from that. So let me ask a question about failure, which is there's cultural failure and the approval for that. There's the ability to say, you know what, I messed up. And that exists in differing levels, in different portions of the world. But generally, let's get back to the bridge model. Where I've seen it fail is in communication, in the assignment of a cultural bias from one side to the other. We're going to send all the testing over there because it's cheap. Well, you just heard, no engineer in his right mind wants to write test suites, and ever, right? Maybe the other thing that happens is those guys from the US are calling and telling us what to do, but we're the guys who founded the company. Those guys are morons. I'm not going to talk to them anymore. So there are many failure modes that are centered, to me and our team, who we do this all day, it's centered around communication, respect, integrity, and also the understanding that people want to work on something that they value themselves. And when any of those is not addressed in a respectful way, it's a huge problem, and it's really hard to put it back together again. So maybe you guys want to talk about what are the failure modes that you see for these bridged companies that are operating in different spots, irregardless of where they are, and how can you mitigate them?
I think it's a little bit to the point Roman mentioned a little bit earlier, that in those kind of 2004 to 2010, the first 6 years, when a couple of failures that we did, was when we did this distribution of engineers. We used them mainly for, let's say, productivity, cost, low cost. And we didn't really bring them into the company culture and also bringing them in on the cap table to actually, so they really feel that they are founders and part of it. So that's what we have changed, actually, based on some specific failure that I remember was in Ulaanbaatar. There were great engineers, really great people, and we couldn't keep them, so we lost them. So that would be specifically one thing that I remember from a failure point of view. In terms of, I was very impressed earlier today when I heard that this really worked between Moscow and Silicon Valley, especially in terms of the time zones. So I tend to say when there is a big time zones difference that it's more difficult because there is so little overlap in the morning and the evening, and it makes people get up extremely early and go to bed extremely late. But I don't think that's actually the issue. The issue is actually to get really the people as a whole team. And I would say the more you spend of time up front with these key people in the different locations up front together as a founding team, and that they do actually meet regularly physically, especially in the beginning, I think it's critical. And we didn't do that I didn't do that between 2004 and 2010, or I didn't push the founders to do it.
Yeah, failure starts when you start bringing, Western CEO to the foreign company. That's really tricky. So, and we saw a lot of failures, around that. To mitigate that, and I noticed some successful companies, and some of them actually became seriously successful companies in these bridge models, usually when there are two co-founders, and one co-founder lives here, and another co-founder lives there. And one is good, manager, CEO, and another one is good head of R&D, visionary guy, and they communicate constantly, and they've done it together, and they always 50-50 in every venture they do. So there is like brothers. And then if you see that happening, that's kind of for me like mark that risk may be lower in this situation.
Thank you. Nathan, did you?
Everything that the other speakers have said, I totally agree with. The cross-border transitions that we've seen that have worked are when the two founders trusted themselves implicitly, each other implicitly. And in both cases, the CTO was sent to America, and the business remained overseas. And the CTO came here to, in one case New York, one case Silicon Valley, to really get into the midst of the ecosystem of the tech scene, and it benefited both companies. But in general, having a company in two places is just one more thing that can go wrong, and it's hard enough to make it go right. And if you have a 10% patent batting average, you're doing really well. We don't encourage it, but the two companies that did it well. But it's just one more challenge.
Thank you. What I would like to do is have each one of us say the one or two messages that we'd like to deliver to you guys to take away, or to understand about how we work. And then after we each do that, then we'll open it up for questions. So being the moderator, I get to go first all the time. So I'm not right, I'm just first. So there are two things that always strike us that you guys don't do. You need to do your due diligence on us. Just because we have a checkbook doesn't mean that we're good guys. We can be idiots. Do you know how many companies come to us and say, I want to talk to other companies in your portfolio? 0. Do you know how many companies come to us and say, so what do you really do to help the companies? Other than tell us in the beginning, you're going to help us recruit the CEO of General Motors. None. 0. So you're going to be friends with us for 7 years. So you better do due diligence on us as well as we do on you, because it's going to make both parties a lot happier, especially if we're in these disparate locations. Because we got to like each other and work together and believe in the same thing, because we have the same motivation. And the second thing for us, and I think you guys should know this. You know what a VC does over their career? They make a grand total of about 15 decisions. That's it. That's your whole career. So if you want to be known as a really good VC, use extreme good taste and make about 15 to 20 decisions that you utilize that taste to be able to put all of your energy in. Don't do 500. So this is something that I want all of you folks to know, which is a lot of times VCs will look like they're going forever and making a decision. The answer is we need exquisite good taste. So you need to help us get there. If you can tell us more strongly why you guys are good and why you're going to help us make one of those 15 to 20 good decisions over my entire career, you're a friend. That's my messages.
Yeah, I think my two messages would be all this kind of legal, tax, accounting, cross-border stuff. Don't do that. Let the investors do as much as possible of that. Because if you do that, you're going to fail.
Right.
Big time. The second thing would be, and I'm repeating myself the third time, I think, is if you really want to become global and you want to do this kind of global thing with, distributed teams, whatever, make sure that you do have the complete team yourself. It's very difficult for an investor to say, you need to find a co-founder, this is a guy I know. It needs to be If you want to, play soccer and win in Brazil, you need to get to know each other really well, and make sure that that team is, diversified in terms of geography, but also, if it's possible, in terms of men, women. You got to have all these ingredients to build a global team. That would be my second.
Thank you. Well,
my advice will be on a personal level. If you to build global company, successful, it can be done. It was done, right? If they can do it, you can do it. But just imagine, you'll be traveling a lot, not going with your wife on Fridays, not seeing your kids, having these phone calls, conference calls, during holiday here but not holiday there, or on Friday night, when it's morning there. And really get your family support before you do it, because we've seen so many divorces, second marriages, another divorce, and usually when company is not successful, then divorce happen, and you really don't need that. So really get your family buy-in, before you commit to that journey, and then the rest will be easier.
Thank you. Nathan.
So to the entrepreneurs, 2 messages. 1, don't be afraid of selling your company after 2 or 3 years. You're going to have other great ideas. And once you have the capital from having sold the first company, it'll be much easier for you to come up with an idea and fund it yourself for the second company. So you don't have to build the world's biggest company. Don't be afraid of selling it. And the second message is one that I fundamentally believe, and I've seen it to be true in the 120 companies we funded and the 1,000 companies we haven't funded, and that is dilution does not matter. If your company is going to be worth $1 billion or $5 billion, it doesn't matter what percentage of the company you own, you will have more money than you can possibly spend in your lifetime. If your company is going to be worth 0 because it's bankrupt, which 80% of the companies or 90% of the companies will be, dilution also does not matter. If your company's only going to be worth $10 or $20 million, then whether you have 10% or you have 30% does matter. But there isn't a single entrepreneur in this room today, or one who starts a company, who actually feels that his or her company is only going to be worth $10 or $20 million 5 years from today. So therefore, pick the best VC you can find, pick the best angels you can find, share the equity with everybody who gives you money, share the equity with all of your service providers, share the equity with all of your employees. The dilution absolutely does not matter unless you are only modestly successful, in which case, don't start the company.
Thank you. So with that, we have about 5 minutes or so to take some questions. And what I'd like to do is open the floor up to people who have questions. And the only rule we have is don't throw anything at us. So, anybody have any questions about kind of where we're coming from philosophically, what we see as the future? I circulated these questions to the group to kind of think about this deeply before the session. And so if there's something that you feel that needs to be addressed, by all means. So with that, anyone? One person in the orange. Just a second. So, and when you get the question, would you tell us who you address it to or the entire group?
Thank you for the interesting panel, actually. Actually, this is addressed to all of you because you know best. So, actually, you have thought of difference in culture in different countries, okay? Just I want to know, actually, if you cannot motivate employees by giving out stock options in some particular countries, okay? What can be done for motivating the team to go forward, actually? Thank you.
Anyone want to take it? I can give it a shot?
Yeah.
Okay. So it comes down to, it's not immediately obvious. It comes down to immediate versus delayed reward. And if the delayed reward is recognition, well, then maybe you get a method patent on something and the entire world knows that you're a really smart person. That's one thing. Is it intellectual property ownership, patents that you can license out or derivatives? Is it licensing of software that you write? Is it the ability to be in contact with a team of people who in the next job, they're superstars and they put you in contact with the absolute best people on the planet? So the answer for me is it's not intuitively obvious. Money immediately is not always the solution, is not always the attractant.
Yeah, I would say, especially for the engineering talent, which is kind of the major concern we have, it would be to keep them really working on the really coolest stuff you can imagine all the time. As soon as something new cool comes up, they need to be in the loop. That motivates a lot on the engineering talent. Obviously, that might not be that productive in the short term, but in the long term, you retain them actually. So always, what is this new stuff? What do you think about that? Do you want to give me your ideas, your input on that?
Any other? No?
And actually give them the options. You know, it's a good system. Why not?
Okay. Okay, any other, one more question.
Quick question. Thank you once again for sharing your thoughts. It's interesting that you mentioned various workable scenarios where founders are across different cities, continents. One of the signals I'm getting from other investors is that it's actually beneficial to have co-founders actually in one location to facilitate the clearly cooperation. What's your take on it? Do you think we're gonna diminish our chances of finding it like in this scenario, or not? Even how? Thank you.
I didn't get the question.
I didn't get the question.
We didn't quite. There was a little difficulty with the sound system. Did you say that you and your other founder were in different locations? I apologize for that.
We're getting signals that it's more difficult to find funding if your co-founders are separated.
Funding.
Yeah.
Sorry, was the word funding I missed.
We apologize.
Yeah, I agree. I mean, it is, if they are separated, it is one more thing to say no to, for sure. I would say, you know, like the example we had earlier, why did Skype buy, you know, the team we saw last time? One thing was the product fit, you know, and all that. But one thing, you know, indirectly was Skype had already, you know, started their own company in Estonia, Stockholm, and a couple of other cities. So it's all about if you can recognize, you know, that VC that has had some, you know, really successes in founders being in two teams. So, you know, the Prezi guys, when they went to Silicon Valley, you know, they are in Hungary, now they're here. Who invested in them? Well, go to them. You know, look at, you know, who are the VCs who have had successes.
And then not just VC, exact partner in that VC who did it. It really matters.
Good point, Roman. Okay, well, with that, I'd like to say thank you all for listening to us. I hope it was enjoyable for you. We appreciate it.
To have your card.
Nice.
Hello. I would like to thank you, the panel here, once again for a very informative and interesting conversation. So, wanted to give a couple of announcements to everyone here. First of all, you know, we have amazing speakers and amazing sponsors, and I would like to thank our sponsors once again: Almas Capital, Microsoft, Singular Gov, Ring Central, GWT, Cale Gates, Finex, Silicon Valley Bank, Luxsoft, and Pulsar Venture. And tomorrow, we're going to start at 9, so please be here. We're going to start with the pitch competition again. And right now, I would like to close today with the invitation to join us at the reception over there in the hall. Thank you very much, and hope to see you tomorrow.